Hello there.
Well, hi, Neil, and hello, fellow fools. Welcome to this edition of Fool24. I am Danny Vena, Hawaiian shirt enthusiast and Fool contributor, and I am joined by everybody's favorite couch investor, Neil. How's it going, Neil?
It's going well. It's going well. How about you?
It's raining here in San Diego, which is a rare occurrence. So we're happy to, get the rain. In fact, I saw somebody throw something on Slack this morning about blame it on the rain. So we'll just take that and run with it.
Yeah, I mean it's raining outside, raining in the stock market, so it's raining a bit everywhere.
Yeah, fair to partly cloudy. And that really segues right into our topic of stocks to hold for the long run. The thing about the way the market has been behaving lately, there's a lot of volatility, there's a lot of uncertainty. I was looking at a few things this morning. Um, Somebody on one of the national morning talk shows said the dreaded R word, said some analysts are wondering if we're headed into a recession. Um, when there's so much uncertainty around inflation, around the trade war, around tariffs, around lofty stock valuations, we're kind of getting this perfect storm that has brought the Nasdaq down into correction territory. And I'm not sure if we're still in correction territory this morning. I should probably look that up. But it really gives us as long-term investors, and an opportunity to be able to buy some quality companies at discounted stock prices. So I'm looking right now. It looks like the Nasdaq is still down 13% off its peak. So we're still in correction territory. And I would say, in days like these, I like to, focus on building that list of stocks that I can buy and hold for the long term. And I should qualify that by saying that we don't know if we've reached the bottom yet. Nobody does. Anybody who says they are, they're making stuff up. But if you're looking at quality stocks, if you're looking at the opportunity to buy stuff, several of the companies that I'm looking at right now are cheaper than they've been in a little while. And I think that they will be worth much more 3 years or 5 years or 10 years from now. So that's kind of my take on what's going on in the market and the opportunity it's presenting.
No, I agree actually. I mean for long-term investors, days and weeks like we've had in the last couple of days, couple of weeks, are probably one of the best opportunities to build out good positions for the long run. You look at good companies that are trading at cheaper prices, yet the business is still doing quite well. I think for me, that's just a perfect mix. And I've seen a lot of conversations and comparisons. 2025, market is down. Is it the same as what we've seen in 2022? Huge bear market in 2022. And I think the comparison to me does not make much sense because going out of 2021, we were going into, well, super high inflation. Interest rates were going to go up quite rapidly. And now, in my eyes, we're having unemployment rates closer to 4%, quite far from the feared 5%, although did go up a tiny bit to 4.1%. We're still quite close to full employment. Yes, inflation, we'll see what happens with that, but all in all, it has come down. Economy-wise, we're still doing okay. Not great, we're doing okay. Valuation-wise, we're definitely doing much, much better today than in 2022. In 2022, I've seen some price to sales ratios of 40x, and that was the norm back then. Today, we are much, much lower. The big tech companies are trading at very attractive valuations, super strong businesses at great prices, is in my eyes, well, a good time to go shopping.
Indeed. And, what I wanted to do is maybe kick off, this hour with a couple of companies that I think are reached pretty compelling valuations at this point. Because, with the market coming down the way it is, I want to start looking to companies that I think have bright futures, but that also, might offer compelling opportunities at this point. So I want to go ahead and share my screen for just a moment so we can look at this chart on Y charts. And I'm going to share right now. And actually, I'm going to go ahead and change this to a larger version of the same chart just as it makes it a little bit more visible here. So the two stocks that I have pulled up on this chart are Meta Platforms and Alphabet. And as you can see from the from the charts here, Alphabet currently has a trailing 12-month PE ratio of 20. And just to give you a little bit of context, so I looked at let's see, multiple.com, and it shows the multiple for the S&P 500 right now at 28. So having the opportunity to get Alphabet stock for a PE of 20, I think is a pretty compelling valuation. The other is Meta Platforms, and they currently have a PE of 25, which also is below the broader market. And as you can see, from the chart, I'm going to go ahead and just change a couple of things here really quickly so that you can see what these are compared to their 3-year averages. And I'm going to start with Meta Platforms. And right now you can see that, Meta Platforms is approaching its 3-year average after being, pretty high. Its 3-year average PE is about 24. And let's take a look at Alphabet now, and we'll do the same thing. I'm going to change this chart here and apply this to Alphabet so that you can get the same view here. And you can see right now that Alphabet is currently trading for a PE of 20, and its 3-year average is 23. So it's actually below average. So I think that, that kind of gives you an idea of the bargains that we're beginning to see. Both of these companies are Magnificent Seven stocks, which were among some of the highest priced, valuation-wise stocks in the market just a few months back. And now you've got two of them that are clearly in bargain territory.
I agree. I own both of those businesses. And yeah, I mean, with Google Alphabet, it is quite interesting that even if we look at the average, it has never really been that high, right? With the others, they've been closer to 30 times. But with Alphabet, it has always been around 23, 24 times, which is quite interesting. On that company specifically, do you think that the rise of the ChatGPTs, the perplexities, and all of that, do you think that's a big enough concern to drag that stock down?
Now this is, my opinion, of course. I don't necessarily think when you're talking about Alphabet, I think you have to look at the totality of the circumstances. And I think part of the reason that the stock price has stayed lower than some of its, rivals or peers in the space is because of a few items of uncertainty. The first of which is you have the court case where Alphabet was found guilty of monopolistic practices. And so we don't have a decision on what the remedy is going to be. The court has been presented with a number of remedies by the Department of Justice. And a few of those remedies, they said that Alphabet could be broken up which I think is probably the least likely outcome. They also said that they might force Alphabet to share some of its algorithms, some of its search algorithms, to basically take away some of the advantage that it has in search over the competition. And another is that they would be, I can't remember what the third remedy was, but those are the two big ones. And I think in either of those cases, I don't think that is going to be a deal breaker for Alphabet shareholders, because if they lose a slight advantage in their search, they still have 90% of the worldwide search. They still are top of mind for many, folks who are searching for something on the internet. And even if the stock does get broken up, if the company gets broken up into several smaller pieces, I think that could potentially unlock value, which would be a benefit to shareholders. The other issue, I think you're right in mentioning ChatGPT. There is the common narrative that Alphabet has fallen behind a little bit in the AI race. And I think you have to look at what it is that Alphabet does for a living. Yes, there is the potential that ChatGPT could steal some market share in search, although I don't think it's going to be much. I think if you go to a Google search now, more and more you're seeing where its AI is basically the top search result that you will see is generated by its generative AI offering. And so I think the fact that that is there shows that Alphabet is not really behind in the AI race. The other thing that Alphabet does is digital advertising. And the company constantly uses AI to not only improve its search results, but also to place those advertisements, targeted advertising, to make sure that the person that sees that ad is the person that's most likely to act on it. And so I think given the totality of the circumstances, I don't think that there's that much of a threat from AI, although the technology is still evolving. So we don't know what's going to happen, several years down the road.
No, I came to the same conclusion. I did a video article today on Alphabet, and it's quite interesting. Like you said, search is evolving, right? It's been years since it's just been the 10 blue links. It's evolving in the United States. When you go on Google right now, you can ask a question, you get an AI overview, which is basically you get an answer. There are a couple of links on the side, but at least you get the information that you want. For example, how I did a fun search today, how to cut onions without crying, and it gives you a couple of ideas how you can stop crying when cutting onions. You don't have to click on multiple links. I believe the CFO last week had a conference with an analysis firm. I can't remember which one it was, but they shared that they have 5 trillion queries annually on Google at the moment, which is not too bad. At the end of last year, there was one firm that came out with a couple of numbers on the market share in the LLM game. From 2023 to 2024, ChatGPT actually went from 50% to 34%. The one that did take quite a lot of market share is one Gemini, went from 7 to 12%. Anthropic, which is Claude, went basically, it doubled. I think it went from 8 to 16, no, from 12 to 24%. So we're still early days. Of course, ChatGPT has that early advantage, but it is changing. Google, of course, has that Gemini and Google search advantage, which is basically, well, you go on Google search and they use their own proprietary data. They use Gemini. And like you said, for advertisers, like we've seen with Meta, they can use AI to make sure that the advertisers have a higher return on investment. The ads are going to be better targeted than ever before. And it's a win-win for everyone. It's a win for the consumer, for the advertisers, and for Google Alphabet. Plus, like you said, the sum of the parts, if they have to divest, is I think larger than what we're having today at $2 trillion in market cap.
Yeah, I absolutely agree. So we have a question from Peter. I hope I pronounced this correctly. Huang, from 3 minutes ago. Is the PE ratio price to earnings? Yes, yes, it is. And what does it mean? Is it better, higher, or lower? So essentially, the PE ratio is the stock price divided by the earnings to give you a quick and dirty on what the company is producing in terms of profits compared to the stock price. Generally speaking, it's better for that number to be lower than higher. However, if it gets too low, that can be an indication of a value trap. Which is a stock that's its price to earnings ratio has gotten extremely low because its prospects for future growth have fallen off a cliff. So I generally speaking, and right now, as I said, it looks like the S&P 500 has a PE ratio of about 28. And the stocks that we were talking about, which was Meta Platforms and Alphabet, have PE ratios of, let's see, Meta has 25 and Alphabet is 20. And generally speaking, again, because these are lower than what the S&P is currently, that can be generally seen as an indication that these are a good value right now. These are a better opportunity than what they were just weeks ago before the market started tumbling. So good question, Peter.
Yeah, I agree. Quick and easy, well said. There is one from Let It Ride 15 minutes ago. I think this is a more challenging one because I think we both like all of those names. Please rank the following for over 5 years investments: Google, Nvidia, PayPal, New Holdings, and Mercado Libre.
Well, that's an interesting eclectic group of companies there. GOOG or GOOGL, which is Alphabet, NVDA, which is Nvidia, PayPal, PYPL, New Holdings, NU, and Mercado Libre, MELI. This is I think maybe I'll just apply a little bit of what the companies do for our viewers who may not know. Google, aka Alphabet, is the world's largest provider of internet search. They are also one of the big three cloud providers, and they are the largest provider of digital advertising in the world. Nvidia, as I'm sure many of our viewers know, is the company that pioneered the graphics processing unit, or GPU, that was a hit and revolutionized gaming. And since then, found that the parallel processing capability of the GPU can apply equally well to moving data around the ether. So good for cloud computing and within data centers. And it's particularly adept at training and running AI models. PayPal is one of the original fintech companies. They pioneered digital payments back before it was a thing, and they continue to do so. New Holdings is a digital bank in Latin America that does not have any legacy bank branches, but they are essentially all mobile. And Mercado Libre is the largest provider of e-commerce services in Latin America. They have some of the elements of Amazon, of Shopify, of PayPal, and they are very fast growing. Now, for my top ranking, I would have to quickly put that between either Nvidia or Mercado Libre. Mercado Libre continues to grow at a fair clip. I think most recently, I'm going to say over the past several years, Mercado Libre stock has gained, let's see here. Yeah, it looks like the stock has doubled over the past 3 years. It kind of bottomed in July 2022, so it's been a pretty good performer. When we're talking about Nvidia's AI opportunity is sizable, and even after the stock's recent decline, it's up about 380% over the past 3 years. Now, when we're looking 5 years out, I think Mercado Libre is a more consistent and a little bit slower grower. So I would probably put Nvidia first, and then Mercado Libre. After that, I'm probably going to go with Alphabet because I think that stock is poised for a pretty rapid rebound. And then after that, it's between PayPal and New Holdings. Now, New Holdings is a company that's doing very well, but it's not one that I follow as well. But I do know that PayPal has a lot of challenges right now. They have been trying to get a handle on their back end, their white label offerings, which is they offer digital payment services for other online retailers without it saying PayPal. And that has kind of a lower rate of return than some of its consumer-facing offerings. And for that reason, I would probably put New Holdings fourth and PayPal fifth. I'm curious about your rankings, Neil.
Yeah, so I'll probably put Mercado Libre as number one. I like that business. I think it's one of the best managed businesses out there. And of course, I mean, the returns historically have shown why I'm saying this. Then, I'm saying this at current prices and current valuation. So of course, in the future, things can change. So it's Mercado Libre at number one. Then it's probably going to be, for me, at these prices, it's probably a Google Alphabet, then an Nvidia. Very, very close. And then I'll have to put PayPal above New. I think PayPal, especially at these prices, there is just such a huge disconnect. I have to say I am biased because I own Alphabet, PayPal, and Mercado Libre. But PayPal, like you said, the Braintree solution, which is not the usual PayPal checkout. The Braintree is what's behind all of it. You're not seeing that. That's one where previously has grown quite rapidly, but margin-wise, it was hurting the business, and now it's doing the exact opposite. Now there are slowing revenue growth, but making sure that it is profitable. In the future, of course, you would like revenue growth to continue to accelerate, but at the moment, I think price-wise, valuation-wise, there is such a big disconnect, and that's why I'm putting it fourth above New. Although New, I like it very much. It's also a business that is doing very, very well. So yeah, all five great companies.
Yeah, I see another question here. This came from Rufus Grekus about a minute ago. Do you think Shopify will recover from the current crush, or will it lag behind due to recession and tariff concerns? We know from history, looking back, since Shopify went public, that any time that there is a decline in consumer spending for whatever reason, Shopify is temporarily hurt. Shopify provides the platform that a lot of small and medium-sized businesses use to offer their wares to consumers. It also has Shopify Plus, which is the back-end website for a lot of big name companies, some of which I'm sure you would recognize if I pulled up a list. So we know that if their consumer spending gets hurt, we know there's going to at least be a temporary decline in Shopify's business. Now, I want to make sure that we specify temporary here. because if you go back and look at what happened to Shopify stock over the past 5 years, Shopify was riding high in late 2021 and near an all-time high before we hit the economic downturn. And within probably 6 or 8 months, I would say, Shopify stock essentially lost a good percentage of its value. It went from, let's see if I can find the price here. Looks like Shopify peaked at somewhere above, I'd say 160 or in the neighborhood of $170 a share. And it fell all the way down to below 40. So what you're seeing there is a stock that was crushed. It lost 2/3 of its value. But since then, now the stock has been back up, and it was actually above 125 here just less than a month ago. But now we have economic concerns, and the stock has fallen, and now it's down to about $93, and basically percent off its high just in the last week or so. I would say, yeah, it looks like we're down about 30% since early February. So again, if you're looking for a stock that is going to be around 5 or 10 years from now and doing well, I think Shopify meets those qualifications. But I'm also cognizant of the fact that, there are concerns about consumer spending slowing, particularly if we do end up in a recession. So I think Shopify could lag in the short term, but I think it will do extremely well over the long term based on what we've seen historically. I don't know if you have anything to add to that, Neil.
No, I agree. I don't own Shopify, but it's an excellent business, great management. To be honest, it peaked right after it reported earnings, which I think there was a small miss there. And I was surprised that the stock kept on going up, but the market had momentum, so everything was going up regardless. And so a pullback right now, just like with many of these high-flying stocks, is warranted and makes sense because valuation-wise was not the cheapest one before. Even today, it's not a cheap stock. Although with Shopify, today I rather just focus on free cash flow than earnings at the moment. Free cash flow really shows me where this business is going. So it's an excellent business that operates worldwide. So yes, it's true that recession in the United States, for example, could happen, could hurt the business, but it's also important to know that they operate worldwide, which is probably also why we've seen plenty of companies, not just Shopify, take a hit when it comes to FX, foreign exchange. Because when you report in USD, if the US dollar is quite strong, you're facing some headwinds, which now with the dollar weakening a little bit, it could be a tailwind for many of these companies that gave us some lower than expected guidance because of the expected FX headwinds, which might now turn into tailwinds if the US dollar does weaken even more throughout the years, which I think will play a part in the next coming earnings seasons.
I think those are excellent points. Ed from about 40 minutes ago said, for the rest of the year, will the Magnificent Seven have a better rate of return than a CD? I like the question. I think it shows that you're thinking about, returns of, traditional banking versus traditional returns of the stock market. Anything I say here, I will be making up. So as long as we get that out right at the beginning, generally speaking, the last time I checked, I think the CDs that I was looking at are earning about 3.7% annually. We're already almost 3 months into the year. So, 3.7%, you'll probably pick up a little more than 2 point some percent, 2.25%, 2.5% between now and the end of the year. If you put your money into CDs, we don't know what's going to happen with the stock market. To be honest, And a lot of that depends on what happens with the tariff war, with inflation, with the broader economy, whether or not we slip into a recession. So I would like to reframe that question, which is for the rest of the year, will the Magnificent Seven have a better rate of return than the CD? I have no clue. What I will say is I believe over the next 3 years and the next 5 years, and the next 10 years, I think that many of the stocks in the Magnificent Seven will outperform the rate of return of a CD. Now, right now, there's a lot going on. Yeah, I'm beginning to have my doubts about what's going on with Tesla. I am a Tesla shareholder, and I have been for a long time. But lately, I have become concerned about Elon Musk and his distractions from running Tesla. As I've said before, he has a lot of other businesses. He's got the brain Neuralink business, and he's got the Boring Company business, and he's got the rocket business, and the potential implications of SpaceX and the Boring Company and Neuralink aside, I think Elon already had enough on his plate running multiple companies, and now he is running multiple companies and consulting what seems like full time for the U.S. government. As a shareholder, I don't necessarily like that, regardless of whether I agree or disagree with his politics. But what I disagree with is the fact that he's not running the company that I'm invested in, and the stock has taken a hit because of that. So I'm not too sure about that. The other Magnificent Seven stocks, 6 of the 7, I say, excuse me, I would say that I am confident will not only outperform the broader market, but also outperform the rate of return of CDs or online banks in general. But over the near term, we just don't know. We don't have enough information for that. Neil?
Yeah, I mean, you said it. This year, I don't know. A lot of things can happen, but I rather own a Magnificent Seven for the long run than a CD. I think that would be my answer, short and simple here. There was a question specifically with my name in it, but I'm sure you can add to that as well, from Vihan 26 minutes ago. Neil, see counterintuitive approach you take on your investments. I assume you said he meant Intel, which is ticker symbol INTC, Micron, which is MU, appear more of value play. See Jim G style, outside stocks people chase. So in my eyes, yes, Intel is a value play. I mean, has been a value play for a long time. So maybe it was a value trap. But I do think that a strong Intel with Intel Foundry, because I'm invested in the whole Intel company, so I want an Intel Foundry, should be worth in the future way more than what it is right now. I think it's at $100 billion in market cap, or maybe a little bit less. So yeah, it's a bit of a contrarian pick, I would say. With Micron, I don't see it as any value play or contrarian play. I think Micron is a very important part in the semiconductor industry, focused on memory, more specifically now high bandwidth memory, or HBM, which is being used by the likes of Nvidia. I think there is just previously the likes of Micron, SK Hynix, and Samsung. It is a cyclical business, the memory business. But now with HBM, with the rise of AI and data centers and all of that, I think the cycle will just take way longer than previously expected. Plus, they did say that they have a couple of headwinds for next quarter, which is why next quarter guidance did miss by $1 billion for revenue, which is quite a big miss. But for the long run, their midterm targets are still there, which would make this business way more valuable in the future. And again, in the short run, the markets can go up, can go down, sideways. But in the long run, it will reflect the fundamentals of a good business. And I think Micron is a good business. they're investing for the future. They are making it in the United States as well, which is also an important point here. Same with Intel, which is why I picked those. And there are other names in my portfolio as well that I admit it's a contrarian trade or investment, I would say. But I'm fine with that. I think there are multiple opportunities out there, and sometimes I see a huge disconnect. I just go with it, and it can take longer than previously expected. That's fine. I don't really see it as opportunity cost, because if eventually it does work out, then I don't mind underperforming for a year or so if for the long run I do outperform. So that's basically my answer to this. Do you have any value plays in your portfolio, Danny, or any place where you would say it's a contrarian investment?
I don't think I have any stocks in my portfolio that are purposefully contrarian plays or value plays. I do have some stocks in my portfolio that did not start out to be value plays, that may be value plays now. But those are probably a very small part of my portfolio. I have, probably several dozen stocks that are just a very small, less than 1% of my portfolio that I bought just to monitor. And if they didn't turn out to be what I thought they would be, I probably left them there to languish. And so they may very well be value plays now. But I generally don't invest looking for value plays. I am generally a tech-centric investor. I am a growth investor. I'm looking for stocks that I think have the potential to at least outperform the market, and in many cases vastly outperform the market over the next 3 to 5 years. And since I am at least 5 years from retirement, I'm still looking ahead. I'm still looking for that growth, and which dovetails nicely into Foolist's question from a couple of minutes ago. Sunshine or rain, which 3 stocks would you not hesitate a bit to buy for the next 5 years, in your personal opinion? So we've already talked about a couple of them. And I would say that, I would not hesitate at all to buy Meta Platforms or Alphabet for the next 5 years. Primarily, I think, these are looking cheap right now, but and I think that gives a compelling opportunity to buy them. But I think their businesses, and the fact that each one is an industry leader. Meta Platforms has the world's largest collection of eyeballs. 3 billion people stop off and look at its sites on a daily basis. So that gives you, an unprecedented amount of access to people across the globe. They are also the world's second largest digital advertiser. And they get a lot of cash flow, and they're taking some of that money and they're turning that around, and they are investing it into things that could, in the future, turn out to be very profitable. It didn't work out so well, at least thus far, with the metaverse. It didn't work out thus far with their virtual reality glasses, but now they are working diligently in the AI space. And they have developed one of the world's most widely used large language models with Llama. So I think that this is something that could potentially become a growth driver and a new profit center for Meta Platforms. So I think they certainly are one that I would not hesitate a bit to buy. We've also mentioned, all the reasons why I think Alphabet is, a good opportunity right now, primarily because of their digital advertising business and their, excuse me, their digital advertising business, their search business, their cloud computing business, and they also have a tremendous opportunity with AI, which I don't think investors are giving enough credit to. And I'll throw 2 more out there. The first one is Nvidia. I have stumped Nvidia for a long time. I think that any company that is growing their revenue by 70% in the most recent quarter, they're expected to grow their revenue by 50% this year. I just looked, and it looks like they're expecting to grow their revenue by at least 20% annually over the next 5 years on average. That those numbers are enviable no matter what company you are. And the fact that Nvidia has between 80 and 90% of the data center GPU market share. It has an 80% plus market share of the discrete desktop GPU market for gaming, which has not yet fully recovered. And so, with AI expanding in its use cases, I think there's a lot of opportunity there for, as AI spreads, for more and more users will require NVIDIA's higher end chips. And then finally, we've talked about Mercado Libre before. Mercado Libre in Latin America is one of my favorite longtime holdings. I've owned the stock since 2009. And that actually is an opportunity here for me to stump a little bit for an interview that we're going to do on Thursday at 3 p.m. We're going to have Federico Sandler, who is the former head of investor relations at Mercado Libre and a former investor relations officer for New Holdings. He's going to be joining Jason Hall and I at 3 p.m. Eastern time. So I just wanted to stump a little bit for that interview. If there is anybody that knows the environment and the economics and the stocks that are centric to Latin America, Federico Sandler is certainly that guy. But Mercado Libre, because it is the leading provider of it's the leading provider of e-commerce services. It is the most visited e-commerce website in the region in terms of unique visitors. It is one of the largest providers of digital payment services. And it has a growing user base for its digital wallet, for its credit services, and all of this, it all intertwines nicely. It's more of an ecosystem than an individual service. And so you have people who come for the e-commerce, purchases, and then they stay for the, the digital payments, and they stay for the credit services. And Mercado Libre is also one of Latin America's fastest growing digital advertisers, taking a play from the Amazon playbook by providing digital advertising on their website. So I think Mercado Libre is a company that has a strong track record of growth. I think they have a large opportunity ahead, and tune in on Thursday at 3 p.m. and you can hear it directly from the horse's mouth. What about you, Neil? Do you have 3 stocks that you would not hesitate to buy?
Yeah, first of all, it's great to hear that Fede is coming on. I've known him for a couple of years through X, so that's excellent. Everybody should tune in to learn a bit more about Mercado Libre, Nu, and the region. So that's great. 3 stocks. It's going to be interesting because then the next one we have to answer is only 1 stock for the next 10 years. But for now, 3 stocks. I'd have to steal the Google one, since we'll be talking about Google Alphabet before, so that obviously goes on the list, especially at these prices. I would probably put Amazon in there as well, because I believe Amazon is one of the best businesses on the planet at the moment, whether it's the online shop, whether it's AWS, subscription, advertising, the logistics network that they have. I think it's just an amazing business to own that just gets stronger and stronger every single time. So it's Alphabet, Amazon, and then I would say I would pick AMD at today's prices. I know you said Nvidia. I'm picking AMD because it does seem it is the, let's call it the number two. Nvidia is the number one. AMD is the number two with a wide margin from the number one. But I know there's a lot of focus on the data center side of things, which should be AI revenue and all of that. That was the focus during the last earnings call. We didn't really get a specific number for fiscal year 25 guidance. Last year, that was just above $5 billion, going from close to 0 to 5 billion in 1 year is quite something. But they have the other sides of the business that are doing well. The client side is doing well, and then they expect the gaming side, like you said, gaming was still in a down cycle, but should expect that to turn into some tailwinds in the second half of this year. The embedded side of the business is a high margin business that has also been hit since the peak a year and a half or so ago. And so for AMD, adding $1 billion here, $1 billion there in revenue could be a very big deal. For Nvidia, of course, they generate $40 billion or so a quarter. $1 billion is nice, won't really move the needle that much. For an AMD, I think $1 billion here, $2 billion there, I think moves the needle quite a lot. I think 2025, especially 2026, with the MI400, which should compete with Nvidia's Rubin next year, I think that's a game changer. So those are my three picks. And now already going into the next one, from Cinta 11 minutes ago, to each one of us, if you could lock in one stock for the next 10 years, no selling, no changes, what would it be and why? I would probably pick, of course, one of the three, and that would be an Amazon. I think an Amazon doesn't really matter what happens. This is a business that will continue to do quite well. Even in tough times, I mean, if we are going through maybe a short-term recession or whatnot, people are still going to look at Amazon for good deals. And I think Amazon can offer good deals. It's always been the same thing. You go to Amazon, you save a lot of time, and usually you can save some money as well. Plus, advertising, subscription, third-party seller services are all growing much quicker than the lower margin businesses that they have. And then you have AWS. I mean, it's just a money-making machine. So if I had to pick one for the next 10 years, it would be Amazon, because I could sleep very well at night. So yeah, that's basically my answer, and I'm sticking with it.
Well, since you picked Amazon, and it's a company that I'm fairly bullish on, I won't take that one. And since I've already talked about my love of Mercado Libre, I won't pick that one. Although I think those both qualify from my expectations. I think the one that I will go with may be a surprise, and this is the Trade Desk, ticker TTD. The Trade Desk is a company that I think investors are misunderstanding at this point. They've seen the stock fall by 50%, and that does not equate to what the company's business opportunity is. A lot of the advertising in the world is moving from legacy advertising, which was television advertising, print advertising, billboard advertising, is moving to digital. And digital is the fastest growing segment of advertising. Now, within digital advertising, there is programmatic advertising, and programmatic advertising is the fastest growing segment of digital advertising. And the Trade Desk made its name back more than a decade ago. CEO Jeff Green actually was the very first platform for transacting programmatic advertising. And this was a platform that allowed people to see these ad slots in real time and bid on them. And this bidding platform was actually bought out by Microsoft at the time. Jeff Green went on to found the Trade Desk, and they are now the world's largest provider of programmatic advertising services. And they provide these services not just to individual clients, but primarily to the world's largest advertising agencies. And because it partners with these agencies, that gives them access to a large swath of data. And so they take this data, they feed it all into their sophisticated algorithms. They've been using AI for years to help make these decisions, and they help advertisers get a better return on their investment by helping inform their targeted advertising. Now, the Trade Desk is a stock that has been hit recently because they had a quarter, the first quarter in actually 33 quarters as a public company where they missed their own guidance. And that scared off a lot of people. Fair weather investors headed for the hills. Stocks down 50%. The last time that I saw the Trade Desk stock down this far, I pounced on it and I doubled down on my position, and that has worked out really well. And I think 10 years from now, particularly with the fact that it has expanded into connected TV services, it has expanded into not only streaming video, but streaming audio and podcasts. Streaming connected television is their largest growth area. That's not going anywhere. In fact, it's only going to get bigger from here. So I would say for the next 10 years, I have no plans of selling any of the Trade Desk stock. And that's why.
Yeah, makes total sense. It was one of my picks. I did a video article a couple of days ago, stocks under $100, and the Trade Desk, of course, was listed in there. Like you said, I think one miss in the last 8 years. I mean, I would give them the benefit of the doubt, right?
Absolutely.
There was one question from Robin. Do you think Amazon will ever offer a dividend? Currently, Amazon does not offer a dividend. They don't even buy back shares. And that's why I'm going to answer the way I'm going to answer is, to me, I don't want a dividend. I'll repeat that. I don't want a dividend payout unless you've already buying back shares and you're investing in the business. Paying a dividend for me specifically has to be the last thing you do. So, for example, a Meta, a Google Alphabet, they've been buying back shares quite aggressively, investing quite a lot in the business. Then more in the last, year or so, they started paying a dividend. I would like to see the same thing happen with Amazon eventually. First, buy back a lot of shares, because shares outstanding for Amazon, kept on going up and up and up throughout the years. And me as an investor, tax-wise, it's better for them to buy shares than for me to get a dividend and pay a tax on that dividend. So will they ever offer? I think so. But I'd first want them to buy back shares and then offer a dividend.
I think this brings up an interesting point, and that is, if you look at the Meta platforms and Alphabet, I think these are less capital intensive businesses than Amazon. Now, granted, both of those companies are going to be outfitting a lot of data centers, a lot of server farms, and that's their primary capital expense. With Amazon has that expense, but Amazon also they're building out their warehouses, they're building out their logistics and fulfillment centers, they're building out their cross-docking operations, and they're trying to bring down the speed at which they or decrease the amount of time that it takes to get a package to you for their e-commerce business. And I think that's the reason why Amazon has not bought back shares and why they have not paid a dividend, because they are spending a lot of money to improve the speed of their deliveries. They're expanding their logistics, fulfillment. And so I think it's going to be a while before Amazon offers a dividend, and I think Neil's right. I don't think it's going to be anytime soon, and I think the reason why is because Amazon still sees opportunity in expanding its business and investing heavily in its delivery operations before before the company even thinks about offering a dividend. That's just my 2 cents on the matter.
do you think, so prediction time, do you think they'll announce a buyback this fiscal year?
No, I don't think so. Because when if you listen to the earnings call, I think it was only a couple of quarters ago that Andy Jassy said, that they are focusing on expanding their same day and next day offerings for delivery purposes. The company is also investing heavily in AI. So I think as long as it sees opportunity to invest in its business and grow their revenue and grow their profits from those investments, I think they will continue to do that. If I had to just maybe take a wild guess, I would say probably 5 years from now. So check back in 5 years and see if I'm right.
Yeah, we shall definitely do that. I mean, no, you're right. I think capex for this year is closer to $100 billion, so makes sense. You said 5. I'd say 3 years. Next 3 years, I think they'll start buying back shares.
Fair enough. So I did want to address a couple of questions in here. There are some stocks in here that I don't really cover at all, that I don't know anything about. So I just want to say that, I'm not ignoring these questions. I think it's probably better if I leave them here for people who are better qualified to answer them. I don't know anything about ticker NVO. I don't know anything about Texas Pacific Land Trust, not something that I cover. I will say quickly thoughts on Axon. This question came from Ram about 30 minutes ago. I think Axon is one of a number of companies that we have talked about that had a very high valuation. And when you take a high valuation and add in any type of uncertainty, what you get is a falling stock price. And I don't think we yet have an answer, or at least not one that I have seen, on Axon's partnership with, I want to say Flex. I'm not sure that's right. But Axon has had a very public fight going on between its CEO and one of its partners over what one company claims basically unfair business practices. You're not getting, you're not giving as much as you're getting. And as a result of that, Axon basically cut off its partnership with this company. And it's a company that provided digital license plate readers. And I think you add to that the uncertainty in the market right now. I think Axon is going to continue to fall. That said, I think Axon has a very sticky business. This is a company that provides not only tasers to law enforcement, but they provide body cameras. They provide cloud computing services for, these very private, police, films from these body cameras. And I don't think that just because they have a public, kind of saber rattling going on with one of their partners, that's going to stop really any of the law enforcement agencies that use them from continuing to do business with them. So I think Axon is a pretty good opportunity, although the stock is still a little bit pricey. But they have a premium for a reason. And Neil, it looks like we are at the top of the hour already. That seems to go by relatively quickly. And I think that what a good show this was, and what great questions that we got. And now we're going to turn this over to Toby and Will Healy, who will be joining us to talk about some consumer and travel. What's up, guys?
Hey, Danny. Hey, Neil. Thanks, guys.
Hey, guys.
Yeah, indeed. We're going to take it forward now. Move on to the next hour. We are talking about consumer and travel. That's our theme. We'll get your questions on any of any companies in that area or themes in that area that you want to ask us about, and we'll continue to hit the questions that you've been asking already. So just keep them coming, and we're gonna keep the show moving right along. How are you today, Will?
I'm doing great. How are you?
I'm good too. I'm going to hit this question right at the top from Reed Rusniak, which is not a consumer travel company. Well, I guess it could be a consumer company, but we're going to hit it anyway because we talked about it yesterday. So I have some thoughts on this. Reed says, "I'm sorry if this has already been covered. Is it wise to hold NVO, Novo Nordisk?" Thanks. Yeah, Novo is still a recommendation on the Stock Advisor scorecard. We continue to believe in it. The company got hit with a 9% drop yesterday as they announced results from a recent trial that was kind of using their existing weight loss drug in combination with another, and they were looking to see if there were any benefits, any additional benefits using that combination. The trial was a little bit different than the prior one, so it's not exactly an apples to apples comparison, but nevertheless, the data seemed to be a little bit disappointing. The stock sold off a bit. Long term, I think this is going to be fine. Brian O'Reilly and I talked about. We actually did a deep dive yesterday on Novo Nordisk. If you guys want to go back and look at the replay on that one, if you missed it. But the gist of this is over maybe a medium-term time frame, this matters, but immediately there's not going to be a big impact. Long-term, it probably doesn't matter. Essentially, what you've got here is they were looking to try to get efficacy to show the efficacy with this combination they were using was closer to what Eli Lilly had in their weight loss drugs, and trying to close the gap between the two companies there, and they failed to do that, right? So all this really means, bottom line, is that Eli Lilly is still the leader in terms of overall efficacy of this particular, the weight loss drug on the market there. And so you're probably not going to see over the medium term any revenue gains for Novo Nordisk vis-a-vis Eli Lilly, right? So that gap is still there. It doesn't mean they're going to lose revenue. The existing drug still works quite fine. This trial has nothing to do with that. And looking forward, we're all looking for the oral formulations, because hey, taking a pill is better than getting a shot, right? So once that starts to happen, this is probably irrelevant because this is going to be not the preferred treatment for a lot of people, right? So I would not be super concerned about that. I think the thesis long-term is still very much on track. You're looking, really one thing you're looking for Novo Nordisk here is to see how their pipeline continues to go. Looking for they have multiple stuff in various trials. Again, at that deep dive, you can go look at that. And when Brian goes through that, part of the thesis is one or more of those becomes a market success and helps diversify to some extent away from the weight loss drugs we're seeing right now. But still a good company, still a solid company. We like what we see, and I would have no qualms about continuing to hold it right now. So thanks for the question, Reed.
Okay, so this is the consumer and travel show, and we listed DKS, Dick's Sporting Goods, and Airbnb, symbol ABNB. Dick's reported this morning, so I wanted to put up the slide and go into it briefly. So looking at the slide, yes, here it is. The company beat on both. On both net sales and earnings per share. It was, as you can see, though, the growth was fairly anemic, unfortunately. So, but there were some bright spots, I think, despite the issues. 6.4% Q4 comparable sales growth, which is excellent, especially for a company as mature as Dick's Sporting Goods. They did increase the dividend by 10%. It's now going to be $4.85 a year. That takes it to 2.4%. That's going to be roughly double the S&P 500 average. So if you're looking for an income stock, this one might be one to consider because they do raise their dividend every year. They are generating more than enough cash flow to keep paying the dividend. So I see that as safe. The company's also going to repurchase $3 billion worth of shares. They are switching their stores up a bit. They're closing some of their more generalized sporting goods stores, and they're opening more of these concept stores like the House of Sport and the Field House location. So on balance, they add one store, though they did close about 23 of the regular Dick's Sporting Goods stores. So overall counts now 856 in 47 states. This is also a very cheap stock because, PE ratio about 14. It's actually a little bit more expensive. It's been, at 12 for 3-year average. But if you look at the stock performance, it's beaten the market most of the year. I think after the 6% downdraft this morning, it's a little bit behind. But I think if you're looking for a solid income stock, this one looks like a good one. Obviously, it's in 47 states. It's a retailer. It's a brick and mortar retailer even. So I don't expect any massive growth. But if you're looking for a stock for income, I think this is one to consider.
Yeah. Yeah, I mean, it's we know what this is. It's your big sporting retailer, right? A lot of I feel like steady. I feel like reasonable growth. Not going to knock anyone's socks off anytime soon. Will you shouldn't expect that, but it does look fairly solid. You didn't get a chance to listen to the conference call, did you?
I did not.
Okay. I'm just wondering if there was any mention of Nike at all, because I know Nike's had their struggles and trying to restore some relationships with some retail partners there. Just kind of curious about that, but maybe I'll look back at the transcript and see what we can see there. So, all right. So let's hit a couple of these questions. We can talk about this one from Sadaf here. Booking versus Airbnb versus Expedia Group. That's fascinating, Will. Let me share my screen on this one too. As we're discussing these companies, let's set the stage here. So I'm going to bring this up so you guys can see what the relative performance has been over the past 5 years, and you see Booking has been where it's at over the last 5 years. Airbnb has not, and you can go through pretty much any period you want. Look at the last 3 years. Again, Booking is getting it done. Look at the last year, and you see, Expedia not bad over the past year. Airbnb is still lagging. Now, interestingly, of the three, I am most optimistic about Airbnb's future, stock charts notwithstanding. I think a lot of what we're seeing on the stock charts, especially that 5-year chart, is a reflection of Airbnb's valuation at IPO. The day, when trading came out there, a lot of optimism around the company. The business has been doing really, really well in terms of growth, in terms of cash flow, just expanding what they've got. So I like what I see from the business that is not showing up yet in terms of investor returns. But I remain optimistic about the future there for them. I worry that Booking is a little bit broader in terms of their reach right now. Airbnb has said they're trying to add things and expand their platform, so we'll see if they can grow into that type of thing. Booking seems a little more susceptible to a consumer spending pullback in travel, I think, Will, because Airbnb is so focused on on lodging.
Mm-hmm.
There are obviously ways you can do vacations and travel by cutting back on some things, reducing your spend, but you still need a place to stay if you are actually traveling, right? That's kind of inherent in the definition of the word, right? So if people do more driving vacations, if they do shorter vacations, if they stay closer to home, if they don't go overseas, right? They pull back maybe on a cruise type of thing. All of that could impact Airbnb and Expedia, or I mean, rather Booking and Expedia. But Airbnb, given their bigger presence relative presence in the lodging space, may not see as much of a pullback. I don't know that for sure, right? You may see people pull back from Airbnb. Maybe we're going to start staying with friends more. But the platform does provide even low-cost options. Like you could stay in rooms, and people, they do that. They still do that, right? Rent a room in someone's house, right? Stay with someone. So they look like they might be positioned to kind of withstand a downturn in consumer travel spending, depending on what that looks like. If people fly less, it's going to hit Booking, it's going to hit Expedia, even if they're still staying at hotels, even if they're still staying in houses, right? Expedia has they own VRBO, I believe.
Yeah, that's correct.
So they have an aspect of that
They
too.
were actually the
but
first one in that business too. But
Yeah,
Airbnb
right.
kind of, I think had the better business concept and pulled ahead in that industry.
Right, I think that's right. So that's one reason I like them. If you're looking for the one that may be more resilient heading into a turn down in travel, of the three, that one Airbnb looks to me to be better positioned. They'll still get hurt for sure, right? But I can certainly see a world where people are still taking vacations. They're just lower key, less further afield.
Yeah.
And so more of your dollar on that vacation spend ends up going towards lodging, since you're not flying, right? So you're not traveling a longer distance potentially. We don't know what that's going to look like, but that is one thing potentially to think about. I like what they've done with the business. I like the management team. I'm optimistic. So perhaps I like that one a little bit better. Second choice, I think for me, Will, I'll see what you think, but I think I would go with Booking on the list. Expedia just seems in some ways to be kind of like a mismatch without as much of a clear direction and focus. That's just my impression when I look at it.
I agree. I mean, it is the lowest PE ratio of the three, so maybe it has a slight advantage there, but it's never executed as well as Booking or as Airbnb. And by the way, Booking Holdings is the former Priceline.
Yeah.
A lot of people see that sticker. We talk about Booking Holdings. They don't know what it is, but it is a former Priceline. So if that helps you recognize it, it's probably nowadays it's Priceline and a bunch of other businesses, including Booking, which is what Booking.com, which is what they ultimately named the business after. Which I personally thought Priceline was a much more recognizable name, but
although Booking was more recognizable in Europe. Right.
Yeah. Well,
so
maybe
I think that was kind of what they were maybe leaning towards. But the Americans will know of those brands that they own. Americans will know Priceline, I think, more. Americans of a certain age, I should say. From back in the heyday of Priceline, made William Shatner rich. Will.
Well, it would have made me rich if I'd kept those shares. I'd bought it.
That's fair. That's fair. Probably would have. What do we think? And so thank you for that question, Sadaf. Similar, Rufus asked, what do we think about Airbnb in the context of a probable recession? I think we just went through that. And I of many of the travel companies, Rufus, I like where they're positioned for the reason we just talked about. I think they're less susceptible to the more higher end pullbacks or the more pricier parts of travel, mainly air travel for a lot of people. And you're more perhaps luxury vacations. I could see Airbnb kind of, I don't want to say they're not going to suffer, because you can't not. If there's a pullback in consumer spending on travel, every travel company will get hit to some extent. I think they'll see less of a hit, is my guess, the way I'm looking this right now. So maybe it's a go into own, but if you're really, really concerned we're going to see a major pullback soon, a reasonable person could look at these travel companies and say, let me see what next quarter looks like before I buy any of them, right? I think that could be maybe what some people are thinking. To that point, did you see Delta's report yesterday?
No, I did not get to that, unfortunately.
Yeah, I didn't look at the report in detail, but the CEO did make, or no, it wasn't an earnings report. It was not an earnings report. It was CEO comments, right? Who came out and said they basically pulled back their guidance for the quarter, saying we see weakness in travel and it's going to look a little bit worse than we thought. I keep thinking it's an earnings report because we're in earnings season, but not quite. For this coming quarter, they're saying we're seeing weakness in travel, and so it might look a little worse. Stock went down, sure. So did a lot of other airlines. We had a question on Full Live. Someone asked me, why is you not an airline stock down? I have no idea. And then I saw that, oh, well, there's why. it's unlikely that one airline is going to see the brunt of all this weakness and everyone else is going to be jumping for joy about all the business they're getting, right? It's going to be an industry-wide impact, probably. You would expect to see that. So in that light, Will, if you're seeing, let's take them at their word, right? Let's take the airline execs at their word here, that, because why would you say that if it's not true, right? But that's and assume that what they're saying persists, I guess I should say, right? That we will in fact see weakness, and the Q1 reports are not going to be what we thought they were going to be a month ago. Like, it will be lower than we expected. Does that bleed into the rest of the travel industry? Is this the beginning of is this the beginning of our eventual inevitable pullback in travel that of course happened because it's cyclical? Or could you see a scenario where maybe it's just the airlines? Maybe we're still going to go on cruises, although many people fly to their cruises, so I have a hard time seeing that. But maybe we'll still go on cruises. Maybe we're still going to take big trips to national parks. Maybe it's going to be spending willy-nilly and not a problem. It's just that we're not flying. I find that unlikely, but I'm not quite sure how pervasive and how significant the pullback might be in this coming quarter. Any guesses from you, or how are you looking at this?
It could be that we fly less. I don't think people are going to stop vacationing per se, but they might vacation closer to home. They might take a road trip instead of flying across the country or overseas, for example. It could also affect the cruise lines too. If in that,
yeah.
I mean, I live not within a half day's drive of Galveston, so I can still go on a cruise. People like that might still go on cruises, but it'll be cruises closer to home probably. So I think they would just go closer to home, which wouldn't necessarily affect an Airbnb, for example, but could affect an airline, could affect a cruise line, and so on and so forth.
Yeah, and consider this too, right? Like, this is the weak season for cruising this quarter. You just see less of it after the Christmas holidays and before the summer holiday. It's a weak season for travel in general. We're barely starting to get into spring break here, right? So it's just not a super big travel season, at least for Americans. And when you go on a trip, isn't your flight tends to be one of the last things you book, right? Especially if you're going on a cruise or something that requires like a more extensive vacation. For some people, that tends to, come later, right? For them. But it's a time of the year when I think a lot of people don't necessarily have vacation plans anyway, and so you have nothing else picking up the slack. Maybe less business travel happening too is part of what they're seeing. Less random trips, right? Like, I wake up tomorrow and decide, hey, next weekend's a great time to go to Vegas, right? Less of that happening right now. But a lot of people still have their summer vacations booked, and we were talking not too long ago, hearing from the travel execs saying bookings for the summer are really heavy. The cruise industry saying bookings are looking really great for 2025, right? Airbnb saying we're seeing bookings out in the summer that are looking strong, right? Hotels kind of saying that. So we could be in a scenario where what we're seeing is a temporary pullback in travel, especially air travel, for any host of reasons, but economic concerns being front and center of that. And less of spur of the moment, less of the last minute travel. Just not seeing that happening right now. But we would see a pickup in airline travel come this summer when all those prepaid trips need to be taken, or all those pre-planned trips. People are just going to take them anyway.
Yeah.
Could you see some cancellations? Sure. But if you've already got it booked, you're probably going to do it, right? Even if you don't even have your flight booked, you might find a way to get there. Though if the economic concerns persist into the summer, we'll see what the holiday season looks like, right? And next year's bookings. But we could be in a situation where we're going to do this for airlines, at least for the first half of this year. So I guess that's a long way of saying, well, I'm not sure I would use what the airlines are saying about this current quarter, which is historically lower on leisure travel anyway, and make too much of a guess as to what the summer and the rest of the year brings. It's a data point, and maybe it makes us a little cautious, but it's just one. And I think we already know, or we have a good idea of what they're going to say on their earnings report, which is not great, because at least Delta is telegraphing that going to be worse than we expected. We're seeing weakness. What we don't know yet is what they're going to say with respect to Q2 guidance at the end of that report, and I think that's going to be really important. And in Q3, really getting into the end of the summer there, of what they're going to say. So it's still really, really important to look at this and get a sense of whether, we'll see this in the Q1 reports. Is it just a 1 quarter temporary blip, or are they really seeing sustained weakness for the rest of the year? And what does that mean for the rest of the travel industry if that's the case? So something to look forward to, guys. Depending on how you think what looking forward to means.
So since you're on the airlines, I wanted to take this question from Foolist.
Yeah.
Southwest, symbol LUV, is up today, defying general industry downtrend after announcing changes in baggage and fare policy. Do you anticipate any upside for Southwest from here? Well, in case you haven't heard, Southwest is no longer giving its passengers 2 free bags anymore. You're just like every other line. Just like every other airline, you're going to have to pay a little bit extra to take your bags along on Southwest. I think that's good for their financials. I'm not sure it's good for their. It's not good for, maybe not good for their customer reputation, because Southwest is always one that stood out a bit, and but the company's had some troubles, over the years, and I think they're kind of responding to those troubles by being like other airlines. So this is just the latest step in that. So yeah, I think it's a boost to the financials, but it may hurt its reputation among customers a bit. I don't know if it's going to hurt enough that they stop flying on Southwest, but
right, because what are you going to go?
Yeah,
right. If your problem is I want to pay for a check bag, well, I don't know that you have another alternative, because everyone else charges for bags too, right?
Yes.
Now, they're probably going to change their credit card, right? Like I would expect maybe them to because I think they only have, maybe they have 1 or 2, but they have a lower annual fee than the other ones, top level cards do. 2 reasons for that, right? 1, because they don't have club lounges, so you can't have your high end club lounge card. 2, bags are free anyway, so that's not a perk you can kind of charge for, as it were, with a higher annual fee. You can now.
Yeah.
You can throw out a credit card with like a $200 or $300 annual fee that gets you free bags. So might we see that coming soon? I haven't heard that they're going to change that up, but it would shock me if they don't. Like if they don't work that in somehow.
Sure.
To that. The other thing, I look at them. From what I understand, based on the announcement that I saw, tickets booked before May 28th still get the free bags, right? So May 28th is kind of your cutoff date. So fools, if you're taking a summer vacation, you want to fly Southwest, book your ticket before May 28th, right? And I suspect a lot of other people looking at that are going to, well, am I going to book my tickets in May or June for my July 4th vacation? I better do it in May and get the free bag, right? So will we see some revenue pull forward from Q3 to Q2? We actually might in their case. I don't know how significant that's going to be, but it would not surprise me if that May 28th date does actually influence consumer purchasing behavior in terms of Southwest travel. Like if you already know you're traveling on Southwest, why not buy your ticket early and get that perk, right? Yeah. Let's talk about BJ and Costco. We talked about that before, but we can hit this again, from Kent?
Yes.
Yeah, Kent says, please share your perspectives on BJ's versus Costco during the current market turbulence. Safe and conservative picks.
I would say yes with BJ's. I don't Costco. It's probably a conservative pick, but it's still a very expensive stock. So, long story short, I prefer BJ's over Costco. We were like Toby said, we were talking a little bit about this in a previous show, but BJ's. For those of you who don't know what it is, it's also a warehouse club. Directly competes with Costco. And even though it's as old as Costco, they were founded within a year of each other. BJ's has been primarily on the East Coast. The company struggled for years. However, during the pandemic, its groceries were a big draw for customers, such a draw that their revenue increased massively. They were able to pay down their debt, and that gave them some capital by which they could expand. So they went into Alabama, Tennessee, Ohio, Michigan, getting away from the East Coast. Now they're going to go as far west as Texas by next year. So you really see a pattern where it's going from regional to national. So I like BJ's for that reason. I still like Costco too, at least from a business perspective. Although Costco is more of an international company now, they continue to grow pretty consistently. They've recently raised their membership costs. That didn't seem to affect really change the value proposition of the stock. They have no trouble expanding internationally either, so that's a huge boon for them. My concern with Costco, like I said, is the PE ratio. If I look at the PE of Costco, even though that took a big hit yesterday, we're still looking at 54 times earnings for Costco. Compared to BJ's Wholesale, it's 29, and 29 is higher than it has been. But compared to Costco, that's cheap. And like I said, regional to national growth stories usually are good for shareholders. So I think BJ's is going to be good for years to come.
Yeah. I think BJ has more upside in terms of percentage growth from here.
Yeah.
Well, not necessarily in the stock, in terms of the store, like the growth of the business itself, like at least over the medium term. I think that's clear. They're just so much smaller than Costco. I also think that execution is far more important for BJ's than Costco, right? Like just because you have more potential in front of you doesn't mean you can realize it, right? So BJ strikes me a little more of a higher risk, higher reward play versus Costco right now. It intrigues me. It really does. I think Costco is the safer pick, despite the valuation, because of that execution risk there. But it is a high value. I think in a consumer downturn, I think that you'll see that valuation probably persist as people start shopping more and more there. But that valuation is a potential concern when you look at Costco. Now let's stick to that valuation question, or that valuation idea, Will, and address Sadaf's question here. Walmart versus Costco. What do you like better at current pricing? Both of these you have mentioned before in recent past with me, where you say we thought the valuations might look a little rich. So I want to force you between two potentially richly valued companies. Is there one you like better than the other?
Probably at these levels, I like Walmart a little bit better.
Right.
Walmart's. I don't judge completely by the PE ratio, but the PE on Walmart right now is we're down to 36 on the PE for Walmart. I think Walmart's been executing a lot better lately, especially with their omni-channel, getting international. They traditionally they failed internationally, but they're starting to see some success, particularly in India and particularly on the e-commerce side. So I'm liking Walmart better for those reasons, even though it is pretty much saturated in the U.S. Unlike Costco, which actually, believe it or not, still has some opportunities for significant domestic growth, despite being in almost every state now. But yeah, due to valuation, I'd probably give the edge to Walmart.
All right. Cool. I would probably lean Walmart too, in terms of which one I think is going to grow more over the next 5 years. I'd probably lean Walmart, between Walmart and Costco. Walmart has it's in my opinion, a better e-commerce strategy in terms of what they've done with it. They've just done a better job with that, for sure. Better integration between e-commerce and the physical retail channel. They have Sam's Club too, so they are competing directly against Costco in that business model. Although I prefer Costco to Sam's Club in terms of a shopping experience.
Yeah,
and it's not even really close. But it is there, right? They are competing in that space. So many questions, Will. Let me let you pick one if you want to focus
Yeah,
on
I'm
right
gonna
now.
tackle Vihan's question from 13 minutes ago.
All right.
Stocks like Target with dividend. If you max out the retirement account, are you comfortable building a position in tax account? Can you share your insights? Reach dividends and tax account. Let's actually that's a few different questions. But Target. I basically like for valuation reasons. I think of these major retailers we've mentioned today, Target is probably in the worst shape out of all of them because they don't really have any room to grow. They're relatively more upscale compared to Walmart, and I think that's made them a little bit more vulnerable to economic conditions. And their same store sales they're not really falling, but they're not really growing either. One thing I will say about Target, though, the PE ratio I think is 12 or 13, something like that. So you have to assume a lot of these troubles are already priced into the stock, and moreover, the dividend yield is approaching 4%. It's raised its dividend every year for more than 50 years now. I don't see that changing anytime soon. So I think that Target's an excellent choice for an income investor if you feel like taking the risk that it's not performing quite as well as a Walmart or at Costco. As for whether to deploy capital in tax accounts or yeah. Well, I guess let me see what the question says. Insights, REITs, dividends, and tax account. Well, first of all, if you know you're not going to need the money before age 59 and a half, I recommend putting as much as possible into your Roth and traditional IRAs or your 401ks because you're going to get all that growth tax free while it's in the account. So, but I understand some of this money you want for other purposes. You want earlier than 59 and a half, or you're doing so well that you've maxed out all those other accounts. You're going to have to turn to the taxable account. But as long as you can put it in a tax deferred account, I would definitely do that. REITs can also be a good choice for such accounts. They tend to pay a little bit higher dividends than traditional stocks, and unlike traditional stocks that can cancel their dividends at their leisure, a REIT is obligated to give at least 90% of its net income away in the form of dividends if it wants to keep its operations on a tax-free status. So even if a REIT struggles, unless their private profits are wiped out completely, you're probably going to get some kind of income from a REIT. So excuse me. So that's the advantage there.
Nice. Root versus Lemonade. Do you follow either of these? Will?
I had followed Lemonade a little bit. I haven't looked at it lately, and I don't know Root.
Yeah, I have. I can give you thoughts on Lemonade, Ed. I don't know Root enough to really give a good comparison there. Lemonade has been doing better. The last report was actually really good, all things considered. Loss ratio is trending downward for Lemonade. We really like that. They continue to grow the customer base. They continue to grow premiums per customer. Premiums in force keep going up. I really do like that they seem to have gotten to a point where it seems that loss ratio is about where you want it to be, has come down steadily. In the last quarter, it was lowest it's ever been in company history, 63%. And I believe the trailing 12 months gross loss ratio was like 72% or something, I want to say.
Yeah, it was pretty low.
It was low. So they are doing a much better job from an underwriting standpoint. Will that persist? Who knows? They talked a little bit about California fires too. There would be some impact from that. We'll see more in the next quarter. But they are in a much better place than they were before. So I'm optimistic about them going forward. I own shares. I'm still holding them. Now I'm still skeptical. Like if you ask me what is my favorite insurance company right now, kind of the consumer type insurance company, I'd probably lean more towards Progressive, honestly. They're doing a lot with data too, and they are bigger than Lemonade. They have more scale. They've been doing auto insurance a lot longer. So I like them a little bit more. But Lemonade is certainly getting there. And I guess one thing, what you could say, right, is Lemonade looks at Progressive and says this is kind of what we want to be when we grow up, right, as it were. So I'd probably lean that one more, but making progress, and it's good to see. I like when companies continue to improve. So there you go.
I'm going to take this one from Ed quickly because
Yeah.
we were just talking about Target. Ed had really a comment. Until the talk of a recession subsides, Target can keep going down $1 off its 52-week low. That is true. I'm not going to by any means pick a bottom in Target, despite being 12 or 13 times earnings. It still can fall further. I just think retailers rarely, at least top retailers, rarely fall to such levels. So I really think we are toward the bottom on Target, but we'll see. It certainly can fall further.
Yeah. You want to talk about Disney? Do you have any thoughts on Disney?
Yeah, Disney. I don't know. I think it's a little expensive for what it is personally. I love the experiences and vacation side of the business. I think their theme parks and cruises, that part of the business is firing on all cylinders. The other part of it, the other major part of it anyway, Disney Plus. I don't know. I'm not really a fan of the streaming business in general. I think other than
gotcha.
Netflix, no one else has really succeeded with this. I unfortunately, I think despite Disney arguably having the best content, they seem to be struggling with their streaming business. I don't see that changing anytime soon.
See, I'm kind of the opposite of you. I'm optimistic on the streaming business, particularly with the acquisition of Fubo and kind of merging. Well, so that's less than it is streaming, but Fubo is being merged into Hulu essentially, which looks more like going forward it's going to be kind of an over-the-top TV streaming service, more akin to YouTube TV. Is how that looks like it will develop, and we don't know for sure. With a sports focus, right? As Fubo did. You combine that with ESPN, which should go over the top this year. That's the indications that they're telling us. Disney looks compelling to me on a streaming basis. Now it's expensive. There's a lot of CapEx involved in there, especially with the sports rights. Those are not cheap. But I'm optimistic about where I see them going. They're profitable. Can they continue to be so? Keep an eye on that. I do love the parks business, Will. I worry with that we're getting a little bit close to the point where they've hit their limits in terms of price increases.
Yeah, that's fair.
Right. I don't think consumers are going to stomach much more of that. And you're seeing executives talk about that, saying, well, we got to be a little careful here. I don't know how much more we can go. Right. Now that said, they keep offering things like a more expensive version of Lightning Lane that people seem to buy in droves. So for now it's there, but if we do see a big turn down in the economy that impacts travel spending, right? It's really easy to not go to Disney World, right? I mean, it's expensive. Like you can do something else, right? You can not have that trip this year, right? It's also easy to say skipping the line is nice, but I can stand in line if it saves me a couple $100 a person. That's easy too, right? Maybe the kids complain, but whatever. If fewer people are at the parks because fewer people are spending money, maybe that's a nice trade-off, right? It's also easier to go for 3 days and not 7, right? Like you can see a pullback there in those park spending. At the same time, CapEx is significant for that, and you can't do too much in terms of reducing your CapEx spending if you're Disney, because you got to keep people coming back, right? Mm-hmm. You got to keep people coming with the next hot ride. What you want is a ride in a park that's going to make people want to show up when it opens to get that Lightning Lane purchase, because they have to ride it. Like Guardians of the Galaxy at Epcot right now, right? Like you need that hype, you need that hot thing, and you need to keep your existing rides from breaking down, right? No one likes to wait in line for an hour for Space Mountain and then have it break down and not be able to ride it, right? So there's a lot of CapEx involved in these parks. And if they were to see even a temporary revenue decline, you could see that swing to a loss temporarily in any given quarter, because you can't just stop your CapEx spending, right? There is a minimum level of maintenance that you have to maintain for those. But I do like the business. It is probably the most diversified consumer entertainment company out there right now in terms of getting both your in-home video entertainment and your high-end travel dollar entertainment. I don't think anyone else offers quite that same combo that Disney does there.
Yeah, with Disney, Disney, they don't build a third theme park in the U.S. because I think the fact that they can get these prices tells me that demand is
right.
So it may be time to add a third or maybe even a fourth theme park in the United States, in my opinion.
Well, you don't want to dilute the brand too much, right?
Yeah.
Like you don't want to become a Six Flags, but could the Midwest stand a Disney park? Probably.
Yeah.
Or something, right? Texas or
like Texas, Chicago, KC, maybe,
right?
Or maybe Toronto also.
Somewhere along the line.
Yeah.
Do the Canadians like Disney? Do they like Mickey Mouse? Would they go to a Toronto?
As
I don't know.
I know they do. I'm not Canadian.
Yeah, I don't know. But
they tend to have our same consumer taste though. So
yeah, right. Certainly something that they could think about. Maybe we'll see that. There are rumors of a park in Australia, right? I know they have land out there, but I don't think they've announced anything.
Yeah,
officially in terms of that. You might see a park there if you're looking for expansion, because you do see Disney cruises are pretty big out in Australia when they take their ships out there for the Australian summer season, essentially our winter. Which is handy for them, right? Because there's less cruising in the Caribbean during that time of year when all the kids are in school. So they send a ship or two out to Australia to do some cruising. That seems fairly popular. So it could dovetail nicely with a park there. Who knows what we'll see. Ed says Disney could turn around maybe a 5-year return -6%, while the S&P rose 102%. Yeah, Disney, recently they've done well. Over the longer term in the past, they have struggled. They seem to have gained momentum, though, and we do hope that continues. Now, I want to say with Disney, the big red flag right there is we don't know who's going to be CEO yet after Iger. So you do want to see something there. And you obviously want it to go better than it did last time around, because that was a failure of leadership transition. That was a board failure on Disney's part that last time. So hopefully they get it right this time.
Let's see. Investing Cat asked an hour ago, what stock would you add to the Magnificent Seven to turn it into the Hateful Eight? I don't know whether that Hateful Eight name would take off, but I would incline toward Netflix. One, because we're doing the consumer show, but also they were in the FANG index years ago. They had some troubles, but they seem to have really recovered. Like I said, this is probably the one stock in streaming that I think is actually doing well. So I would probably incline toward Netflix in that case.
Yeah. That's interesting. Bring back FANG, huh? What were the former FANGs? Facebook?
It was Facebook, Apple,
Amazon. Oh, Facebook, Amazon, Apple,
Netflix, and Google.
And now several of those have changed their names, so that doesn't work anymore. So Netflix is the only one of those that's not in that Magnificent Seven now. So that's a good choice. What would I add to it? I want to say Broadcom, but they have to hit $1 trillion first, I think.
Yeah, or consistent.
Is that like a rule?
They hit it, but they didn't sustain it.
They didn't sustain it, right? What is Netflix market cap?
I don't think it is a little bit lower than those, I think.
Oh, it's like 300. It's 400 billion. Will they're not even like, we're not even playing the same ballpark here.
Well, yeah, maybe.
But no, I like your suggestion. But and in fairness, Tesla is no longer a $1 trillion company either. Magnificent Seven. But actually, that makes me think more about Netflix, because just on a market cap basis, maybe you like that for the potential to get larger, right? Is it more likely for Netflix to double or for Microsoft to double over the next 5 years?
At this point, I have to pick Netflix, because Microsoft is what, $3.5 trillion now. That would take $7 trillion, and we haven't even had a $4 trillion company yet.
Yeah.
So
yeah.
The law of large numbers is starting to take its effect on it.
Yeah. Thanks for the question, Investing Cat. I like it. What else we want to look at here? Do you follow Square?
I used to a lot, not quite so much now, but a little bit.
Kalpana asks, is Block, formerly Square, worth buying for long term, given it has fallen quite a bit? Well, Will's less interested in it now, it seems, and that says something. Me too, right? I used to follow it more closely, and I don't anymore. I think that says something, right? That you kind of have, both of us have backed off a little bit from our interest in the company.
I still look a little bit. Oh, go ahead.
No, go for it.
Basically, I loved Square. I don't feel that same way about Block. It's like once Jack Dorsey decided to devote all his attention full time to the company, they seem to do all these weird things like adding a streaming service and the Bitcoin thing. A little controversial, but I can see that maybe working. But the fintech space in general, especially in the U.S., has just become hyper competitive too. So it seems like there's less opportunity for growth in there. Like I've been telling investors in other shows, I've been focusing on international fintech more lately than fintechs that are based in the U.S.
Yeah, I kind of feel the same way. It seems like their diversification, I don't know that it has been useful for them.
Yeah.
Especially the title acquisition. And even in the United States, I think I like PayPal with Venmo better than Square. I like Toast better than Block in terms of fintech right now. So there's a lot of companies you can think of that you might prefer to what Block is trying to do right now. And what's the one, and all of the, like, your international players like C Limited and Mercado Libre are getting into fintech. A big way, all have payment mechanisms.
And there's more opportunity there too, because a lot of hundreds of millions of people in those countries still use cash only and don't really have direct access to the financial system. So getting them into the financial system, I think, represents a huge opportunity, more than just adding another payment method to how Americans can spend money.
And you've got the banks fighting back with Zelle. So some people use that. You've got Apple Pay and Google Pay. In some cases, make the straight up payment apps a little less necessary, right? Because now it's just easier for anyone to do that. I think there's even American Express even has a payment transfer aspect on their platform. There's just a lot more competition in the space.
You talk about personal experiences too. When I saw that I kept using Apple Pay, that kind of made me less optimistic about all the others. I don't know what Apple Pay is doing for Apple financially. I don't think it's really moving the needle compared to their other products. But the fact that Apple can just add this little app that we don't even know what it does financially, it seems to take away the need for these others. That doesn't warm my heart towards these other American fintechs.
Yeah. All right. Let's look what else we got down here. I'm scrolling down quickly, Will, to see if I see anything that happens to be travel related that we could hit real quickly.
Well, Ed had a question from a minute ago about Disney again. So,
okay, what
Disney pays a 1% dividend. Why don't they increase the dividend so income investors would look at it if the capital expenditures they have? Disney had dividend up until the pandemic, and because of what happened there, because their theme parks and cruises basically had to shut down. That took out the dividend. I think they've started to build it back up, but it may take some time to get it back to where it was. I actually haven't looked at their dividend history in a while. Have you followed their dividend, Toby?
Not a lot. I mean, I like that it's there, right? They had it and they took it away and it came back. I honestly don't know that I would expect to see that increase too much over the near term, given the CapEx requirements. I think, right? For both the theme parks and for the massive investments they're doing in that streaming business, right? So honestly, I would prefer them to spend as much as they can on reinvestment right now to kind of get all of that in a good place. But yeah, it's nice that they do pay it, and I think the reinstatement was more of a signal, less of an intent to return capital to shareholders in a big way, and more of a signal that said, "Hey, we're past the pain; we can afford to do this again."
Yeah.
And that was a good signal. I think you'll see them raise it marginally, right?
And looking at the dividend, okay, it was
Yeah.
88 cents quarterly when they canceled it in early 2020. It was reinstated in late 2023 at 30 cents quarterly. It's now up to 50 cents a share. That looks like, according to this anyway, they haven't necessarily paid it every quarter either. There's only 2 dividend payments in 2024. So I guess it's slowly coming back, but yeah, it's not what it was before, certainly.
Mm-hmm.
Well, actually, no. I take that back. They only paid 2 dividends a year beforehand. Also, one payment in July and then one in December. So yeah, I guess they are back to that. But yeah, it's not the level isn't back to where it was. Although 1% is not far below the S&P 500 average of around 1.2 or 1.25%. So it's getting there.
All right, let's address this question from young Tom Morris from 4 hours ago. This was asked addressed to Tim, but I'm going to go ahead and answer the question now. Young Tom Morris said, on high-end travel, did you get a chance to look at Vikings earnings this morning? I haven't dug in too closely yet. They did report this morning, but I have looked at it a little bit. The report actually looked pretty good, Will, all things considered. Revenue up 20.5% year over year, 1.35 billion in revenue for Viking. This is the cruise line, right? Viking Cruises. The river cruises, also some ocean cruising ships now. Smaller ships than most of your other big major cruise lines here. Nice net income, 100 million. They had a net loss last year, so now we're profitable versus being unprofitable. We love that. Earnings per share beat expectations. Occupancy rate 92.1% for the quarter. That's pretty good for this past quarter here. This was their full fiscal year, but for Q4, occupancy rate 92%. Total revenue for the year was up about 13%, 5.33 billion for the year. Now, what about our outlook? So they're saying that for the full 2025 season, so this upcoming year, this calendar year, they have sold 88% of capacity, right? So already, so you're looking forward for a sign on travel, right? 88% for next year has been sold. So if you're looking for a Viking cruise this year, my friends, not much left. So get on that.
Well, I say that, but the occupancy for the bigger cruise lines has been above 100% because they define 100% occupancy as 2 people in every cabin.
Right. Yeah.
So maybe I don't know if Viking allows that, but
Viking, I believe, only has 2 people per cabin for occupancy.
Okay.
Right. So when they say that, it's like, that's pretty much, it's real, right?
Yeah.
Because they don't like kids. So there's no family aspect to this, right? It's 2-person occupancy for a cabin. At least that's my understanding.
Wasn't it? I can't remember. I'm going off memory. Wasn't it Carnival that said they were going to build similar ships and compete more directly with Viking? I don't
recall. I'll have to look into that.
It was one of the cruise lines. I can't find it.
People want a piece of this market, and it is actually notable going back to Disney. When Disney has, I think, 5 ships in construction right now.
Yeah.
They've said that one of them is going to be the same size as their existing biggest class. I think at least one, but at least 3, if I'm remembering this right. I'm not 100% sure on this, but most of the new ships they announced, they recently said were going to be smaller than their current largest class. So they're looking at a little bit of a smaller target, right?
Yeah.
Not Viking size necessarily, and very different, right? Because they're more family oriented. But there does seem to be, at least among some of the major cruise lines, Will, this idea that maybe we should look smaller in part and I suspect a lot of that is coming from Viking success, right? But so nice advanced bookings. Though advanced bookings are up 26% versus where it was last year, right? So you've seen a substantial uptick in advanced bookings. And they also said they're looking to expand the fleet with 10 new river ships and 1 new ocean ship in 2025. So continued expansion from Viking there. Now, the stock was down, right? The stock was down, but Will, is anything not down today?
No, it's
right. So I don't.
So
And on a day like this, the stock looks like it's down right now. It's down about 6.5% today, with S&P 500 down about 1%. All the indexes are down. It's hard to separate on a day like this, like how much of this is because we might not have liked the Viking report, which I think looks pretty good, even though guidance looks good, and how much of this is the whole market's down, and this happens to be a discretionary spending company, a travel company, a leisure company. Should it go down more on a day like this if you're concerned about the economic picture looking forward? I would argue it makes sense, yes, for a company like this to be down. But we can dig into that a little bit more, right? Also recall what we mentioned earlier in the show about the airline of Delta's comments yesterday about looking at seeing weakness in travel. So I think some of what you're looking for Viking too is, well, what about that? Does that mean the whole travel industry is going down? Concerns over that right now, concerns over the general economy, all is feeding into Viking stock going down. I think that's mostly driving this. It was a good report, and let's remember that Viking the audience they target tends to be somewhat less immune to economic fluctuations because they're older, they're more retired, they are wealthier on average than your typical cruise customer. They care a little bit less about the overall economy because they have a nice nest egg, perhaps, with which they're using to travel. So they should be a little more insulated than some of the other bigger cruise lines. Maybe you look at this as an opportunity, but I look at the numbers. Well, I think it was a good report. I like the guidance they gave. I like where they are in terms of advanced bookings. I think things are looking pretty good for Viking here.
Yeah, the cruise industry in general hasn't so far seemed to be affected by all this. It may be just a lag. Although Matt from 14 minutes ago, rather, had a comment about NCL, Norwegian Cruise Line's Pride of America, the modern in-service ship which was started but not completed at the Ingalls Shipbuilding Yard in Pascagoula, Mississippi. That is interesting. Maybe they are seeing some signs that there may be finally a slowdown, but the cruise industry has been resilient.
Yeah, and that's an interesting ship, right? It has been very resistant, super resilient, right? And so for those who I don't want to go too deep into the weeds on the legal landscape here, right? But there is an act out there called the Jones Act, which places restrictions on ships and where you can come into port, what passengers you can carry, all that sorts of things. And part of that is, if you're not a U.S. flag ship that was built at least partially, I think partially in the U.S., you have to basically go to a near foreign port, right? If you're taking American passengers from one American port to another American port, right? You either have to be U.S. flagged, or there's other nuances there, but you're hit a foreign port, right? What does this mean? It means some things are off limits to non-U.S. ships, like river cruises in America, Hawaiian Island cruises that are only Hawaiian Island cruises, right?
Yeah.
This ship, the Pride of America, is meant to provide a Hawaiian itinerary. So what they want to do is cruise around the four major Hawaiian islands, and basically just do that. And to do that legally, they have to be a U.S. flagged vessel. Hence, why they tried to build part of it here, and why it is a U.S. flagged ship. It's also smaller, a little over 2,000 guests it can accommodate, which is kind of what you want, I think, when you're island hopping too, right? So a little bit small. And of course, if you also there's some shipyard issues there, right? You can't build a 6, 7, 8,000 passenger ship in Pascagoula. It's not going to work, right? They're not set up for that. So yeah, it's an interesting one, and I think maybe you see more of this. Maybe you see some other lines say, "Hey, let's check it out."
Yeah.
And look at this market. But we have to be done, Will, unfortunately, because it's noon. This was fun. I enjoy. Or no, it's not. Is it noon?
2 o'clock Eastern now. So yes, but we are at the top of the hour. So it is time to bid each other farewell, and
we'll bid each other farewell.
And bring.
This was a fun show, Will. Thanks for coming on. We're welcome on Tyler and Jason. Hey guys, feel free to go into the weeds on the Jones Act if you like.
Oh, please don't encourage Tyler. Seriously, man.
I think actually, can we just change this next episode to 1 hour on the Jones Act? I mean, I thought that was on the schedule, wasn't it, Jason?
Oh boy. Where did
Good luck,
everybody go? All right, Will, Toby, have a great rest of your day. Thanks for a good hour.
Thanks, guys.
Tyler, hey, buddy.
How's it going? I mean, no, it's not quite a Jones Act, but industrial stocks that could relate to Jones Act. Can we?
Yeah.
Can we,
I can't remember the Ben Stein's character's name. It was Ferris Bueller's teacher, right? We know him as Ferris Bueller's teacher. I don't want to turn into one of those kind of hours. Anyone? But we are going to have some fun. It's an Ask Us Anything hour. What we promoted was industrial stocks down 10% plus. We can focus on ones that we like. But of course, those of you that see me around these parts, I can answer questions about a lot of companies. Tyler knows a lot more about industrials, energy, obscure suppliers, international stocks, a little bit of a lot of things. So Tyler knows a lot about a few things. I know a little bit about a lot of things. To get your questions into us in Slido, slido.com. The event code is Fool24. Get your questions into us. And remember, we're answering your question. We're not giving you personalized financial advice. We don't know you and your situation. For a litany of ethical and legal reasons, we're not giving individual investing advice here, personalized investing advice. We're happy to weigh in with our expertise and thoughts so that can maybe inform what you then choose to say, but decide to do. But again, own your own decisions, people. That's the most important advice I can give anybody. Tyler, we were going to kick the hour off as people get questions in. We wanted to talk about what's going on out there in industrial land, because the markets are down. I haven't looked at it since I was on a couple of hours ago, but the market was down. The S&P was down a little less than 1% last I checked. So this continuation of the downtrend, the last I saw, the S&P 500 is down about 9.5% from a recent high. So really close to that correction, as they call it, when you get that 10% decline from the recent high. And everybody thinks it's just tech stocks that are down, but there's a lot of stocks across industries that are down. And this includes a lot of industrials, manufacturers, conglomerates, specialty companies that are suppliers and industries and that sort of thing. Right, Tyler? What is your math telling you? You pulled some numbers.
Yeah, so I did a little stock screener before we came on today to just get an idea, because industrials is like the one section of the market. So like, well, we don't know how to categorize this company, so they just lump it in industrials, because it could be like an IT service company that does professional service. That's an industrial company. Or you get, machinery manufacturers and things like that. So it's industrials in itself is a pretty wide gamut. But I did a quick stock screen of the industrial sector, how it's defined. And anything that was over a $200 million market cap, because we don't want to be talking about nano caps here, at least for the moment. And of that, in the industrial sector year to date, there's about 223 companies that are down by more than 10%. Ranging anywhere from 10% down on building suppliers to, I think the worst one I saw was down 75% for a very, very small aerospace contractor. So wide range of things going on in the industrial space. I think one of the themes that the two biggest themes I think that you and I have been following in this space, especially, has been kind of the picks and shovels of AI, the contractors, the machinists, the building supply contractors and things like that. And also just building, construction, housing in general, residential housing companies, things like that. There's a lot of them on this group for a litany of reasons. Starting in January, we had kind of the DeepSeek moment, if you will, where everybody kind of looked around and said, hey, maybe we don't need as many data centers as we thought, because we're a little bit more efficient with these AI models than maybe. And then we've also had this recent downturn for, and again, litany of reasons. We could call it tariffs. We could call it sticky inflation. You can kind of go in any other direction you want there. So
throw it in the economic uncertainty bucket, and that's You know, the
Yeah.
market does not like uncertainty. So yeah.
Yeah, it's the uncertainty stew has been getting hot lately. So So
that's right.
you know, there's a whole bunch of companies. I think there's a lot that you and I follow. And when we started, you mentioned a couple that you had seen quite a bit lately and been following a little bit more, and your thoughts on them. I think you mentioned to me, and I'll open and you can go in either direction you want. You said you wanted to talk Trex because I think Trex is on your Mount Rushmore of favorite stocks to talk about. And then also the other one was, I think, Chart Industries, which is another Jason Hall favorite.
That's right. So Trex is ticker TREX. Chart Industries is ticker GTLS, which you're like, what the heck does that mean? It's gas to liquids. So their equipment is cryogenic gas processing equipment. So what I thought both of those companies would be interesting to demonstrate is thinking about downturns, thinking about what's happening in the market now, while also with these businesses, industrials particularly, just like with banks, you have cycles that can affect them very much. And with banks, of course, it's the broader economy, right, that can cause banks to see significant declines in their revenue and earnings. And with industrials, you need to know the end markets that these businesses serve and know what's going on with the cycle there when you're evaluating these businesses. Before we jumped into those two, though, I just wanted to share this. Bart, if you can release the screen share I just sent over. This is just a couple of ETFs that are broad industrial ETFs from Fidelity and Vanguard, just to show this is over the past year. And you can really see just since the beginning of the year, these are down by double digits from their recent highs. So double digits, right? So you compare this to the S&P 500, they're down more. And the Fidelity one in particular is down a similar amount to the NASDAQ 100, the QQQ ETF that you can buy that's super tech heavy, very growth oriented. So Tyler hit on a couple things. I don't want to really dig into it with a lot of detail, but again, a lot of the keys, like he said, tariffs can affect these sorts of businesses in outsized ways. As we've seen the economy, especially the manufacturing economy, become more international. There are very few companies that manufacture something in the United States that aren't sourcing something really important to make that thing from somewhere outside of the US that there's nobody in the US that's making it, right? So replacing that tariffed item is going to be a challenge. Inflation, like you said, it's been really sticky. Bolt that all together and it creates pockets of economic uncertainty. So I want to share, I'm going to jump over to Chart and Trex, and we'll talk about these two businesses briefly. Again, this is their stocks so far this year. They're down 21%. Now, they did go up a little bit, right? They did go up a little bit at the beginning of the year. So from the highs where they peaked, it's a pretty big sell-off. Chart's down a third. Trex is down 27%. Let's start with Chart, Tyler. Because of the two, it's the business that you can hardly even see it on that chart now. Its financial results that it reported in February were great. They were objectively very, very good. Chart made a substantial acquisition a few years ago that it's in the process of digesting and integrating, a business called Howden that added a substantial amount of debt at the time that interest rates were going up. And one of management's big goals, in addition to the integration of the operations of those two businesses together, was to start bringing debt down, paying off debt quickly. And what we've seen is, from an operations perspective, the free cash flow, the operating cash flow that the combined business is generating, partly just based on the trajectory of growth and deals that were already in place for those businesses, but also as they wring out costs. When you combine businesses, you have a lot of redundant back office function and accounting and things that you can kind of combine. They're way ahead of schedule. They're like 2 years ahead of schedule on where they said they would be with bringing those costs out and driving cash flows up. And they're immediately applying those cash flows to address the balance sheet and the debt that they took on. So the results were good. Their guidance was really, really solid. The stock continues to sell off. So why? Chart's largest end market is the energy industry, Tyler. And one of the things that we've seen that's the opposite of the inflationary pressures is oil prices continue to fall. And there's a lot of reasons that is happening. And the reason that this matters a lot for a company like Chart, where its biggest energy business is largely the biggest energy opportunity is liquefied natural gas, not oil prices, but that's a natural gas price driven business with the value added for being able to take cheap gas in the US and send it to other markets where it's far more expensive because they don't have domestic supply. It's the profits from the oil sides of these businesses that's largely funding a lot of these LNG export facilities that are being built. A lot of the co-investors and the companies that are participating in it are integrated oil and gas companies, and their profits are getting squeezed because oil prices are going down. So companies are being very mindful about their capital spends. And then again, you factor in all of the tariffs that we're talking about. The energy market is almost certainly going to be, the energy industry is going to be squarely in the target of foreign companies or foreign countries because of retaliatory tariffs against tariffs that the Trump administration's put into place. So all of those things factor in. There's a lot of concern that the cycle is going to turn negative if oil prices remain depressed and capital spending gets squeezed because of that. That has the stock down. Looking counter-cyclically, Tyler, we've talked about that with industrials and these businesses that go through these cyclical periods. Almost always the best time to buy them is when the cycle is negative. It's very like counter David Gardner's idea of averaging up and winners win and continuing to be willing to pay a higher price for your winners. Because these are large, stable businesses generally, and they do have the ability to grow. But we're not talking 20, 30, 40% revenue growth per year. They go through these cycle periods, and the best opportunities to buy are typically during those cycles. You want to talk about Trex a little bit?
We are actually getting quite a few questions directed towards us. So
how about if I will save Trex towards the second half of the show.
Yeah, I had a few thoughts on MCore too, because MCore Group, electrical contractor, kind of tied to the AI thing that we were talking about with DeepSeek and inflation and things like that. So that was an interesting. It was one that I had been following. It's also down 10%. Kind of a little bit of a touching on all of the hot points of political macroeconomic stuff, very similar to Chart, where it's like, oh, they have great earnings, but everyone's scared of for a lot of the other macro reasons. But we do have quite a few questions out there, and there are some ones in here that I feel like we're really talking to my people here, because 19 minutes ago, Maria asked to both of us, hi, Tyler and Jason, looking at GEV, which is GE Vernova, we'll get to that in a second, TT, which is Train Technologies or Train Corporation. Either way, Train, the company that makes air conditioners.
TRANE, not toot.
Yeah, that's right. TRANE, the ones that are outside your house and keeping it cool. APH, which is AIT, which is Applied Industrial Technologies. This is a distributor.
You made Tyler
the joy that came to my mind when we talked about distributors. APH was Amphenol Corporation, another just tugging at my heartstrings here. And then CSL, which is I think it's Carlisle Corporation or Carlisle Companies. There's like so many Carlisles that are publicly traded.
It's Carlisle Companies. Yeah. And Train is Train Technologies. Good job there.
Okay. I feel like it's a quiz every single time we do these. And Carlisle Companies is the building products company versus the private equity company. So right. Of those, which of these do you find most promising in terms of potential returns, and how would you rank them? Thanks. I'm going to punt on two of these, and maybe Jason can hop in a little bit more with Train and Carlisle, because those two I think are for me the ones I know the least. But AIT, Applied Industrial Technologies, is a distributor, mostly like distributing mechanical components for building like automation lines. So say like you're building a semiconductor fabrication company and you have to do all of like those belts and pulleys and all that stuff that connects it from one one portion of the fab to the other. A lot of the automated components that move things along a line in automotive, basically anything that involves factory automation. AIT is going to be one of the distributors and suppliers for this industry. Amphenol is an interesting company. They just basically make connectors, like like ribbon cables, like that they built for printers back in the 80s. They were like the ones that invented. Basically, if you have to like connect a circuit to another circuit or a plug to a plug and you don't have a effective way of doing it, you go to Amphenol, they design it for you and then build it.
It's the perfect kind of business where, because those things are niche and specialized, chances are you don't need, even if you're big, you don't need to manufacture enough that it makes any kind of sense at all for you to try to design it and stand up your own manufacturing to do it. It's exactly the kind of thing you find a partner to do.
Yeah, there are dozens of companies out like this that just do this really, really small niche thing that nobody in the world wants to do, or like it doesn't make any sense for them to have it in their within their business. And they'll just be like, hey, can you solve this problem for us? And we're like, yeah, sure. And then GE Vernova is the spinoff from, part of the breakup of GE, where Vernova is the power industry component.
It's the picks and shovels for the power industry. Yeah.
So they do mostly natural gas turbines, although they still have some coal steam turbines, wind turbines, and then like transformer equipment, and basically all of like the hardline for moving power from one place to the other. So I'll kind of comment on these three. I've been pleasantly surprised at GE Vernova post split. The power section of GE was like the trouble child and part of the reason why they sort of instigated the breakup. It was, renewable power, especially wind, was for something that for them that was really a struggle. They signed a lot of bad contracts. They had a lot of cost overruns. Service contracts weren't very profitable, and that's how all these like turbine manufacturers make money, is they sell the product for low margins, and then they get these really lucrative service margins. So, these
turbines are in the field for decades. We're talking 25 to 40 years in some cases, and it was bizarre, Tyler, because the legacy of a GE, especially in its aerospace business, and most of it, the rest of its power businesses, they're pretty good at that razor and blade model of getting that long-lived asset out there and then earning really good service revenues with high margins over the long term. But they really struggle. You're right. They've struggled with this.
Yeah. I think, so all three of them, I think, are relatively quality companies. I've been, like I said, pleasantly surprised with how GE Vernova has been playing out. They are very much on this play on, or this concept of increasing power demand, not just globally, because global power demand has been a huge, a thing for a long time, especially in emerging markets. Developed markets like the US and Europe hasn't been about load growth, capacity growth. It's more or less just been like turning over an exhausted portfolio of 50, 60-year-old coal plants, really, really old steam gas turbine plants that weren't nearly as effective as some of the new like combined cycle turbine plants. So a lot of that just kind of turning over. There wasn't a lot of growth. But with AI and kind of this power demand that we're seeing, we could even throw in cryptocurrencies too, and demand for mining currencies as well. There's a little bit of growth in that as well. There has been this shift in thinking in North America in terms of power demand growth, which should position GE Vernova really well. Now, again, I'm punting on Trane and Carlisle, but of those three, I think I've been, like I said, I'm very optimistic about GE Vernova for a lot of the reasons I mentioned. It's kind of a improvement, a business that looked bad but is rapidly improving, and I don't know if the market is fully appreciating it's improving. And Applied Industrial Technologies, I love distributors. I love incredibly well-run distributors. I think Applied Industrial Technologies is one of them. They are going to be a little bit more cyclical. Like I said, they're kind of tied to construction cycles, new consumer product plants, new automotive manufacturing. The reshoring trend in the United States has been a big boom for them, but this is a cyclical industry, so do keep that in mind in terms of a long-term hold. And Amphenol, man, that stock will just bore you to death. It's, the business itself is incredibly resilient. It's a quality business. I think it's one of those ones that's probably going to last forever because, look, we're always going to need to connect stuff, especially in the electric market. So Amphenol is always going to be there in some form or another. That's just kind of one of those businesses. I haven't looked at the stock price recently, so I'm going to I'm going to temper my response on the stock itself right now because I would have to go double check on valuation. But in terms of something that you can just kind of hold and forget that it even exists in your portfolio 15 years later and look up and go, wow, that turned out really well for me. I think Amphenol is a top candidate for me.
Yeah, it's a great business. I can't. So Trane is really interesting. So Trane, this is one of the large HVAC companies. I believe they have the largest market share in North America, are in the 20s, low 20%. And I think the top 5 companies probably have a combined 50% of market share. So what that means, again, this is a large industry. It's relatively mature. What you tend to see in those cases, and Trane is an interesting story because it's only been a public standalone company. I don't even think it's been a decade yet. So Ingersoll Rand, it used to be Ingersoll Rand. Ingersoll Rand acquired it, and then they spun out Ingersoll Rand, and Ingersoll Rand became Trane. So looking at the long-term performance of the stock is a little challenging with it. But what you really have is this is a consolidation play, but also just a modernization and energy transition play too. Because one of the things that the International Energy Agency has talked about is in terms of the path to reduce carbon and reducing climate change and the low-hanging fruit for just improved efficiency of energy consumption. We talk a lot about renewables. We talk a lot about using energy storage to unlock the power of things like wind turbines that GE Vernova makes, solar panels, which, by the way, the solar panel manufacturers, you'd think, oh, that must be in the energy industry. No, they're a manufacturer. Oh, so it's an industrial. No, they're semiconductors. So they're in the tech industry. The sectors are weird. I just want to tell you, even though I'd say if you're going to bucket it directionally, these are industrial manufacturers. But the point is that the third leg of the stool for energy optimization is taking these existing legacy buildings and just making them more energy efficient. And modern HVAC equipment is a big part of that, right? So that's one of the opportunities for growth there. The electrification of everything, the growth in things like data centers, need to be able to cool those. There's opportunity there. But really, it's market consolidation is where Trane's growth going forward is probably going to be. When you've got less than a half a dozen companies that have, roughly half the market share, that means that there's a lot of smaller players that you have the opportunity to consolidate. So I think the opportunity for Trane is interesting, but I haven't studied the company enough to really say anything of specific value beyond that. You don't want to talk about implied industrial technologies, Tyler?
I did.
Oh, that's the first one you did. I'm sorry. That's right. That was the first one you did.
It was sandwiched between GE and Amphenol, but you fell asleep because I started talking about Amphenol. That's fine. Everyone else does.
Yeah. So I don't follow Carlisle, so I'm not even gonna say anything about it. But of these, I think AIT is the one that I like the most. Just because it's tough because Amphenol too they're both in the same, you overlook them. You don't know who they are, but I promise you, if you're in manufacturing, there's a really good chance one or the other, or maybe even both, right? If your job is tied to operations and manufacturing, product design, these companies are really, really important. The thing about GE Vernova is the one thing the stock's done. I haven't looked at it recently, but I know coming out of the split, it did incredibly well. I'm not sure if the valuation makes sense. Let me rephrase that. I think there are better opportunities out there to me that look like more obvious opportunities to buy right now. Let's see. There was a question that I saw earlier that I wanted to make sure to get to, asking about some of the yield codes and some of the, okay, here it is. Ed asked this about 20 minutes ago. So Brookfield Renewable Corporation, that's BEPC, Clearway Energy, CWEN .A. It's also CWEN. The difference between the two shares, CWEN are voting shares, .A are non-voting shares. There are two companies that have a voting control of these companies. They're two partners, one of which is the French oil and gas giant, or energy giant, really, Total Energies. The other one is a privately held infrastructure developer. I buy the non-voting shares here. I own the non-voting shares of Clearway because somebody else is going to make the decision. You can get a lower price and a better yield. And then and now we're going in a different direction with Devon Energy, ticker DVEN, independent oil and gas producer, and now Chevron, CVX, the multinational, fully integrated oil and gas giant. The question Ed asks is, would you consider all these energy type companies as long-term buys and holds? I'm going to start with Devon Energy, and I think you'll agree with this. If you're investing in Devon and really just about any independent oil and gas producer in the near term, it's gonna be a leveraged bet on oil and gas prices. The day that you buy, there's a very good chance in the next 30, 60, 90, 180 days, the next year, probably, not always. Again, if you're buying it from an extremely low valuation, bottom of the cycle kind of thing, you may see something a little different. Or if it's extremely overvalued when you buy, it might be a little bit different. But generally, if oil prices fall 5%, it's probably going to fall 7 to 10%. If oil prices go up 10%, it's probably going to go up 20 or 25%, right? Again, adjusting for the company reporting something material along the way. If it's just oil prices is the only news, that's going to move the stock, right? So I think you have to remember that is going to be a big thing, and that means volatility. And for fools out there that don't know, investors out there that don't know or follow the oil industry and have some baseline of knowledge, it can be really difficult to hold these businesses through that volatility. So I think that's really important. Also, broadly, these independents over the past decade, Tyler, have struggled largely to really create long-term value. We've seen some exceptions over the past 5 years because we're kind of bottom fishing right now from 5 years ago. We're like torturing the numbers in like the perfect way to get the right entry price from the pandemic, when all these companies were just kind of sitting around hoping they didn't run out of money before people started putting gas in their cars again. It's been a real challenge. We're starting to see better signs of that over the past 6 or 7 years. We've seen better capital discipline because nobody wanted to lend them money and they had to be more disciplined from a capital perspective. They've changed their dividend policies to pay like a small base dividend, and then based on excess cash flows that have really good years, you're going to get a big dividend for a few quarters. Prices like we're going through right now, that special dividend, the variable dividend, is going to be much, much smaller to zero depending on what happens. I really struggle to think of any of these independents as long-term buys and holds. Now, Clearway Energy and Brookfield Renewable, these are utility companies. They're independent power producers. So I don't put them in the same bucket with Chevron and Devon, because the things that affect their business are very different. They're more like, if you're going to get in the oil and gas business, they're more like the pipeline companies, but their business is to deploy capital to build renewable energy or to invest in renewable energy assets that operate for decades. They get they know their cost of production, and then they sell the power from those assets on long-term contracts, like 20 plus year contracts. Some to utilities, but they also sell to really big power buyers like the Alphabets and the Microsofts of the world, large manufacturers that want to lock in renewable energy to offset their power, and lock it in at predictable rates over the long term. That's who they sell the power to. So the play as an investor here, the thesis is the dividend that they generate, and their ability to grow that dividend over time. And that's the biggest driver of returns for investors over the long term is the dividend and growing the dividend, with around half or maybe a little bit less than half of it growing the per share value as the business becomes more cash flow generative. So I think those are steady, great long-term investments. Again, if you buy them from attractive prices, and I think they're attractive prices right now. I wanted to leave Chevron for you, Tyler.
I'll go really quick. I don't think it's necessarily a bad company. I think it's going to do fine. It does a decent job of generating returns. It's a little bit more levered to the production side than most of the integrated oil and gas companies, because it just doesn't have as much refining and chemical manufacturing. The one thing that does concern me a little bit with Chevron relative to the others is they have a relatively weak development pipeline in terms of what sort of growth they have coming online in the next few years. Basically, they bet the farm on shale in the US, in Argentina and Algeria. The US certainly worked out. We're still waiting on Argentina, and Algeria has not been great. And their other big one has been a expansion of a major project called Tengiz, which is in Kazakhstan, and that's been a hot mess. It seems like whenever anyone does a mega project in Kazakhstan, it goes way over budget, and this is another case here with that. Aside from that, they don't have a lot. They've got a couple other like oil and gas platforms in the Gulf that they're working on, but if you compare it to a lot of the other companies, that it doesn't have that big that I would say like diversified portfolio of growth opportunities in the next several years that would concern me a little bit. I mean, ExxonMobil has Guyana, and that should keep them going for at least 15, 20 years. And Total Energies has offshore Africa. Equinor has Norwegian continental shelf and some stuff in Brazil. I struggle with Chevron's long-term growth prospects. I think it'll do okay. It'll do fine. It'll find some oil, but right now its pipeline looks a little shaky relative to the other ones, and that's kind of been by design. Like several years ago, they went way over budget with some stuff, and then really like honed in on their capital spending to be disciplined. And I think that it's just coming to roost a little bit. So I'm personally a little bit bigger fan of Total Energies and Equinor, both on a returns and also based on valuation today. But yeah, and then I'll defer to Jason on the rest of them, because we've got quite a few questions, and I want to make sure we get a few more of them in. Rose asked about 27 minutes ago, is XLI a reasonable way to take the lazy approach to adding industrials to your portfolio? I mean,
it's most the sector spider, the industrial select sector spider, which and that is just large cap S&P 500 industrials.
Yeah. And I'm just looking at like the top 10, 15 companies in this. And not only is it industrials, it is very heavily weighted towards like the big ones, especially aerospace and aerospace and defense. So its largest holdings as of right now are GE Aerospace, RTX Corporation, which is Raytheon, United Technologies. They own like Pratt and Whitney engines. So again, big commercial aerospace. Caterpillar, so big earth machines. Uber Technologies, definitely one of these things is not like the other in the industrial space. Union Pacific Railroads, Honeywell, Deere. I mean, lots of just big diversified industrial manufacturers or aerospace. The one thing that I would say, I think it's a nice lazy approach. The one thing I would say that is a little bit more exposed to commercial aerospace or commercial airlines more so than probably some others. I mean, Boeing is a big position as well. Airbus, Boeing have kind of been having a little bit of trouble deploying commercial airlines. So there could be some knock-on effects with GE Aerospace and RTX in that regard. So all in all, I think it's fine. It's just just know that you're not getting the full range of what is available in the industrials world. Much of the industrial world is in like the mid cap space of that, $10 to $50 billion that aren't in the S&P 500. And so you're not getting as much exposure to the more broad, diverse aspects of industrials, and very much on the mega ones.
And I think that the risk there, because again, it gets back to the importance of valuation for those sorts of businesses, that as much as the market's down, I think that particular industrial select sector the spider XLI is probably down around 10% from the market, but it's done quite well more recently. And we've seen, Tyler, a lot of those businesses that you named, particularly the defense companies and some of the aerospace companies, there's already been a lot of inflows to that. Investors have moved a lot of money there, viewing them as safer. And plus the catalysts of the war in Ukraine is driving some tailwinds of investors in there. So I don't necessarily know that, like, over the past 10 years, it's generated annualized returns of about 11%. That's trailed the market, but that's better than over the same period, but it's better than the market's long-term average, Tyler. I don't know if we're going to see those same level of returns going forward, because a lot of these businesses, their valuations are pretty elevated right now. So I don't know. It depends on, I guess what I'm trying to say is that as an individual investor, it depends on what one is trying to accomplish. What are you looking to own them for? Is this a ballast investment to give you some sort of stability? Because as much as a lot of these industrials are very cyclical and struggle, the defense stocks tend to be a little more steady Eddie, because they know what they're going to get broadly. The governments that they sell to tell them years in advance what their budgets are going to be. And they know these programs are 20, 30 plus years. So we have a lot of view into what their revenues and earnings are going to be. So there's ballast there, but if you're looking for outsized performance, I think that that's probably not the approach that I would take. All right, what's next?
Well, just a quick follow on to this, and we can answer it and move on, because Danny asked 23 minutes ago, thoughts on industrials with good dividend yield and growth potential for retirees. I don't know how much growth potential Danny would be looking for, because dividend yields and growth potential in industrials, three things together that don't necessarily work together. You can have industrials with good dividend yields, or you can have industrials with growth. It's hard to find all three of those. That's really threading the needle. But since you're saying for retirees, I'm going to kind of focus on the quality company dividend yield, probably looking for some portfolio ballast income. I would say, there's a pretty decent shopping list. If you look at the XLI ETF and look at its top 10, top 20 holdings, there's a lot of high yielding dividend companies in the industrial space here that are worth taking a look at. I mean, the one that stands out to me immediately, I think it's raises dividend for like 50 years straight. Deere Corporation, it's right there in the top sort of thing. I don't want to speak too broadly or too specifically about Deere. I mean, it's everyone knows what Deere does. They make agricultural product machinery, but one of those businesses that has committed itself to growing a dividend over time. So if you're looking for a shopping list for good dividend yield in industrials, I think it would be worth going to the XLI page and just kind of doing some homework, because I think there's a lot of options there.
I'm going to take your answer there and referring to Deere, and sent us question 28 minutes ago. Jason Tyler, if automation and AI reshape manufacturing, which industrial stocks thrive, which become obsolete? I think Deere is an interesting case study for a company that has leveraged technology for its customers in markets where things like automation can create enormous amounts of value. Farming equipment, mining equipment, where you can bring in automation and improve safety, use less diesel, get your most efficient work out of your equipment, improve yields with optics and sensors that are actually analyzing soil and potential disease in real time in your fields off of your equipment, that then can inform being very specific with how you water, or pesticides or herbicides and things, the application of those sorts of things that create massive amounts of value just from a piece of farming implement that can create value for a farmer in lots of ways. And again, some of the same thing in mining and construction equipment, other things that they do. So I think there's two ways, and then maybe we can talk about a couple of companies that we like here. But first of all, there's that thing, the Deere model of finding a way that building technology into your product serves your end markets. And some of it's going to be competitive. You're going to have to, because if you're not, your competitor's going to be doing it and you're going to lose market share. So some of it's defensive, but the companies that lead there can take share, and then they can find margin by doing that, by expanding their business. So that's one way. But one of the things that I think is probably the biggest broad implications for artificial intelligence is for companies that leverage it inside their, not necessarily just in their manufacturing, but they use it for things like business intelligence. They use it in the back office. They use it to find ways to make their business better, drive out cost, identify opportunities. That's the thing that I'm maybe most interested to see. It could be something as simple as let's use MCore as an example. I can imagine one of the things that they probably bang their head against the most is making sure that they maximize every hour of time that they have an electrician that's working, getting them from site to site, job to job as efficiently as possible, so that they're spending more time on site working than going between, right? Making sure that they get parts that they need as quickly as possible, and that it's the right parts the first time. And those are some of the ways that I think AI, especially for the service intensive businesses, can unlock tremendous amount of value for these companies.
There, somewhere that reserved for another time, is my very, very long rant on this false narrative that, you know, only innovation in AI and technology is going to come from these Silicon Valley startups that are doing tech and you know, doing the coding and whatever, and all of these industrial companies are all going to go die because, you know, AI is just going to dominate them, stuff like that. Many of these companies have been around for decades because they innovate, because they, you know, step up to the moment when they need to. And I can assure you that most of these companies are thinking about this hard, how to use it well, and how to, you know, more effectively better their business and not become the least. Some are going to get caught off guard. Yes, there are going to be the Eastman Kodaks of the world that screw up and kind of, you know, miss the forest for the trees when a technical innovation comes. But I just want to use an example of what could sound like the most boring un-AI. How is this ever going to like live in a digital, in a like a technologically advanced world? Lindsay Corporation, they make sprinklers. Basically, like if you've ever seen a crop circle, like the big circular when you're on an airplane, they're one of like the 3 companies in the world that make those type of like automated goes around sprinklers. It sounds so like benign as like, oh, there's not a lot of technology in this, just like a center pivot gear or something like that. The amount of like data and tracking and like information that they're using so that they can, you know, track, you know, down to almost the square foot, like where to apply water, where to apply pesticide, like how frequently are things growing as they're getting into enough sunlight. The amount of remote sensing and AI data that these companies have been collecting for decades, not the, you know, machine learning AI component now, but they have been collecting this data for decades and know how to, and are now using these tools to better the products that they're making, because they know if they don't, their competitors will. These are always like vicious knife fight sorts of industries where if you don't innovate, if you don't move on or move to the next thing, you're going to get left behind. These companies have known this for decades. And I would be, yeah, there's going to be some that fall to the wayside, but I think more of these small industrial manufacturers that, or, you know, industrial services companies, things that we don't necessarily even think about that much, they're likely going to succeed because they've been doing it for decades. It's built into their DNA.
Yeah, no, I think that's exactly right.
And that's my short rant on this.
Yeah, you can go much longer. I've seen you. I have seen you. Tyler, Vihan's asking about A.O. Smith. Do you still own A.O. Smith?
I stopped. But we can go there. Vihan asked if I still own A.O. Smith, current thoughts. Again, this is one of those where the caveats, because this is for Motley Fool members who get recommendations, and there may be some analysts and recommendations for A.O. Smith in current portfolios, in current services with the Motley Fool.
This is the Motley and the Motley Fool.
Yes, and we are contributors who sometimes might have opinions that are slightly different from what some of these services are. So please don't, just keep that in mind when you may see something a little bit conflicting, because I was a huge fan of A.O. Smith. I thought it's a wonderful business. It's North America. If I could just take the North American business alone and just have that, I would own it until the day is long. It's an incredibly resilient business. It's water heaters, commercial boilers. 85% of sales in North America are replacements of existing systems. That's a perfect business because people replace them like the minute that a hot water heater goes out. They barely care on price. They don't really pay attention. They just be like, hey, plumber, what do you want to put in? Well, A.O. Smith owns 40% of the market. Yeah, great. Throw that baby in there. I love that business. I can't get enough of it. They made a really big push into the international market. And this is a reason why I kind of let it go, because this was it really pushed hard into China, which for a long time was a huge tailwind for the business. Massive growth. Margins weren't quite as good, but it was kind of the promise of man, if it can grow this fast in China and we can get some uplift on margins, it will do relatively well. That's kind of gone from a major headwind to quite a bit of a tailwind, both with the slowdown in the construction industry and real estate development in China, coupled with this is one thing it's hard to quantify, but for the longest time, they used to put this chart in their investor presentations that showed that they were the market leader in China. Then all of a sudden they miraculously stopped, which I don't know, kind of tells me if you stop doing it, it normally means it's not good news. So I'm going to guess that they stopped being the leader, market share leader in China as a result. So it just, to me, it looks like it's been a little bit of a tailwind. I'd love to revisit this business in a few years, maybe to see once this, they kind of lance the tailwind or the headwind that it has been its international market and try to right size that and figure it out. But until that international headwind kind of clears, I'm going to kind of sit on the sidelines again.
So before we take the next question, I want to make a quick plug here for what's coming up after us. And I want to encourage any fool that decided you wanted to watch the industrial stocks down 10% hour, you want to stay for the next hour. Motley Fool co-founder and CEO, Tom Gardner, and Motley Fool chief investment officer, Andy Cross, are going to be interviewing Sterling Infrastructure CEO, Joe Cutillo. So make sure to stay tuned for that. That's going to be coming up right after us. So be sure to check that out. Do you want to?
I think we're the amuse-bouche because we're getting everybody hyped up for industrial stocks before we go into this.
Yeah, we're the hype men for this show. So I want to
certainly
say
the amusing part.
So I got a feeling that you'll be able to talk to No Noise's question about Republic Services and waste management. But before we do that, I want to give you a chance to take a breath. And Mukund and Vihan both are asking some questions about the Brookfield companies and some valuation things too. So we'll start with Mukund's question. Why is Brookfield Corporation falling? So that's ticker BN. I want to share, as I want to do in these sorts of moments, I want to share, if I can get it to come up here, I want to share a little chart. So Bart, if you can release that to the screen share here. I've got, with Brookfield Corporation, I've got KKR and Blackstone up here, and I'm going to throw BAM on here too, Brookfield Asset Management, just for some context. And this is, and you notice, here's the thing, directionally, they're all doing the same thing, right? They're all to some degree doing the same thing so far this year. But even on a day-to-day basis, if you match up the little, pretend they're like Legos and you're fitting them together, these companies' alternative asset management is the engine that turns the wheel for these engines. They all do that. And for Brookfield Corporation, it owns 75% of Brookfield Asset Management. So it's going to move in lockstep. And when there's no news specific to one of these companies, they're all going to move together because, again, they're in the same business. So this is broadly some of the same rhymes with what's going on with the broader market, Tyler, with the concerns, economic concerns, interest rates, tariffs, geopolitics, kind of lump all that stuff in there together. And markets and investors are a little bit fearful. Commercial real estate values, all of these have to some degree, more or less, a lot of exposure to commercial real estate values. Financial Times recently had an article that came out that questioned some of the related party dealings with the different Brookfield entities. But to answer the first question, it's down because the industry's down, because most stocks are down, and fear and uncertainty is the bigger driver of the market than greed right now. Ergo, stocks are down. The other question from Vihan, looking at Brookfield Corporation and Brookfield Asset Management, which is a better valuation, kind of goes on with asking about taking a specific amount of money. I'm not even going to touch that, Vihan. I'm not going to touch it because that's going to sound way too much like me telling you what to do with your $3,000. And I don't want to touch that. But I will say, looking at valuation, I think the Brookfield businesses are really appealing right now because the uncertainty that's pricing things in concerns a little bit of a concern with some of the related party stuff that the Financial Times piece put out there, are questions that people have asked about the business in the past that have always been answered to the best of my concern. If you're gonna have questionable activity with related parties, you're not going to do it probably not going to do it. The smart way to do it would not be to do it between publicly traded entities that are highly audited. It's too easy to find things that aren't good going on. So I have very few concerns beyond the fact that it is a little bit opaque just because of the corporate structure to understand all of the things with the Brookfield businesses. But Bruce Flatts earns a certain amount of trust for me. But thinking about valuation between Brookfield and Brookfield Asset Management, I think they both trade for reasonable prices right now. And it's really more of what an individual investor wants. If you want to own an asset management business, an alternative asset management business, Brookfield Asset Management makes sense. You earn the 2 and 20. You get a percentage of the cash flows from the fees for managing the assets and excess returns above the benchmarks. That's what you make money on. It's a dividend growth investment. Brookfield Corporation, you own a stake in everything that's Brookfield, the asset management business, but also the operating companies in renewable energy. So if you want to be exposed to energy transition, you can get exposure to that. The industrials business, the infrastructure business, which trillions of dollars is going to get spent in modernization and global expansion in industrials or in the infrastructure industry in coming years. It's a massive amount of money, and Brookfield operates in dozens of countries with people on the ground that know those markets and know the opportunities, and they're value buyers. They're really good. Private equity business they have that's pretty good. You get exposure to all of them, I guess is what I'm saying. With the asset management business, it's a little cleaner. It's because you don't have all the related party things quite as much, even though the asset management business and the funds, they may sell assets maybe to one of the reinsurers, that sort of thing. But no, I think the pricing right now is appealing for those businesses, especially based on the long-term trends and the long-term need for capital to flow into the assets that they're investing in. I know you have a thought too.
Yeah, here's my thought, actually. It's a shameless plug, because if you are interested in Brookfield companies, Jason and I are going to do a full hour. It's the Brookfield hour. It's Jason's dream job. He gets to talk about Brookfield for an
that would
hour.
be the Brookfield day.
Okay. Well,
But
we only get an hour, but on Thursday at noon Eastern time, Jason and I are going to do a whole hour on Brookfield and all of its various entities. Maybe not the insurance part, because that will make us look real dum-dums, because I think if we started talking about insurance, people will start tuning out. And speaking of dum-dum, because we're about to close out the hour, and you wanted me to give thoughts on Republic Services and Waste Management. And I can give my thoughts, but this is going to be us closing out, and you're all going to be sitting around going, man, we listened to these guys for an hour, and then we had to, we find out this guy's an idiot, because I owned Waste Management and I sold it because this is Waste Management, Republic Services are obviously the trash collecting companies. They own landfills, the two largest in the United States. And it's one of those, like, it's hard to screw up sort of businesses. Look, if you own a landfill, chances are you're not going to get a competitor anytime soon. Like, the permitting for a landfill is practically impossible. So you have these like geographic monopolies. You sign these really long takeaway contracts. It's very stable revenue business. If you're a good operator, you do fantastically well. Even if it's slow growth, 10, 12% returns on invested capital, pay a dividend, buy back some stock with your excess cash flow. It's in terms of like businesses that could last forever. These are the kind of businesses that you could see lasting forever as long as they're managed well. I sold my position in Waste Management because, like I said, I'm a dum-dum, and it was because it was coming into a business where Waste Management was going to be doing a large investment in the recycling efforts. Recycling had always been a weak point for Waste Management in particular. So they were going to do this pretty large multi-year investment cycle to try to, make this business a little bit better. When they announced this and I was looking at the stock, I was like, man, this is a quality business, but it's trading for like 35 times earnings. Even a quality business has a price. And I looked at it and I said, it's done great returns for me. It's trading for a very, very high multiple. The multiple has been expanding the entire time, and we're about to head into this period of like thinner cash flows because it's making these reinvestments. And we could, 2 or 3 years, we could see like maybe some lower earnings because of all this reinvestment and stuff like that. So I sold, and then of course the company has done nothing but beat the market the entire time. Mm-hmm. So goes to show you that, slow, boring businesses can be wonderful and beautiful. And sometimes you shouldn't listen to us because we make dumb decisions, like sell a great company like Waste Management because it trades for 35, 40 times earnings.
I want to build on that just really briefly here as we're getting close to the end of the hour before we hand off for a great interview coming. There's times that selling those stocks do make sense. And it depends on individual situations. And sometimes if you have a stock that's highly valued and you looking forward, you have questions, but it's been a big winner for you. And now it's a really large part of your net worth, and retirement's around the corner or some other big financial goal. What the stock's going to do going forward is less important than turning that wealth into money, right? When you need money. So sometimes that's a good situation. But of course, Tyler was still in his 30s when he made that decision. So the biggest mistakes we always make usually are selling winners too soon, often for reasons like valuation, right? When the current valuation doesn't matter if we're intending to hold for the long term. So great lesson. I've made more mistakes on that than you have, Tyler. So that's really good. Let's see here. I have a last question you want to grab here before we transition over to Andy and Tom with Joe Cutillo.
Yeah, I'm going to take half of one question from Maria from an hour ago. I mean, we opened with Maria's question because she tugged at my heartstrings with all of those wonderful distributors and boring companies. She asked, Jason, any thoughts on Pilgrim Pride Corp and which is PPC ticker, and Coca-Cola Consolidated? Ticker is KOCOKE, which is one of the bottlers and distributors for Coca-Cola, the big company. It's their largest one, and it's publicly traded. I'm going to punt on Pilgrim's Pride, and I'm going to focus on Coca-Cola Consolidated because it's always wondered to me. It's like, man, everybody looks to Coca-Cola, but why not look at Coca-Cola Consolidated? Because this is one of the businesses that has done spectacular over the years. Distributors, it's a great business. As well as I've said it again, be a good distributor. You can make a ton of money as long as you're good at rolling over your portfolio and all that stuff. It's been a high return business. The revenue has slowed a little bit, but they've got tons of cash. They started using it to buy back stock. It's more or less a family run business. I think the son now, or the third, I can't remember. It's multiple generations of CEOs have been at the helm, so it's a little bit family controlled. I think they also own a majority of the shares in this company. It's one of those ones I've looked at it for years and been like, man, why don't more people just own Coca-Cola Consolidated instead of Coca-Cola? Because I think it's actually a better business, and the opportunities for growth of acquiring some of the other fledgling distributors is a real growth opportunity.
It's right there in the name, consolidating. instead of consolidate it.
Yep.
That's the opportunity. It really is. All right, Tyler, this has been great. Fools, thank you so much for all these awesome questions. Our YouTubers that are watching, giving us questions too, thank you so very much. But it is indeed time to transition over to better fools, smarter fools, and a great guest with Joe Cutillo. So let's get them onto the stage and we will hand it over. Hey, Tom, Andy,
Jason,
Gents,
great to meet you, Joe. Great to have you on.
good morning or good afternoon, I guess. Thank you for having me.
Absolutely. All right, guys, take it away.
Thanks.
Joe, thank you very much for spending this time with us. And we're really looking forward to this conversation with you. And we'll just sort of start up with a very quick introduction about your business and just queuing you up as I go into the intro, that the opening question will be just an overview from you on the business. But Joe Cutillo is the CEO of Sterling Infrastructure, I believe, since 2017. The company has around 3,000 employees, over $2 billion in sales, about $330 million in owner earnings, plenty of cash flow in the business. The company's market capitalization is about $3.4 billion. It's been quite a volatile time for a lot of stocks out there in the market. So we'll get into that a little bit with Joe as well. And we have recommended in the Hidden Gems Moneyball portfolio, real money portfolio, where every day we invest $4,000 in a different stock. We have chosen to allocate 2 separate allotments to Sterling Infrastructure here in the first 6 months of the portfolio. Not many companies have gotten 2 allotments. We are at a higher price point than the stock is at now, but that's the nature of the game in investing, and that's what's happened in the market. But our cost basis is around $150. The stock's down around $120 today. It was a $9 stock in 2020, so it has been an unbelievable performer. In this short little window, Joe, we're the only ones that are down in Sterling Infrastructure in this world. But as I'm sure, as you may know, we are a 5+ year holding period approach as investors. So we're really excited to be shareholders of Sterling Infrastructure and to get to learn from you today about it. So the opening question is, how would you describe the business to a newcomer, somebody who's never heard of Sterling Infrastructure before? Obviously, a lot of our viewers today are shareholders, but there are certainly some people in the audience that have never heard of the company before, and now they get an opportunity to hear it from you.
Yeah. So, we're an infrastructure service provider that focuses in 3 different segments. Our e-infrastructure segment is our largest. And in that segment, what we do is site selection, site development for mission critical type applications predominantly, which could be data centers, onshoring of manufacturing. We've done a lot of battery plants, solar plants, you name it. If it's big and needs a lot of dirt moved and infrastructure put in, we do that particular type of project. That market is growing tremendously for us. It is, and we see a very, very strong multi-year trend ahead of us, not only with the backlog that we have in place, but the projects we see on the drawing boards and what our customers are telling us. The second segment that we have is around transportation solutions. This is where the company started back when I joined in 2015. About 95% of our business was in low bid, heavy highway work. That's a very difficult business, very high risk, very low reward. As you talk about the transformation today, less than 10% of our business is in low bid, heavy highway work. That's why you've seen the margin migration up significantly over the history of that time. And we focus that business more on value added type projects in the transportation space, whether that's design, build, or alternative delivery projects, where instead of just being low cost, we have a value proposition to the end customer at the end of the day that we can design and build the project better and faster in a lot of cases, not necessarily cheaper for the end customer. And then our last, also we've migrated towards aviation and rail. So we'll do runways, taxiways, those sort of activities. And then on the rail side, we have what we call a rapid bridge replacement and some technologies and uses that we can pre-build products. And instead of taking months to replace a damaged bridge or a defunct bridge, we can do that in weeks. So as you can imagine, if you're a railroad, they know exactly what an hour of downtime is or a day of downtime. That has a high value proposition for them. Our last segment is in building solutions, and we're in the 3 fastest growing, largest markets in the U.S., which is Dallas, Fort Worth, Houston, and Phoenix. And there, it's a little different business from the rest in that we do concrete slabs and plumbing for the major builders. Pulte, Lennar, Horton are three of our largest customers, and we've seen very nice growth in that market over time. If you put that all together, we've built a portfolio of these three segments over the last 6 or 7 years. That's really the beginning point of where we're going in the future. Everybody asks us, you've done such a great job of transforming the business and going from low single digit margins to we have the best margins, the best cash flow, the best returns of anybody in the specialty infrastructure space, to where do you go now? This is just the beginning, and that's what's really exciting. What we can not only add to the three segments that we have today, but we're looking for that fourth leg of the stool that has 10 to 20 years of growth attached to it as well.
Thank you for that. Very helpful. Andy is going to share our menu of events here, just a little overview of the questions, the sections that we'll go to. Maybe Andy can bring up that screen share. But as he's bringing it up, just one more overview question. Is there a single company that you view as your lead competitor, or because you're in multiple segments, it's really there isn't somebody that's sort of consistently across all areas with you?
Yeah, I guess the good and the bad is there really isn't. Each one of our segments will have some maybe specific geographical competition, but nobody on a holistic national basis. That's the good news for us, right? We like that. The challenge is sometimes is a publicly traded company. Who do we compare to, and who are our peers, right? And how do we fit against comparables? Sometimes it's challenging.
That's great. Well, Andy's having a little trouble with his screen share, but why don't we just go to your question, Andy? Just start in with your questions, and then we'll bring up the menu.
So, Joe,
I was surprise Joe. We'll surprise Joe with our.
Sorry, okay. I'll pull that up in just 1 second. I was just curious if you could just maybe get down to some specific examples, brass tacks, when people think about data center build outs and your exciting infrastructure build out. Give us an example of what are some of the specific things that Sterling does, and the complexity around data centers that you are involved in that is maybe misunderstood or not as appreciated as much by the market.
Yeah, I think first of all, the market is right as we speak today over the last couple of weeks is grossly misunderstood. The demand let's start with the demand, right? First of all, the demand we're seeing from our core customers is greater than it's ever been. And we're in conversations on, do we have capacity? Will we reserve capacity for 27, 28 and further? But let's talk about the projects in more specific areas. If you take a look at what we do, everybody thinks, well, you're just clearing some dirt and they build a building on it. We're building all the underground. We start with a mountain in most cases, and we're going to make that a level field, okay, to put stuff on. We have to work with the end clients to fully understand what that end field looks like to reduce the cost ultimately for them and make the projects viable. And also to increase the speed of completion, because at the end of the day, getting these things done on time faster than anybody else is a core competency that we have, and we do it every single time, right? So we have to work with them to fully understand what does that final grade look like, and where's it going to ultimately be. And that's where we've really started leveraging a lot of technology with drones, along with some other technology, so that if you imagine a 300-acre site that's a mountain, and we say we're going to get it to a grade of 27 feet off the main road, and we're off 1 inch across 300 acres, we either have to bring in large amounts of dirt to fill that, or we have to export thousands of dump trucks to get that right.
Wow.
Everybody else, very few people are using this level of technology to where we can get it to the gnat's ass, technical term by me, right out of the chute, okay? But also allows us to get the projects completed faster and deliver on time more effectively. The bigger the project is for us, the better. And, we have several examples where we've had sister projects running with other competitors, and most of our competitors are much smaller, where in literally 3 months, we will be done with the project, and they won't even be finished with their first phase, right? So the amount of speed and consistency that we can deliver, that's what we get paid for at the end of the day.
That's great. Thanks, Tom.
I'm going to execute a screen share here that might be it might not work, but we're going to try for it. So here we go. Are you able to see that, Joe, on your screen? Are you able to see a collection of numbers and your company name?
Yes, I am.
Okay, so this is our Moneyball database. It is an AI-powered scoring system that our AI engineers and analysts have worked together to score aspects of public companies. I have just drawn Sterling out, but this is a database of about 3,500 public companies. So as we're looking down these, I just want to hear if you want to reflect on any of these. You need not reflect any, and particularly love it if you want to challenge it and say, hey, we're doing better than that. This is, again, comparing you to all other companies. We can draw it out and just have more industry level comparisons, but these scores are up against 3,500 companies. So your super score, which is the unifying score across all of them, is the 78th percentile across all 3,500 companies in the database. Your financial score is the 90th percentile. So you're one of the strongest companies in terms of your financials in the public markets. Rounta is actually a financial formula, return on unlevered net tangible assets. It's essentially exploring how much pre-tax operating income you can draw out of your physical asset base. I believe Buffett has said in past shareholder letters, he likes to find companies above 25%. Your Rounta is 57%. GAPTA is goodwill as a percentage of total assets. So it's showing that you've got, a measure of goodwill on your balance sheet because you've been making acquisitions. And we'll talk a little bit about that later in the hour. And again, you don't even have to reflect on these scores at the end, Joe. If you're like, oh, it's interesting, I have no comment. But if you'd like to, your leadership score, and we're kind of looking at the person right now, is in the 95th percentile. And obviously that reflects you, your management team, and your board of directors. But you're in the 95th percentile among all public companies in leadership. Your product is in the 71st percentile across all companies in the public markets. I mean, we can, and tech is 55th percentile and AI is 32nd percentile. Again, you're stacked up against Nvidia, right? So there, and so, what's the proper comparison? It would be better to look at that at the industry level. And then the surge score is just stock price. I won't go into that. And then GARP is growth at a reasonable price. It's kind of a valuation metric that we have in Prompt. So is in the 95th percentile. It's saying that your company is quite attractively priced right now, particularly with the stock having come down. So I don't know if you have any reflection on any of those. We didn't show you this beforehand. So what rings true or not?
Let me give you a couple comments. Not surprised on the very high financial score. Philosophically, one of the core things for us as a company is we focus on margin and cash flow. That is our number one thing. So many people talk about revenue. I have this simple belief that if I'm focusing on margin and cash flow, I will ultimately end up in high growth markets, because you don't usually get real good margin and real good cash flow in commodity markets or shrinking markets, right? So as we run the business as a very entrepreneurial, decentralized company, we're always challenging our people and our teams to find what can we do with our assets and our skill sets and capabilities to move up the value chain to make more money on that piece of equipment or with those people. And that's how we actually went from just simple warehouses 7 or 8 or 9 years ago with our e-infrastructure business into data centers, and why we're going towards semiconductors and why we're going towards onshoring, right? These are highly value added projects that require highly value added services, which we can deliver and continue to grow those margins. Most people don't believe we can continue to grow our margins. I will tell you, we will continue to grow our margins as a company, certainly in e-infrastructure, and we believe in transportation solutions as well. It's just that philosophical drive in how we look at everything that we do. What'll be interesting is go ahead. I'm sorry.
Oh, no, please keep going.
It'll be interesting over the next couple of years to take a look at the technology and the AI score. We believe that if you take a look at the infrastructure spend over the next 10 years and the number of people coming into this industry, they're diametrically opposed. We are working really hard, not only from training centers and development of our people, but what can we do with technology and AI ahead of everybody else that just gives us another competitive advantage that builds further capacity and capabilities that the other players will not have.
Thank you for that. And I was sorry to interrupt you there. I was just going to mention that, obviously you were not a 90, not that we didn't have, this scoring system is 6 months old, and we're refining it each quarter with new filings and new data sources, new APIs, and the ability to just sort of more comprehensively cover public market companies. And we'll actually be adding international markets as well. But certainly your 90 financial score was not a 90 when you joined in 2015. Right. If we had that database back then, where would you guess the number was in 2015?
We may have been a 0. I don't know if that's possible, but we were pretty close. We were borderline bankrupt at that point in time, and so we had to do a complete turnaround and then a transformation. And one of the I guess interesting conversations I had with the board early on is once we get this company turned around, one of the things we are going to do is transform it, and we're not going to ever look back to what we were in the past. And it's worked out really well. And at that point in time, our stock price was $3 a share. So we 3 to 200 is kind of our range, a little over that. It's been a fun run.
What was the catalyst for you to join? Not many people would like to join a winner. Like, I'm so excited that I've been recruited by this amazing business, and now I get to take it to the next level. Why join a near bankrupt company at $3 a share?
Yeah, well, interestingly enough, I had done multiple turnarounds in my past life, and I said I would never do another one. I was working on high growth businesses. I really like growth, and the chairman of the board, who was parachuted in to be the CEO, is one hell of a sales guy. We've become very close friends even since then, and convinced me that I had one more turnaround and I was the right guy to get it done. And I was a little bored at the time, so it all worked out. It worked out really well. So, yeah.
Thank you, Andy.
Joe, just carrying along that line, it's a fascinating story. How do you culturally get your team set for hard decisions that would be required when you're in that kind of a turnaround spot? And what did you learn about that going forward in now managing a very successful company?
Yeah, I think the key thing is when you're in that position, you got to have a vision to where you want to go. And at first, nobody believes that vision, in fairness to them, right? They're in a struggling company. Having a burning platform actually is a help, because at least you can do what I call an IQ test. The people that realize they have to change are going to make it. And those that are failing and don't believe they're going to have to change, you can quickly move them out of the organization. Mm-hmm. And we had some really good people, just really bad strategic decisions in the company over time. So the effort was to get the good people on board as quick as possible and prove to them what we could be, and then get them aimed and let them do what they're really good at. We weren't, as I always say, we're not going to ever be making iPhones, right? We're going to do what we do, maybe in very different markets, but what we're really good at, how do we continue it? And then we run the business very differently than really pretty much every other big corporate entity that I know, public company. When we buy businesses or we bring in people, we're looking for entrepreneurs, and we want them to run their business. So we are very decentralized. We help them with strategy. We help them with kind of planning to understand what will help make them be successful. We set very lofty goals for our guys, but we pay our guys a lot of money when they hit them. They get a lot of stock, and that's been very beneficial. So when I first got here, I could not get a person in our company interested in one share of stock. Okay. Now I have people begging for stock. As a matter of fact, I have people sending me messages that are buying stock to make sure they can go buy it. Right. It's very exciting to see when you get people focused on an end goal that's tied to the stock price, which is tied to financials, how fast an organization can move there. And we have a kickoff meeting every January with our leadership team, and we put a big number out there on where we're going to get in the next couple of years. And I can tell you we've beat it every time, right? So
that's outstanding. Thank you.
Sorry to do this to you, but I would love it if you would go back to each of the segments of the business and give us a brief case study on a project.
Yeah.
And
So
a recent project, how the process, the completion, any other factors you'd like to add?
Yeah, so I'll start with the easiest, simplest, and smallest projects, and we'll work our way up to the big ones. Okay. So in our building solutions business, very small projects. Our average project size is $25,000. Right. So to do several hundred million, we're doing a lot of slabs. Okay, to do that, and what that is really about is how fast can we get those slabs done. And these large builders, D.R. Horton is an example. We did a time-lapsed video, I don't know if it's on our website or not, of a development, right, over 30 days. And it literally starts from field to blocks of houses, over 30 days. You just see them building up. So as you can imagine, as they're building them this quickly and these rates and these numbers, if we're behind, now you have all the trades backed up. In all of our businesses, and we'll talk about the infrastructure, but if we're behind days or weeks, it could take the project over weeks or months or even further, depending on the type of project, right? So those are the simplest things. In transportation, the vast majority of our projects, well, I'll give you actually kind of a fun one, are design build or progressive design build, something that is complex where the process is all about how you're going to do the project, what it's going to look like, and then how fast you can execute it. So we just finished a project in the Kwajalein Islands of all places, right? That was an airport aviation job. And to kind of put it to the complexity and how good these teams are, there's nothing in the Kwajalein Islands at this particular base that could support our people, okay, to house them. We had no equipment over there. They had no equipment. There's no material there. So we literally have to barge rock from Canada to the Kwajalein Islands. We have to get oil from the West Coast to the Kwajalein Islands. We had to develop and set up a barge that we put our people on. We had to actually dig out the port so that the material could be delivered. And we delivered that several months ahead of schedule, right? And that's kind of a little bit unique project, but shows to the importance and the complexity and the abilities of what our teams can do from a planning standpoint versus just going down the road and digging a ditch and putting some pipe in, right? Type thing. On the e-infrastructure side, one of the things we didn't talk about that's an advantage to us is we're highly vertically integrated. Okay, so most people will move dirt, or they'll blast, or they'll do utilities, but nobody does all of that stuff. We do all of that stuff. And one of the things that gives us, so picture a 400-acre site that's a mountain, okay, and we've got to take literally the equivalent of 2 Mount Everests and get rid of that, make it flat, right, over the course of 400 or 500 acres. And that starts with blasting and then moving, crushing, and getting material all in place. But one of the things that gives us a unique advantage is if we were to subcontract blasting as an example, and I'm a blaster, I'm going to come in and I'm going to blast the biggest pieces of rock that I can because that's quick and it's cheap, right? We actually designed the site we designed the blasting pattern around the site requirements. In certain areas of a site, you may need rock that's 6 inches or smaller. Some areas of the site, you may need it smaller than 3 inches. In other areas of the site, you can leave big boulders because nothing's going to go over it, right? Most people will take the biggest boulders and then they set up crushing operations, crush all of it and bring it back. So you end up moving it from the front of a 400-acre site to the back of the 400-acre site, crush it, make big piles, later on move it back to the front of the site. Well, not only does that cost you money, but it takes a lot of time. We'll actually come up with blasting patterns so we could actually blast 70 or 80% of the rock in place. So we may use 10 times as much explosives or put them much closer together so that we end up with 6-inch minus rock in that area. We don't have to dig it out. We don't have to move it back. We don't have to crush it. We don't have to bring it back. Also on that site, every day we have a drone flying that site. So not only do we have project management on site, but back in our headquarters, we have people watching those projects, making sure that everything's on time, everything's sequenced perfectly. When I first looked at the business, they told me something, and I honestly thought they were full of it. Okay. They said, just to give you an idea of how planned and how sequenced these projects are, if you get to see one, they're fantastic. It's like a ballet of yellow iron. The stuff moves and crosses at the same time. They said every 17 seconds, that truck will get loaded and moved. And I said, you're full of shit, right? So I got my watch out and I'm timing it. They were within a half a second. I mean, it was just one. And then 20 seconds later, another truck pulls up, boom, it's filled. And it was just, that's the level of detail that we get into that I would challenge that you find in anybody else doing this sort of work. We've taken basic work and sophisticated it with technology and kind of tools and metrics to where we become highly effective and highly efficient. And that's why the margin differential that we see is we get paid a little more because we can do the big jobs faster than anybody else. But we make a lot of that up in these technologies and productivity and how we lay out these projects to really get that incremental margin through the course of the project. I don't know if that helps you.
Oh, it's great. Yes, thank you. And I'm just curious, you had mentioned the difference between subcontractors. So those are all sterling people. You don't really subcontract any of that out, and that's your culture and your people.
In e-infrastructure, now if we get too far away from our base, we may sub out some of the utility work. But everything else, we're doing in transportation. On these progressive design builds or design builds, we tend to team up with 2 or 3 other companies. So we take what we call the best of the best. We will team up with somebody that may have pits and quarries, so we use their rock. If somebody is really good at white paving, we'll use them to do all the white paving. We prefer to do the bridges and some of the dirt work, so we'll tend to do that. And then we've got the best of all worlds, right? And we're not trying to, as I say, one of the things that the business was trying to do in transportation at the beginning is every location was trying to do the same stuff. And some are really good at bridges. Some are really good at, white paving. Some are good at something else. And we went back to our core competencies and make sure we subcontract the others. But in e-infrastructure, we're managing that ourselves. Yeah.
That's excellent. And Joe, just if you could give us some insight into the sales process, about how long would something take? Who are you primarily selling to? Who are the core customers across the different divisions you make? And you can just use one example, but I'm just curious on the length and the process of the sales cycle.
So we'll talk about e-infrastructure, and this is what we try to help people understand. First, we really don't sell. People come to us. And we get it from two areas, from the end customer. So it could be one of the mission critical data center companies. One of them we're extremely close with and do a lot of their work. And what they'll do is they'll come to us, and in a lot of cases, they'll come to us 3 or 4 years in advance. And they'll say, we're looking at these 2 sites. Could you give us a rough estimate on how long it's going to take and what it's going to cost? Okay. And we'll do that. And even our e-commerce distribution companies do this a lot, right? So we'll say it's going to take this one's going to take 6 months and cost you $120 million. This one is going to cost you $50 million, but it's going to take 2.5 years to do because there could be wetland permits. There could be all kinds of other complications, right? But it's up to you. And then we don't hear anything for a long time. And then there's a couple times in the year that they generally are starting to release next year's projects, and they'll call us and say, remember Project Delta? I like to tell you we remember it, but we got a database. So somebody looks at the database and says, oh, of course we remember Project Delta, right? And they'll say, okay, we'd like you to reserve capacity in the 3rd quarter of this year, finalize pricing in the 2nd quarter for us, and be ready to go on September 1st, right? So we pull that out. We go back to the site. We finalize what we think the rough estimate of the total project is going to be. We give them the first phase pricing, and we move on, right? So it comes that time. So the thing that people don't understand is not only on these projects are they multi-phase, multi-year, and one of the things we keep talking about is we have backlog, and backlog's important, but we also have what we call future phase backlog. And that's other work that we know that's going to happen on that site that hasn't been released yet, but they're going to spend that money. So if you look today, we have over $1.5 billion, going to be close to $2 billion by the end of the first quarter of backlog and future phase work, which will be 26, and some goes into 27. And we're seeing activity on projects, looking at land and giving kind of rough estimates for stuff in 27 and 28. So I hear everybody saying that, data centers are at the peak and I'm just telling you, our customers are not saying that. And we have not seen one bit of that take place. So we're really excited about the next 3 to 5 years in there. But what's more important to us is if data centers slow down and chip plants pick up, or onshoring comes back as fast as we think it's going to, we don't care. If it's big, it's the same thing to us. So this fungible assets, as I call them, is the greatest thing, because we can keep moving them to where the money is. And that's our philosophy.
I'm going to do another screen share here. This time we're about halfway through. Joe, thank you very much for this time. And to our members, just reminding you, you can ask questions. That's queuing on the information scrolling at the bottom of the screen. You can ask a question and be a part of this conversation at any point. Okay, here we go. We're going now to Sterling's 10K. And I'm just going to bring up the income statement. Then I'm going to bring up balance sheet. Then I'm going to bring up the cash flow statements. And I just want you to call out something or teach us one thing that we're looking at, something, some highlight you see, or something important, some cue or reminder for investors to pay attention to this. But here we see years ended 2024, 2023, 2022. What jumps out at you on your income statement? Well,
we look at, one of the things we're really proud of is the last 4 years, we've delivered bottom line growth of over 35% a year, right? And close to 40% several of those years. So I tend to not get hung up on the revenue. I say I don't care. I care about profitability. So if you look at our margin trends going up, we've been able to maintain SG&A as a whole, and our profitability just continues to outpace the growth of our revenue. And what I think people don't realize is every time you grow the bottom line faster than the top line, you are reducing the risk of the company. And you're doing that because you got more stable income coming in versus going and growing revenue where I need more capital, I need more people, I need more cash to support it, right? But everybody seems to love to do that. I personally would rather have more cash flow come in, see our balance sheet continue to grow, our net negative debt continue to get better until we find the right acquisitions to put that in play with, or buy back stock when it's low. That's kind of how we run the business in my philosophy.
Excellent. Thank you for that. Now we come down next to the balance sheet. What stands out here on your balance sheet? We see, a company with 660 million plus in cash and equivalents. We see a company with about 290 million of long-term debt. Current portion would take it over $300 million. So 2+ times more cash than debt. Maybe there are other things you'd like to call out. What do you see that you can teach us about on your balance sheet?
Yeah, no, I love the cash to debt ratios. That's a great one. And there's some cash flow we've continued to throw off, and we feel very confident we're going to see that trend continue into this year. The other thing that I always look at that's very important to me is that our billings in excess is growing, and our costs in excess is shrinking. And that just means that I'm able to work off customers' money more effectively than off my own money.
Mm-hmm. Thank you. Now we'll come down to the cash flow statement and close out this MBA class moment with the CEO of Sterling Infrastructure, Joe Cutillo, walking us through STRL's financial statements. Here we are with the cash flow statement. What do you have for us here?
I think everybody would like to have our cash flow statement. So, again, we focus very heavily on cash flow. If you don't have cash, there's not much you can do with the company. There's a lot of businesses that have gone out of business with great, quote, profit margins, but no cash flow. So our philosophy is we should work off customers' money. We shouldn't be working off ours. We've been very prudent in capital allocation. If you look at what we're able to do and only spending around $65 million a year for a business this size, and if you take into account in our e-infrastructure business, our average piece of equipment is probably around $700,000, $800,000 a piece. So we've come up with a very effective model that's a combination of buy, lease, and rent, and it's worked really well for us. I'll tell you, when I got here, we believed we needed to own everything. We don't believe we need to own everything today.
Thank you, Andy.
Joe, just quickly on that cash flow statement, you talked a little bit earlier about how you have people calling you or asking you for stock now. How do you think about stock-based compensation? We follow a lot of tech companies, which it is used excessively. You have a very reasonable amount of stock-based compensation, as we just saw. But are your employees asking for more stock these days? Just talk about the balance of how you think about using stock-based compensation as incentives.
Yeah, we not only are we being asked for it, we're using it more and more. And this is a challenge in our space. We have to also work with the outside, I call them comp consultants, to help them understand the value of the stock piece in a more non-traditional comp plan, right? I think there's the cookie cutter comp plans. We have very non-traditional comp plans down in our business units. Our guys can make a lot of money if they doubled their business in 5 years based on stock, and then they get the appreciation of that. So it's we love it. We think it's highly effective, highly motivating. We have a lot of people that have made millions of dollars, and every time I hand one of those checks out or hand that stock out, it's the happiest day of my life, because we equate that back to what we do. And I tell people, without getting into how we compensate people, it's really simple. For every $5 you hand me, if I handed you $1 back, I'd want to hand you as many dollars as I could, right? And if that dollar is included in the 5, so you really have to hand me 6 to get $1 back, I win every time. And by the way, you're happy because you're winning and we're winning. That's a simple way to look at how we've structured a lot of the comp plans for the key leaders down in the business. So they want to deliver as much as they can, and we want to deliver back our fair share.
That's well, you get paid in amount of stock yourself, so I'm glad to see that you continue to deliver on that on that expectation.
About 80% of my compensation is performance based, but we've also done a couple stock based programs to hit targets of EPS and share price, actually. And I will tell you, it's been extremely effective for the management team.
That's great.
One of the pieces of guidance I give to our members in investing is try to align your time horizon as an investor with the time horizon of the CEO of that company. And there are a lot of rapid turnover companies. I mean, there are low quality companies everywhere. There are promotional things, and people take companies public after 18 months, just taking advantage of and getting pushed into public markets by VC or private equity. So there are a lot of bad and mediocre scenarios. But if you find a great company, and you should attach your time horizon to the time horizon of that CEO. And if you're going to find a great company, that CEO is going to have been at Sterling Infrastructure since 2015, right? And is going to be talking about what are the next 10 or 20 years forward, right? And thinking about the company in that way. That similar things you'd hear from Jim Sinegal at Costco, and Jeff Bezos, basically planning 10 years forward at Amazon, to the point where they felt that they knew what the earnings report was going to be 3 years in advance of it at Amazon. So I'd love it if you'd speak to our members about going through a period here, short term, where the stock goes from 200 to 120. And what that does, what you think about, like, obviously one point on the continuum is I don't even pay attention. Another is, no, I pay attention, this and that. I get these signals, I'm learning it. But it certainly isn't for a long-term CEO like a tough moment as to whether or not to stay employed at the business or to continue to own the stock that you have, right?
Yeah, it's funny. When we took the big dip, I would tell you, I had a lot of friends call and say, are you going to jump off a bridge, or what's going on? And I'm like, for the first couple of days, I didn't even watch it, right? And my answer to people is this: I'm not looking at $200 a share. My expectations are much higher than $200 a share. So when people ask, are you worried about getting back to 2? I say, no, I'm not worried about getting back to 2. I'm worried about getting back to where I want to be, or getting to where I want to be. So two isn't in my sights. Okay. We'll get there. The market will correct. People will realize we continue to deliver the results I feel we're going to deliver, and the markets are going to do what I believe they're going to do based on what we've seen. We'll get back through that. This is a temporary setback. I bought, it's public knowledge, I bought $1 million of stock last week, I think it was. If it stays down, I'll probably buy some more at some point in time. We're confident in what we know, where the company's going, what the markets are giving us right now. And my sights, I can just tell you, my sights are much higher than $200 a share.
And what are the impacts now of, changing dynamics in regulation, new administration? What are any pluses or minuses for Sterling Infrastructure in what seems like a pretty dramatic shift? And obviously, the tariffs and negotiation and a lot of uncertainty around it. What's the impact on you in at least an intermediate term basis?
Well, I think the perception is there's going to be a lot of impacts. The reality is, and I just talked to some of my friends that are CEOs in similar businesses and other spaces, and we've all said the same thing. We just went through COVID, where we were seeing 30% increases in inflation on a monthly, quarterly basis, right? Something we have never seen before. If you look at the prices that we were paying for materials in COVID, and you look at them now today, if the prices went up 10, 15, 20% because of tariffs, we're still nowhere near what we were fighting from the peak of these material costs. Okay. So this is like kindergarten compared to what we went through. This, and it's not to say we won't see it. It's not to say you can't see a couple months of pain as you get your contracts updated or you get to the new projects. But we managed our way through that pretty well. As a matter of fact, much better than I would have thought the world would have managed through it. So the reality is, if our material costs go up, we're going to pass it on in pricing. You have that interim of time in some of these contracts before the next phase starts or the next piece starts, so you might get caught in it. But a lot of our materials, first in our transportation, our steel has to be made in America anyways. So it's been made in America, has to be made in America, all that stuff. People talk about rebar. Well, we do get it from China, but we can get it from Turkey. And there's other places we can get it from, right? So it may not go up 25%, it may go up 3%, right? Or 4%. What I always worry more about is availability. We can manage inflation and prices. If you don't have products, that becomes very challenging, right, to get stuff built. So we'll get through that. I think, we're all caught a little bit in the tailspin of there's so many things going on, whether it's tariffs or everything else. The market doesn't like uncertainty, and they're trying to figure it out. And sometimes they overthink it. Sometimes they underthink it. I just think there's a lot of balls up in the air. I will tell you, we've spent very little time internally worrying about or having to even come up with any sort of planning around the impact on us, frankly.
It's really interesting thinking this in the context of a concept I really love from the writer Nassim Taleb, who wrote a book entitled Anti-Fragile. And essentially the concept of anti-fragile, not to spoil the whole book, it's a wonderful book, is, at one end of the continuum, you're fragile. You're a vase that holds flowers. If you're dropped on the ground, you break. You have really only one use, right? It's a limited function, and it's a fragile. It's risky in its environment. You think the opposite of that is resilient, but resilient isn't the opposite of fragile. Resilient would mean you drop it and it's fine. It bounces back. It's fine. Anti-fragile is you thrive on volatility. Mm-hmm. So each time a business goes through the complexity of the pandemic, I also think of the writer Peter Drucker, who said, I basically love to find companies that have gone through some hell, because they're going to be able to, they know the ones that scare me got born into a beautiful environment. Everything was rosy for them, flourishing, and then they get hit for the first time, right? So it's quite interesting to hear your context on this, because it's obvious, hearing you express it, it's obvious that the pandemic was a much greater challenge than the levels of uncertainty right now. That's
what we believe. We actually believe that if this continues, we think there's huge upside for us. All of whether it's the car manufacturers or pharmaceutical, everything's that's all work for us, right? So we don't care if we're paying $2 a gallon for diesel or $10, the work's still going to get done, right? So unfortunately, the cost of that project may go up 10%, but we're more worried about that work coming, right? That's good for us. We're less concerned about the cost of that particular material.
Joe, just reflecting again back to your balance sheet, then my follow-up question. It is pretty incredible that this year you have more cash on your balance sheet than you have property, plant, and equipment. It's the first time that's been that way in a few years, and that is just really for a company that relies on that property, plant, and equipment. That's pretty incredible. And my follow-up question is, as you think about geographic expansion, different areas, just talk about some of the complexities of transporting and using and sourcing all of the goods that you have to use to do all of those things you explained to us earlier on today.
Yeah, it certainly gets more complicated the farther you go from home, as we say. And, we've got a great partner with Caterpillar. We're big customers of theirs, and we've got some great programs in place to get equipment where we need it, when we need it. So they've been really good to us. But what really, it's one thing. There's really two elements, and people don't think about the second element, which is the people side. We can move equipment, we can haul it. There is a range where it becomes less economical, right, and very expensive. Where it gets more complicated is if we're on a project for 12 months, let's just say, those crews we send there, the superintendents, the people, now some rotate, but they're there. And now they're not going to stay there for 12 consecutive months. They have families they got to get back to. So we have rotations and we send them back and we do all that. That's where it starts to get really expensive. If they're a 3-hour drive or a 4-hour drive, it's not a big deal. We can give them Friday afternoon off or have them come in Monday afternoon. If they're halfway across the country and we got to put them on planes and get them back, the logistics, that's what people tend to forget, right? That sort of piece of it is what really drives a lot of the economics as well. Yeah.
And Joe, are most of the people Tom had mentioned about 3,000 employees, are they mostly in Texas?
No. So believe it or not, the least number of people we have is in Texas.
Oh, okay.
So southeast through the Rocky Mountains, in northeast, east coast, Rocky Mountains are really the two biggest areas. About 50% of our people are union and 50% are not union, roughly.
Okay, great. Excellent. Thank you.
We have about 10 minutes left, so we'll go with some rapid fire questions. Feel free to be superficial in your answer, although I know you'll deliver some great lines like the gnat's ass. That was one of your phrasings here that our producer behind the scenes said, I want to listen to a podcast titled The Gnat's Ass. But I also loved, a lot of great one-liners like the ballet of yellow iron. Come on, what a great expression. And even the simple one, we don't sell, people come to us. So I'm sure you'll nail these, but just want to let you know you can move quickly through them as we just get some final firework questions out here. What companies do you admire, either in your category or not? This actually has helped us investors to ask this. So it's a very selfish question. For example, I asked the executives at a company called Wix what company they admired, and they said how much they admire ServiceNow. This would be like 6 years ago. So then I really hadn't looked into ServiceNow, went, looked at it, recommended it. It's been a great stock for us. So this is not you recommending any stocks. You could call out private companies, but what companies either in your category that you interact with or just in general life do you admire?
Yeah, I think two companies that probably run their businesses the closest to us are two companies that are in the specialty infrastructure, Comfort Systems. I think they run a very entrepreneurial, very solid business, and have done a good job sticking to their knitting. I think far too many companies just go and buy companies. We've been very disciplined and regimented. They have as well. and then Quanta. And from a standpoint of Quanta, started out as a small, very entrepreneurial, a lot of acquisitions. They're a behemoth now, but they were able to maintain that for a very long period of time as they've grown. And both of them, one of the things I'm most proud of, and it will never come out in a statistic or anything else, is the owners or the people that were running the businesses when we bought them are all still there. And I think both of those companies have a very high track record of that. I would tell you the vast majority of companies have a very low track record of that. And that just goes to the culture and the values.
Yeah. I mean, two out of three acquisitions, I think, don't deliver on the original goals of that acquisition. So another rapid fire one. What are the basics of your acquisition playbook?
So absolute number one, we don't buy businesses, we buy people. So, one of the things I do that's absolutely critical is before we even talk about buying the company or going any further, I've got to have dinner with the owner, and hopefully that's the founder, the original founder. And in the first 30 minutes, if their values align with our values, I can usually tell that, and we're very excited about the deal. The financials, the strategic fit, everybody talks about, that's really easy. I mean, I can hire 8th graders to do that stuff, right? That's pretty simple. It's the cultural fit and the what really drives that person. They've got to love their people as much as they love making money in their company, and those are two very high success factors for us. Yeah.
Even though I'm hungry to keep asking questions, we turn it over to Andy, who's hungry also, and we go with a few of his, then a few of mine, and then we'll wind it down. No,
Joe, I just want to get back to the acquisition side. Is the balance between cash and stock for acquisitions your philosophy there?
Yeah, acquisitions number one, no question about it. Best return we can get, maybe with the stock low. I mean, we can get some quick returns, I think, with that. But is a general statement, acquisitions are our number one focus and the best return for us. Yeah.
Andy, you got another one?
No, Tom, I was just going to say, Tom, go ahead if you got one.
Okay. What would you say is your playbook on a great turnaround? So imagine that you now have, for the fun of it, we'll simulate hypothetically, it's 17 years from today and you've retired. We'll be unhappy about that when that happens. And maybe it won't be 17 years, but you've decided to spend your life investing more and more of your time investing and looking for companies that look like Sterling Infrastructure did when you happened upon it. Obviously, that's a deep turnaround. So it might be hard to see that as a passive, many arms length away reviewer. But what's the playbook and how would you find a great turnaround?
Yeah, turnarounds are much less complicated than people think. It's, I call it not being really smart is a good thing sometimes. And the Guido Sarducci school of business is important.
Oh, some old school SNL references.
Stop doing what doesn't make you money and do more of what makes you money as you find other ways to make even more money. It's really that simple. I guarantee you can go to the vast majority of companies, and if you did a Pareto analysis of by customer, by market, however you want to do it, okay, 20% of their work is making them 80% of their money every single time. So that bottom half, stop doing it. Just stop. Don't listen to people. They'll tell you why you have to do it. They'll give you all the excuses on why this is critical to the company. Stop doing it, right? Mm-hmm. And go find stuff that's better than the best stuff you have today. And it's amazing how good you can make a company in a short period of time.
I'm going to bet that you've read this book, but if not,
just going to say
you're looking for some pleasing reading. It has kind of a cheesy title, but
I have not read that. Yeah, no, I have not.
Okay,
double your profits.
Double your profits in 6 months or less. Bob Pfeiffer, he was the chairman and CEO of Kaiser Associates. I'd say it has a cheesy title to it. There's a great investment book with a cheesy title entitled "You Can Be a Stock Market Genius" by Joel Greenblatt. There is a reason he had to come up with that title. It's pretty funny, but overall, that is a wonderful book on special situations, turnarounds, how to find kind of the alternative outliers in the public markets that people are missing and not realizing it's a great long-term investment. But this one is from an operating leader, obviously not kind of a cheesy title all in all, but essentially what he is saying, two of the things. The first one you just said, like, do what makes you money, stop doing what doesn't, and be very honest with yourself about that reality. And then the second is every single dollar in our organization goes towards our strategy. We don't ever have a happy hour that's a happy hour. We have a happy hour to try and figure out that problem. Like that's a Bob Pfeiffer view. Like every time we're going to do a retreat or everywhere we're going, we're trying to push our strategy forward. We're not going to waste dollars on things that don't play into what we're trying to achieve as a business. So sounds similar to your thinking.
Yeah, I'll definitely read that. That sounds great. Yeah.
Joe, leadership development. How do you have a development plan across Sterling that tries to identify and grow the next Joe Cutillos, or is it just more organic and it's people entrepreneurial?
We realize with the rate of our growth and the future of the company, this is where we're stepping back, and so we have succession planning, right? But we're really going back down to the bottom of the organization, to entry level people all the way up. We started for the first time a Sterling Academy, where we're running project managers, superintendents, and it's a 5-year plan to build this out. We're in about year 2. We've had, I think, 130 people go through, and you're talking about that. They're then assigned a project afterwards, and if they complete that, they get stock, right? So as part of the thank you for completing it, but it helps them with career pathing as well. We've just purchased some simulator equipment from Caterpillar. We're setting up an operator university on the East Coast. So not only can we start recruiting people that we can train, but we use it during the interview process to make sure people actually can run the equipment like they say they are. But we're also using it from a safety standpoint. One of the things we found statistically, and one of the things we're most proud of, is our safety rate is 50% better than anybody else in the industry, right? So we're like a 0.25 DART rate, and industry average is around a 1. So anyways, we use that. One of the statistical things we found is years 3 to 5, people become complacent and they get injured again. So now we can run them back through in year 3 and go through training and safety training and all that kind of stuff, so that we help people there. So we're really big on it. The next phase that we're really trying to do, and we're talking about technology and AI, is we want to make these jobs sexy for kids that like games and all that stuff, because our projects really are big games in some way, shape, or form. So how do we turn this project management into something you could do from I call it a NASA control center, running drones out on our job sites. And then you have the people that are on the site doing certain things, but now I can have oversight with a different level of oversight over multiple projects. There's some really neat stuff that we're doing with that, and we're at the early stages, but I'm excited on where that goes. And I can now take that to a high school or to a junior college and get people that would never come to our into our field and excite them about being part of what we do.
Thank you.
How important is it to you who your institutional shareholders are? You could say, not at all. I mean, I love them. I love they own our stock. I have our quarterly conference calls. Or you could say, oh no, some of the ones we've attracted are very helpful. They make a lot of great suggestions. I hear their thoughts. They know the category. So is it consequential to you to look through your institutional investor role? And if so, what are you looking for?
Well, it certainly has evolved. In 2016, we had a lot of bottom feeders. And we were all or nothing bet at that point in time, and they've all did really well. We spend, I would maybe answer it a little differently than maybe by a type of investor or breakdown. We spend a lot of time with our investors, probably much more than people would ever imagine. Okay, and their feedback is always valuable. They'll never align 100%. Don't get me wrong, right? People say buy stock. People say do this, give a dividend, and all that. But what's good is they all have opinions and feedback. And I will say sometimes we come back after a conference with them and say, we should really think about this. We heard this from 6 different investors. We haven't really thought about that. Maybe we should think about that, right? But it's also, they're a very good sounding board for us when we're thinking strategically of where we're going next, where we can kind of throw some things out there and get the immediate reaction, right? Like, hell no, that's a terrible idea. Or that's really interesting. That would help you in this way. And so we use it both ways. So they're of value.
Well, as an investor, albeit a small investor, I'm going to be bold enough to suggest that I have an idea that could be helpful to you. And then you can just kick it to the side as one of those. Yeah, thank you very much. But what we've found at the Motley Fool at this point is having essentially a board-like group of AI engineers that are truly cutting edge. And we basically have built an AI-powered tool to find that talent around the world, because it's harder and harder to find in certain spots where Google and Microsoft are gobbling it all up at, very high prices. But basically that AI panel looking at our business is telling us all of the different opportunities there are for us. So I don't know if that would ever have any relevance to you all, but I'm finding it's almost like another board for me, because it's hard to get a board that's cutting edge. You're going to have different roles on that board.
No, it's interesting you say that, because we've been we're early with a couple universities to kind of bring their thought leaders and do something similar to that, right? Take a look at our business. Here's some of the things we're thinking. How does that evolve? I think that the learning for me with AI, and I, by the way, I can't spell AI. But here's the thing I do know is I sit on a board of engineering at a university, and every one of those kids is using AI every day. So when I hear people say, well, AI is fake and it's not coming and it's going away, they're dinosaurs. I believe, and I'm a dinosaur, right? If I can get in my computer in the morning, I'm happy, right? The first shot. But it's coming, and these kids are using it, and if they're using it now, they're only going to expect to use it more and in more ways than we can even imagine today. So I think that's an interesting thought, because again, that's not our expertise. We know there's something there, but we're not even smart enough to know what it is. Frankly, I'd like to tell you we are, but we're not, and that's where we're trying to explore this stuff. We're humble. We'll gladly admit when we don't know something.
Hey, we're fools. We're fools. So we have used up more than 1 minute of your time, but maybe one last question for Andy, one last question for me, and then we're out.
Sure,
Andy.
Well, I'll just do a little bit of a fun one. I believe you're located in the Woodlands, Texas,
yes,
near Houston, and our Macri, our producer, is from Houston, and so he sent this one in and said, "It's a hot button debate in Houston. What are you doing with the Astrodome? Tearing it down?"
I don't know that they'll ever let it get torn down, but no one's come up with a solution on what to do with it. It's certainly a cost, but this time of year, if he's from Houston, he knows this next couple of weeks are rodeo week. So there's a lot of people in and around that Astrodome right now, but even for rodeo, they don't use it for anything. So
incredible.
Yeah.
Thank you, Tom.
My last question is an unfair one. So it's the thought bubble above my head. It's like the equivalent of the elephant in the digital room. It's Joe saying, when we make an acquisition, it starts with the people. I'm going to sit down and I'm going to have dinner with that person. I'm going to understand if their values align with mine. And then I'm really excited to go for it, and we'll figure the numbers out. Now I take that to this situation with us as Sterling infrastructure investors. Actually, if we had our AI databases years ago, I believe we would have found, I think I might have had a shot of finding Sterling infrastructure from some of the methodologies we were developing. We didn't. So here we are. We get to make our investments. Your market cap, $3 billion. You're talking about what you're going for in the future. We're very excited to be shareholders. We're very long-term in our orientation. So there's one thought bubble above my head, which is the people point you had about acquisitions. What if Joe leaves? What happens when Joe leaves? Because Joe is like, we know Joe's a humble guy, and Joe's not going to overplay, the role that he's had at the company, but it was a bankrupt business, before you arrived. What process do you put into play so that your belief and practices are advanced and you don't end up with the next leadership team that comes in, or two leadership teams later comes in and says, we're going to own everything. We're not going to lease, we're going to have a lot of businesses that underperform. That's okay. Whatever the components are, the other elements of financial mismanagement that existed or got the company to where it was. What happens when Joe leaves?
Yeah, well, a couple things. I think first, I hope I'm not leaving anytime soon, but you never know. If our stock keeps going, maybe the board will get banked. No, they won't. We have a great board, great relationship with the board. And where I want to start is I think first and foremost, the board fully understands the value of what we built and how it's run. So I think there would be tremendous pushback from the board if somebody did follow me and wanted to go another way. That's one. But two, we're a public company, but I treat this like it's my company. And I'm not going to bring somebody in that can't take this 10 years further than I did. And what's really interesting is, we look at a lot of deals and people say, why don't you do this deal? And why don't you do that deal? And I tell them, I will not do a deal that I am not confident that 5 years or 10 years after I leave, it's still not a great business for us. Those are easy to get into, ones that'll be good to 3 or 4 years, but don't have the runway after that. And that's not my DNA.
Joe Cutillo, CEO of Sterling Infrastructure, ticker symbol STRL, market cap above $3 billion, cash flow juggernaut. We learned so much about how you think and about the company's priorities. And we walked through the financials together and had a couple good laughs as well. Thank you very much for this hour. And we look forward to connecting again in the future.
Great. Hey, I appreciate it, guys. Anytime you have a question, just holler.
Thanks,
Right on.
Joe.
Thanks.
And now we will be going to our next hour of Fool24 programming. And we've got Toby Bordelon coming on. And we've got Rachel Warren as well. That means it's going to be awesome. Rachel's outfit is almost matching the art on the wall up to her left side. I mean, only in the blur of the color do I see it.
I do my best. I do my best to color coordinate with the wall
You
art.
nailed it. Obviously, we have many things going on in our lives. So perhaps you did not see any of the last hour. But if you did see any of the last hour, do you have any quick reflections on it? If not, we just move on to your hour. I don't want to embarrass you if you're like, hey, just so you know, I mean,
I didn't know this company as well before going into the hour. I heard some of it. I'd like to hear the full interview. This is definitely one I want to put closer on my watch list. It sounds like a really interesting business.
Yes, indeed. Okay. Thank you for that, Rachel. Now, because I've seen Toby at so many member events over the years, I don't feel at all. I don't feel bad at all hazing Toby. Toby, did you watch the entire interview and take notes or not?
I did not, Tom. I was working out before this hour here. I
were
talked
working out? Okay, outstanding.
We were getting into the right mindset. It was all about the mindset.
Right.
I
I caught the tail end of it, and I do love that we can bring companies like this to our members. This is not one I had heard of before I saw that the interview was happening. So it's great to be able to see these, to hear from the people running the companies about businesses that we might not know about, and to bring them to our attention.
Yeah,
absolutely. And then even though we've already stolen 7 minutes from your hour, I apologize, but I'm going to steal another minute by saying, Andy, any reflection you'd like to have here before we sign off?
Yeah, I'm a little upset myself for not asking more a question about how they make decisions around the bidding deals, that process. But otherwise, so I give my own performance C-. But
I don't criticize yourself. Let us criticize you. I thought you did a fantastic job, Andy. I bet people would say it in Slido as well. I thought you did. I really enjoyed your questions. Thank you.
Tom was going to be like, let us criticize you. And I think it was a D.
No, it was.
You were too generous.
I'm between 96 and 98 for you for that hour.
I thought it was very impressive. I thought humble, honest. I loved so much of his answers around cash flow and profits, managing that business. That is very rare. You don't hear that a lot from small company CEOs that are just in the growth mindset. So I really respected that.
Yeah. And just for Toby and Rachel, I do recommend going back and watching the hour. I think you'll both enjoy it. He joined the company in 2015. The stock was at $3 a share. It was basically verging on bankruptcy. His basic methodology, obviously there's more complexity than this, but is, hey, let's stop doing the things that aren't going to make us any money and start doing the things that will. And they just keep moving their way forward in infrastructure towards the bigger and bigger opportunities, and find exactly what the customer needs are and make sure they can deliver them higher quality, faster, safer, but not less expensive. Higher quality, faster, safer for everyone. And so they're very much in building out data centers. That's a big part of their business now. Their stock has gone from 3 to 200, but has gone from 200 to 120. So we've talked a little bit about that journey from 200 to 120, which was interesting to hear his thoughts on it as well. But
still, really, 3 to 120.
40 bagger in 10 years.
That's the company you want to be investing in.
Exactly. And I think the good news is he's raring to go for the next, 10 years of the mission at Sterling. So ticker symbol STRL. Thank you for letting us take some of your time. I look forward to the hour ahead. Toby and Rachel, thank you. And Andy, thank you very much. And
thanks, Tom. Have a good one, you guys.
Tom, thanks, Andy. All right, my friends, we're moving into the 1 o'clock hour on the West Coast. It is 4 o'clock, of course, on the East Coast. Markets are closed, Rachel. That means markets are closed. We do have earnings coming in So this is the earnings hour. We're going to look at, well, honestly, whatever companies you want us to look at. Now, we had thought that one of those might be iRobot, but apparently they're actually reporting tomorrow morning, not today. So we're not going to be able to talk about iRobot's earnings report. But Viking reported earlier today. I think Casey and Stitch Fix do report after hours. So we can look at those. We can look at whatever others you guys want us to do. Don't limit yourself necessarily to companies reporting today. We can answer questions about any companies you want to ask us about on their earnings. Some of them we won't know well, so we'll give you our first impressions, but that's fine. We can dig in even more later. That's what we like to do here. Market had not a great day, Rachel. Today,
it was a tough one.
It was a tough one. It was another tough one. For a minute there, I thought it was going to be a green day for the Nasdaq, doing it, trying hard, led by companies like Nvidia and Tesla, even coming back from their lows today. But I couldn't get it done at the end of the day. That's all right. That's all right. Now you know what was actually interesting, Rachel, up relative to the interview we just heard. The Russell 2000 is actually up on the day. So the small cap index doing pretty well. So fools, if you're looking for bright spots right now, maybe small caps is where it's at. Maybe that's where we should be looking a little bit to find some of those consistent winners over time. Because hey, who doesn't want to go have an investment go from $3 to 120 over a decade, right? I mean, that's awesome. All right, let's get some questions, Rachel. Do you want to touch on one of these earnings companies quickly before we start looking here?
Yeah, I thought it might be fun to start off talking about Viking Holdings, ticker VIK. They reported, I believe that was earlier this morning, before the market bell opened, so 7 o'clock Eastern. So we've talked about this company a little bit recently, Toby. You know, they're a global experiential travel company. They focus on river, ocean, and expedition cruises, very destination-focused itineraries and cultural immersion experiences across all 7 continents. They have a very unique approach that's different from some of these other cruise companies that we talk about. A lot of it is built around, guest lecturers, music, art, cooking demonstrations, both on board as well as onshore enrichment programs. And Viking has done a really good job as establishing itself as a dominant force in the luxury cruise market, particularly in European river cruises. But they have, really significant plans for expansion in ocean as well as expedition cruising. And they tend to cater to a very specific target audience, largely individuals that are 55 and up who have, the time, the capital, as well as the desire to, explore the world on these lengthy and often, very expensive cruises as well. The company was founded back in the late 90s. There was a few things that are also differentiate the business. They don't have any casinos on board, so no casinos. And they also have a completely child-free atmosphere. So the design is that it's only for adults and often older adults. They also have a direct marketing approach. They source a significant portion of their passengers through direct channels, which allows them a closer relationship with customers and, more personalized marketing efforts. They have roughly 90 ships over their river, ocean, expedition segments. They have itineraries across 5 oceans, I think something like 21 rivers and 5 lakes. And again, there's that primary focus on destinations in the Europe and Mediterranean. So looking at their results, which they reported this morning, full year 2024, total revenue was about $5.3 billion for the 12-month period. That was a nice increase of about 13% compared to fiscal 2023. Gross margin increased 22.5%. They also reported net leverage was 2.4x as of December 31st, 2024. Adjusted EBITDA was about $1.4 billion. That was an increase of 24% on a year-over-year basis. It's worth noting they reported net income in Q4 of about $104 million. That was compared to a net loss of about $594 million in the same period in 2023. They've been seeing a really significant uptick in advanced bookings per passenger cruise days, as well as overall passenger cruise days. They gave an update on their operating capacity and bookings in the report. They said for our core products, operating capacity is 12% higher for the 2025 season compared to the 2024 season. They said for their core products, as of February 23rd, 2025, they had sold 88% of their capacity passenger cruise days for 2025. They had 26% more advanced bookings for the 2025 season than at that same point in time a year ago. And advanced bookings per passenger cruise day for 2025 was 7% higher in the 2024 season than at the same point in time. So management noted that bookings are breaking records. Actually, January 31st set a new all-time high for revenue booked in a single day. And January 2025 was the highest revenue booked in a month in Vikings history. So
Nice.
those are pretty strong comments and very hopeful as well for the business. So the company thinks they're pretty well positioned for 2025, that their products continue to really resonate with their core targeted customer base. It's also worth noting at the end of their fiscal year, they had about $2.5 billion in cash and cash equivalents on their balance sheet, an undrawn revolver facility of about $375 million. So, the biggest thing I would note is obviously this is a company that has struggled with profitability under GAAP, recently, but they, especially in the closing few months of last year, turned that net loss into net income, significant improvement on that metric. And just the fact that they're already seeing such a robust uptick in capacity passenger cruise days for the new season at a rate that is significantly above what we were seeing a year ago. As we have all these discussions about concerns over the macro environment and the state of travel, something that I think has been true in past periods of macro and rust is often that luxury segment tends to be a bit more resilient. And I think that that's something that you're definitely seeing with a business like this that is geared towards luxury travel, towards older travelers that have, a higher level of personal capital to spend. So interesting business. Watching profitability closely with this one, their growth in capacity, passenger cruise days, occupancy, and just the significant metrics they're reporting already for their 2025 season bookings seem to bode well for the year ahead.
Yeah, and new capacity coming too, right? 10 new 10 river ships, 1 ocean ship coming for them. So they continue to grow. This is also the vibe here seems to be a little bit different than what we saw from Delta's announcement yesterday about weakness that they're seeing in travel. Viking does not appear to be seeing any weakness at least among their customers in their business. So far so good. Yeah, it's stock went down, Rachel, but I think that's because a lot of things went down, and maybe just general concerns over travel, the travel industry as a whole, as opposed to anything specific to Viking, because it really was a solid report. It was a really good report from them.
It was. And, obviously the business models of these types of companies, it's very, very industry specific, the way you evaluate this type of business. And for the industry they operate in, they are doing quite well. And particularly considering some of the reports we're seeing from, some of their competitors. So I do think some of that goes back to the unique segment of passengers that they target. And I agreed. I think a lot of the performance we're seeing with the stock is down to the broader sentiment afflicting the market, far less than anything related to the actual report itself.
Yeah. All right. What shall we hit next here?
I was looking through these questions that I wanted to. Oh, Matt was saying, would you say that Viking was a more mature business than your typical IPO? I think that would definitely be the case. So they held their initial public offering on, May of 2024. It was actually the largest IPO of 2024, at least at that time, on the New York Stock Exchange, the second largest in the US in 2024. But this is a business that's been around for close to 30 years at this point, maybe a little bit over 30 years. I'm trying to remember the exact founding date.
It's been around for quite some time.
1997, so almost 30 years.
Yeah.
Yeah. No, they were a very mature business before they held their public offering.
Been around for a while. Old enough for me to have received brochures from Viking and to look at them and say, why are you sending it to me? This is clearly not me. And then have grown up during that time to a point where, you know what, maybe someday soon this is for me.
Yeah.
So I've, gone from no way could I possibly be a customer to maybe so.
Well, and it's interesting because they had a kind of a fascinating business trajectory. They were founded back in the late 90s, and there was this idea that travel could be more destination focused and culturally immersive. They expanded into the American market, I think around the year 2000. They established a sales and marketing office in LA. And then that same year, they purchased a company called KD River Cruises of Europe. And that increased their fleet to roughly 24 vessels. And that made them essentially the largest river cruise company in the world at that time. And then in the years that followed, they started really focusing more on that target demographic that I mentioned, revamping their ships, partnering with different sales agents. And so now they're one of the world's leading travel companies with their fleet of nearly 100 ships.
And very much focused on Americans as a core customer demographic now.
Yeah,
for sure. All right. Hey, before we hit some of these questions that are coming in, do you want to talk about another company that reported earnings today? Do you want to talk about Kohl's?
Yes, I can talk about Kohl's. I'm sure we both have some thoughts. I actually haven't checked to see how the stock is. Oh, okay. I was checking to see how is the stock performing. I just refreshed my screen.
Down 24%, my friends. Kohl's stock today. And we cannot blame this drop entirely on just general market vibes. A lot of this is Kohl's. This is a direct reaction to their report, which I'll let you go into details here, Rachel, but it wasn't pretty. Down 9.4% revenue, down 9.4% year over year in that fourth quarter. Comp sales down 6.7%. That's not what you want to see. Hey, and the good news, gross margin went up. I'm not sure how that happened, but gross margin improved marginally a little bit by 49 basis points. They are still profitable, believe it or not. Operating income for the quarter, $126 million. That's less than half of what it was in the same quarter a year ago, but it's still not negative. $48 million in net income. So that's less good, but it's still profitable, right? And they are profitable on an operating basis, on a net income basis for the full year still. But look, full year net income was $109 million, right? So there's not a lot there. $109 million net income off $15.4 billion in revenue for the full fiscal year. There's clearly a problem there, right? That is not what you want to see from a retailer. I know margins are narrow, but they shouldn't be that narrow, right? The outlook for next fiscal year. So what are they projecting for revenue growth, my friends? The answer is they are not. They are projecting a decline of 5 to 7% for the 2025 fiscal year. They're expecting a decline in comp sales between 4 to 6%.
Not good.
Not good. I
was looking at the share prices, and other than the dip that, of the bear market of early 2020, shares of Kohl's have not traded this cheap since the late 90s.
Wow.
Yeah. So, and I'm not saying that as someone who's looking at it as a potential deal. I'm saying that
I would not.
This is one of those examples where it's always important to look at the movements behind a stock. A stock may be beaten down for a reason that is outside of its control or not tied directly to the business fundamentals or because of the broader market. This is, I think, a great example of a stock that its decline is absolutely justified by the fundamentals we're seeing.
Absolutely. And the other thing, so they did declare a dividend. And you say, oh, they're paying a dividend. arguably should not be. Let's get that out of the way. But they declare dividend. Unfortunately, it is a dividend cut. It's 12.5 cents a share. The prior dividend was 50 cents a share. So a substantial cut in the dividend. I honestly don't know why they just didn't slash the whole thing to zero, because I feel like you should be preserving cash at this point for this business. This does not look good, my friends. If you're invested in Kohl's, my sympathy on today's performance, this earnings report. I don't see a bright spot here, Rachel. I mean, did you see anything in the report that suggests this is going to turn around anytime soon? Because it ain't going to be next year, not from what they're telling us.
Yeah, no, not from what I'm seeing. And yeah, you hit a lot of the high points or the low points, if you will. Q4 net sales decreased 9.4% year over year. Comparable sales decreased 6.7%. As you noted, 2024 net sales decreased 7.2%. Comparable sales decreased 6.5%. And yeah, that gross margin was a 49 basis point increase. But operating income was down. Net income was down considerably. So in Q4 2023, they reported net income of 186 million. In Q4 of 2024, they reported net income of 48 million. So that is a considerable decline. And then again, as you mentioned, the full year net income was 109 million. A year ago, they reported net income of 317 million. So they more than halved their profitability. And that, again, I intend to agree with you about the issues concerning the dividend. I guess maybe one note is they did reduce their long-term debt load by about 113 million through the redemption of the remaining 9.5% notes due May 15th, 2025. So slight reduction in their long-term debt. This is something that as a consumer, I find a bit sad. And we've seen a changing landscape within retail, especially over the last decade. And there are brands that have done a really good job of adjusting to changing consumer behaviors. I think I think Walmart is a great example. Obviously, this was a business that, more than half of their sales come from grocery. They're very consumer staple focused. But they do have a wide range of items that they sell, including, apparel. And there are these examples of brands that have been able to expand to a really robust omni-channel experience or to revamp their brick and mortar model. TJX Companies is a fantastic example of a company that has been very capital efficient. They have their own very unique model that ensures that they are not, overstoring inventory, that they're always constantly refreshing and creating this treasure hunt experience for shoppers. Kohl's has had kind of a manifold group of problems. There's shifting consumer behaviors, right? We know that shoppers are increasingly turning to online shopping. They're seeking out better deals at discount retailers. And that traditional department store model is not the success that it was, 20, 30, 40 years ago. High inflation is a factor that has also reduced consumer disposable income. So you're seeing less spending on non-essential items generally. And then where there is discretionary spending, a lot of that is also being geared towards more affordable retailers with a more diversified source of options for shopping, which I think is something we've also seen. And again, Kohl's primary focus is non-essential items. And so I think that there's another issue there as well. Sales have declined, profitability has declined. The biggest thing I would note that happened recently that, maybe there's a little bit of a silver lining is they had a CEO transition in November. Ashley Buchanan was appointed CEO and board member starting on January 15th. She has been the CEO of Michaels Companies since 2020. Prior to that, she held a variety of senior executive roles at Walmart and Sam's Club. During the 13 years that Ashley worked at the company prior to that. That could be something where we see a shift with a new CEO at the helm. Mr. Buchanan obviously has an extensive history within this space at, major brands like Walmart. Maybe that's something where we see a turnaround. I could also see this as a situation where maybe this starts to look like ripe for an acquisition for some larger company that wants to maybe incorporate elements, of the Kohl's brand. But this is a very distressed business right now, in my view, and I don't see what their path forward is. They've tried to expand into online and omni-channel, and they have, but not at the rate they need to, not in a way that's been successful.
Yeah, it's hard to see where they go, right? They fit in this kind of middle space in the retail market. Like you're lower tier than your more higher end department stores, right? Like Nordstrom, say, or that level. A little bit below that, above the big box discount retailers like Walmart or Target. I don't know. You might put maybe a little bit below Macy's, but kind of around there. Maybe around JCPenney level, except JCPenney is bankrupt. Macy's is struggling, closing stores right now. No retailer you would look at that looks to be kind of within their same zone in the retail market in terms of positioning is doing well, right?
Yeah.
The off-price retailers, if you're looking for good bright partner retail, TJ Maxx, TJX companies,
TJX companies,
Ross, Burlington, those are seeing good results, right? Those off-price retailers. Walmart doing pretty well, right? Like that and that part of the range. But this kind of niche that they're trying to occupy is not doing well right now. Hasn't been for a while. We've seen a lot of these stores that you remember from back in the day are gone. JCPenney's one, Sears one. Sears was a little bit different. But kind of that level of bricks and mortar retail is very, very difficult. I look at this business and I say, and Bessie's asked right here, any repercussions on TJX for Kohl's? It's been lingering. How would it fare in a recession? I think it does really well in a recession, quite honestly.
Yeah, they have a very different model. They have a very
different model than Kohl's. Much more robust sourcing and distribution network. They're putting up growth. Decent. Now it's not not double digits, right? Same store sales growth like around 4 or 5% for TJX companies overall. But that is not a decline, and it's beating inflation, right? They're growing their same store sales as they continue to expand their footprint in a big way. They're really targeting growth there, and they're doing well internationally, right? You see people trading down in a recession, right? So maybe coming down to TJX. They have this reputation for being kind of a treasure hunt place. They sell name brand stuff, right? They're getting it done, right? That's, I think, the business you want to look towards if you're looking to invest in this space. Kohl's, I got to say it, guys. I think they're probably not long for this world. And
yeah, makes me sad. I used to shop there back in the day. Makes me sad.
Right. The end game here, I think, is find someone to acquire you or ultimate liquidation. I think is where we're headed. Now maybe someone can turn it around, but I don't think it's its management team.
Yeah, I think that's right. And I'll touch on this question a little bit more, but TJX is an example, I think, of a company that has adjusted really, really well to the demands of the modern consumer. And they had a different model to begin with, and it's worth noting kind of exactly what that is as we're talking about it, right? So Kohl's is very much kind of that older department store model that has not at all been sticky with the modern consumer, and as Toby noted, has not been sticky for quite a while now. TJX company sort of has like a three-tiered approach that has made its business model so effective. One is obviously its off-price model. So offering great value to customers by selling high quality branded designer merchandise at anywhere from 20% to 60% discounted prices. And then they don't run ongoing sales outside of that. It's more that these are the items that are available in a unique period of time with limited stock. And this is the amount at which they're discounted from the original price. And that creates a little bit of a scarcity, which actually draws the consumer. And they have really a flexible model that allows them to capitalize on various, marketing opportunities and changing consumer preferences. They have a broad global network of buyers who they source merchandise from, and they acquire that merchandise at significant discounts through buying strategies like closeouts, manufacturer overruns, and even buying goods at the end of the season. And then they have this very diverse portfolio of stores, including TJ Maxx, Marshalls, Home Goods, TK Maxx, to name several. And as Toby mentioned, there's that treasure hunt experience. The stores are known for having a non-linear layout, constantly changing inventory. And so that allows customers to explore and discover new items. They are able to capitalize on things like department store cancellations, overstock situations. So they have this flexible buying strategy that allows them to constantly refresh without actually carrying a bunch of inventory in the back. And that has been really, really effective for them and has enabled them to capitalize on their relationships with vendors while continuing to maintain a fresh look and design for the customer. So I think there's different companies in the retail space that could be compelling. If you're looking at brick and mortar retail specifically, this is one that I find interesting. And I think that they're actually a great example of a success story in what has been a pretty beleaguered space over the last several years.
Yeah. All right. Well, I think we've beat Coles up enough.
I know, I'm feeling bad now. You know, there was a question that came in several hours ago from Ed about Stitch Fix, which reported tonight.
So let's another company.
Should we talk about that?
Let's talk about
so
they reported just now.
Yeah, I pulled up the results. Actually, when I checked, the stock was trading up after hours, like significantly up. Yeah. So Ed had asked 5 hours ago, Stitch Fix reports tonight. This was almost $100 stock in 2021. Now it's $4. I gave up on them. A fad that never caught on. Who knows? Yeah, I know. The shares are trading up something like 20% after hours.
Yeah.
Is that right? Yeah.
It is. It's 20%. Yeah. Are we not going bankrupt this quarter? I guess not.
Well, so this is an interesting one, right? I think this is a classic example of this is a company that has been struggling, but they did better than what the market expected, and probably by a long shot. And I'll lead into these numbers here in a bit.
And disclosure, I used to be a 6FIX shareholder.
Okay.
And bailed after a loss on that. They were promising for a while, and then it just after a couple of CEOs trying to get things turned around, they just couldn't seem to do it. But maybe we're seeing some improvement here. What do we got, Rachel?
Yeah, so they set also revenue guidance that was ahead of expectations. So they beat on several metrics from what analysts have been projecting. So this was their report for the second quarter of their fiscal 2025, right? So this is not a full year of earnings. So net revenue was a decrease year over year, but a slighter decrease of about 5.5%. So they reported total net revenue of about $312 million. Active clients of about 2.4 million. That was a slight decrease of 2.6% quarter over quarter, or 15.5% year over year. Net revenue per active client increased by 4.3% year over year. So that seems to be, again, an area where investors were excited. Their gross margin, which was 44.5%, increased by 110 basis points year over year. That was driven primarily by higher average order values and improved product margins. They're still operating at a net loss. That net loss was about 6.6 million. They did deliver adjusted EBITDA of about 15.9 million. They are negative in terms of operating cash flow and free cash flow, but they finished the quarter with about 230 million of cash equivalents, and investments, and zero debt on the balance sheet, which is worth noting. Now, what they're forecasting for Q3 fiscal 2025 is net revenue of anywhere from 311 million on the low end up to 316 billion on the high end, which, while both of those figures would be slight decreases from 1 year ago, that would be anywhere from a 3.6% to a 2.1% year-over-year decline. They are forecasting adjusted EBITDA of anywhere from 7 million to 10 million, which would represent a 2.3% to a 3.2% margin. That guidance is definitely above what the losses or decline, if you will, that analysts had been projecting. So that also seems to be feeding into some of the excitement around the stock. So bottom line, the company is still unprofitable. Net revenue declined, but by less than what analysts had been projecting. Active clients decreased, but net revenue per active client increased. Gross margin increased. They're still negative in terms of cash flow, but their projections for the next quarter were broadly above what analysts were projecting. So mixed results there. You know, it's worth noting, you know, how does this company work? They make money by charging a styling fee for each Stitch Fix package sent to customers. And then that fee is credited towards clothing items that the customer chooses to keep from the shipment. So customers pay a flat fee that's usually around $20 per fixed package, and that is applied as a credit towards any items that they keep. Stitch Fix also earns a profit from the markup on the clothing items that customers do actually decide to buy. They've been leveraging AI into their platform a lot more heavily over the last couple years, trying to personalize the customer experience and streamline operations, and do a better job of analyzing customer data with style preferences, body measurements, and feedback. It's worth noting that some comments from CEO Matt Baer at the latter part of last year, when the company announced their 2024 results, Baer has said, they are in the midst of a transformation for the company. They are planning to return Stitch Fix to revenue growth by the end of fiscal 2026. So that's something that they are aiming for. He said at the time of their 2024 report that they had been working on exiting their UK business. They were closing 2 fulfillment centers, so they were saving about $100 million in the last fiscal year. That they are, as he put it, in the building phase now. So to give you an idea, even though their revenue decreased by single digits in this most recent report, so their overall net revenue decreased about 5.5% year over year. In the prior quarter, Q4 of 2024, they reported a decrease of 12.4% year over year. So the end of their last fiscal year, they were reporting double-digit revenue declines. Now they're into single-digit revenue declines.
So that's getting better.
They're amidst these ongoing restructuring efforts. So there might be some hope on the horizon.
Yeah, and look, so just from a timing perspective, guys, the quarter we're talking about is actually the second quarter of fiscal 2025, which ended February 1st. Right. So the end of fiscal 2026 would be like end of July, early August, 2026, right? So we're looking at less than a year and a half from here is what they're saying in terms of timing there. And look, Rachel, gross margins went up. So 44.5% gross margin, $6.5 million net loss. That's not a big net loss, right? I mean, it's close. So if you're picking between Kohl's and Stitch Fix, I gotta say I probably go Stitch Fix. I think it's a lot more hope, a lot more realistic hope. Like this isn't just waving your hands, hopes and dreams, right? This is, you see financial improvement, you see a plan.
There is a definite plan. A couple other things I would note because I haven't had a chance to listen to their earnings call yet, but some highlights that management had given when they were closing out their prior fiscal year in terms of this business transformation that is ongoing currently, in which we are hopefully, starting to see some of the product of. Something that their CEO had said is that their proprietary AI models enable them to present style files to customers. And they've seen a 5% increase in conversions for clients who received a style file. He also said that Stitch Fix is increasing the visibility of its stylists, that there was a 12% increase in conversions for clients who actually received profiles on their stylist areas of expertise and related interest. And then another thing that they've been doing is increasing the flexibility of their model in response to client feedback. So instead of clients receiving 5 items to try in their Fix box, they now receive 8 items. And at the time of their 2024 results, the CEO noted that revenue was up 50%, 50, with clients who have received 8 items instead of 5. So they are trying to turn the business around. This is not one I'm a buyer of currently, but in terms of if we're looking at these 2 stocks that have been seriously distressed, I'm much more intrigued by what Stitch Fix is doing.
I think so. And I'll note that my household is above, I believe, that net revenue per active client number between my wife and my daughter. Now, I don't know if they're actually 1 active client or 2, how that works. And 2, I wouldn't be shocked to know that we're above that. Yeah, they both love it. I get Stitch Fix packages like at least once a month to the house.
Oh, fun! I've never tried them before.
You're not a Stitch Fix user.
I haven't used them. I've used companies like Poshmark, which was public for a hot minute. But never Stitch Fix. It's interesting though, and you kind of think about, in an environment where there are, heightened concerns about the economic landscape and where consumers might be more wallet conscious, there is a benefit to using services like this where you can access new items at a very, wallet friendly cost, that it's very accessible from a price point perspective, that might be something that is even more sticky to consumers in this environment. Hard to say at this point, but they do have a strategy for moving forward. How they execute on that remains to be seen, but there's definite improvement that we're seeing here.
Well, they do not operate in Italy.
No, alas.
Have you heard of Outfittery or Lookaroo?
Outfittery? No, I don't know that one. I
don't know it either. I'm just trying to, looking at their operations here. Outfittery is a service in Europe.
Well, I use a company called, they're private though. Actually, if they ever went public, I'd be very curious what their business looks like. But there's a company called Vinted, Vinted. And I use them here, and they're kind of like a Poshmark type. They're a big secondhand fashion marketplace in Europe. Yeah, that's an interesting one, but they're still private.
Hopefully they fare better than Poshmark.
Yes, that's very fair.
Yeah.
Maybe there's a reason they're still private.
Yeah, maybe so. So let's start hitting some of our questions here. See what our members want us to chat about. So how would Besties asked, how do you think Viking would fare in a recession? Would the money retired tourists still buy? I think so, Besties. I think Viking will weather a recession much better than your other major cruise lines. And by that I'm talking Carnival, NCL, Norwegian. No, that is NCL. What's the I'm blanking on the name now, Rachel.
Not Carnival. Are we talking about
the third? The other. There's like three big ones.
Norwegian? No.
Yeah. So
Royal Caribbean.
Now this is gonna annoy me for until I get this right. So Royal Caribbean. I don't know why.
Oh, okay.
Royal Caribbean, Carnival, and NCL Norwegian, right? Yeah. They're more family focused. They have non-family brands, all of them, right?
Mm-hmm, mm-hmm.
And families with kids in terms of traveling, you're a little more susceptible because, right, if you have a family with young children, their parents are probably still working, right? That's the stage of life, right? Your household budget is more day to day, right? You're concerned about things like retirement, kids' education in college, that sort of stuff. A little more susceptible to the day-to-day movements versus the retired couple that might be have all they need until they're dead, right? Or living off of investments, living off retirement pension, what have you, a little more wealthy. So I do think Besties Viking would fare much better in a recession there. Now there are some like kind of cruise operations that probably hold up okay in a recession as well. I don't know about Seabourn, which is a more luxury brand, but I think is that a sub one of the three owns that one, I believe. I think that's Royal Caribbean.
I think
not 100%.
It's owned by Carnival.
Carnival.
Yeah.
Okay. Yeah. So Seabourn, more luxury. But the point is, I feel like your luxury cruises will hold up more in a recession than your more mass market brands. So you're looking at things like Carnival, Royal Caribbean, NCL. They have multiple brands under their banner, so you kind of got to look in and say what percentage of revenue is coming from where, and it won't be a complete disaster, right? For those, if you get a major recession and consumer spending on the family end cuts off, right, they'll still do all right. Because they're somewhat diversified, but Viking, I think, because of what it is and its focus, will hold up better than them, likely speaking. Disney probably holds up well, but you'll never notice that because
it's such
they're
a small.
The reason they're small, right, is because they just get less business in general, and it's less a major part of what they do in terms of a percentage of revenue. And they're a little bit higher end in terms of their price point, which suggests to me that if you're looking for a bargain, you probably don't look to Disney. So people who are already cruising there probably skew a little bit higher in terms of the income bracket. Not necessarily. You would see a drop off from then in some degree, not as much as I think you'd see some of the larger mass market brands there. But Viking, yeah, probably the one that holds up the best in terms of publicly traded, for sure. There.
It's kind of interesting to think about because we've seen an interesting correlation during prior recessionary periods, and I'm not saying that we're going into one, but looking about how the luxury market, broadly speaking, fares, right? So there was some really good stats that were put out by Bain during the 2008 financial crisis. The luxury goods market experienced a 9% overall loss. Some brands fared better than others, and there was obviously this idea that the luxury sector wasn't immune to economic downturns, but was much more resilient just due to the fact that they have an affluent customer base. The emotional appeal of their products continues. And this was also a segment that recovered incredibly fast in 2010. And then even with the later COVID related decline, those kind of two periods were the only major downturns in that segment that Bain has tracked since 96. Since 1996, with Viking specifically, something I noted earlier, they target primarily affluent, well-traveled adults ages 55 and older who are interested in cultural enrichment, destination-focused itineraries, a more relaxed luxury experience. While those consumers might be more wallet conscious in a difficult macro environment, these are generally travelers, and we're seeing this bear out at least already in their bookings for the new year. These are more resilient travelers from a financial perspective. And that in turn feeds into a situation where that business could fare better than some of the other companies we see in this space because of their exposure to the high income consumers.
Yeah, I think that's right. And Bessie's the other thing to keep in mind when you're talking about the cruise industry in general, not just Viking, but the cruise industry in general, in terms of how it fares during a recession, is remember that a lot of these things are booked well in advance. Many people book cruises a year in advance, right?
Right.
And so if you get a recession that only lasts 3 or 4 months, that might not ultimately matter too much. Because if you've already booked your cruise, you're thinking, I've already kind of paid my deposit. Maybe I've paid my whole thing. Whatever, I'm going to go, right? It's paid for. And then the next year rolls around, recession's over. Oh, let's go on a cruise. Now, maybe that initial booking cycle coming out of the recession is shorter because I'm going to hesitate to book until I feel more comfortable. But I could still end up going depending on the timing and how long a recession actually lasts, how long people are feeling uncomfortable. It might not be a major hit just because of their long booking cycle for many of these. The other thing I think all of us here together in the Fool universe need to keep in mind is that stock market does not equal economy. And just because we're seeing a couple of bad days and a couple of bad weeks in the stock market, we should not assume that is going to translate into a recession necessarily, nor should we assume that your typical consumer who doesn't really follow the day-to-day fluctuation of the stock market that much, who just invests in their mutual funds in their 401k automatically out of every paycheck, and that's it. Don't assume they feel the same way about the current economy that we do. Now, we do know consumers are feeling pressured and pinched because of inflation. That seems pretty clear. We do know there's concern out there. Some people are concerned about their jobs potentially, although employment's up a little bit more, but not a ton more in the latest jobs report, right? It's still adding jobs. There's a lot of things you would look at in the overall economy and say things look pretty good. The stock market's going haywire, but does your typical, Royal Caribbean cruiser care about that or even notice that when they're thinking about, do I go on a cruise this year or not? Maybe not, right? So it's easy for us to get too caught up in this idea that as the stock market goes, so goes the economy, but they're not the same thing. And I think we need to remind ourselves when we're thinking about longer term investments, even midterm investments that might be impacted by the economy. Our feelings watching the market go down may not translate into what the average consumer is thinking in terms of how they're spending their dollars right now. Just something to keep in mind.
There was a question that came in from Ed a few hours ago about Kava and Dutch Bros saying they've been hammered. Yeah. Do you like any of these as opportunities for the long term? Is the PE too high? Will they suffer if there is a recession? So just to give some perspective. So Kava is down over the last month significantly, but the stock is still trading up about 30% over the last year. Dutch Bros, while again, they've been beaten down in the last month, especially, they are still trading up about 90% over the last year. So these are both stocks that over the trailing 12-month period are still, in the green, if you will. They both have very high PEs. Part of that is a function of the fact that they are more newly profitable. So that's something to bear in mind as well. These are not companies with extended track records of profitability thus far. So I think it's notable to perhaps take the PE ratio with a somewhat of a grain of salt. Dutch Bros reported their first full year profit in 2023. Kava reported their first, I think, ever profit in 2023. So these are still businesses that are working towards consistent profitability. Something to note there. I actually like both of these companies. I tried to add a little bit of color there to what's happening with the PE. Looking at these opportunities for the long term, will they suffer if there's a recession? I do like both of these companies. In the sense of with Dutch Bros, they have an interesting model. They're a drive-through coffee chain. They're very much not designed to be the place where you sit and congregate in the way that you might at a Starbucks or some of these other type of coffee chains. It's really about that quick, drive-through experience, but quality beverage options. Something that management has also noted is that they're really trying to work to expand their food offerings. That's still a very small part of their business, and something that they're really focusing on over the next couple of years. This is a business that's been around since the early 90s. So they've been around for, I think, about 33 years at this point. Started as a push cart by the railroad tracks in Oregon and has grown to this, massive business today. And to give a little bit of highlight in terms of how they're doing financially, they reported net income of $67 million in 2024. That was more than 6 times than the net income they reported in their fiscal 2023. So they've seen a significant uptick in GAAP profitability, which is also, again, feeding into that ratio you're seeing. Total revenue grew about 33% year over year to $1.3 billion in 2024 compared to 2023. They opened 151 new shops in 2024. 128 of them were company operated. That was across 18 states. I like this business. Kava is another one that I think has an interesting opportunity. Somewhat of a competitor to the likes of Chipotle, although they have obviously a very different target segment in terms of cuisine. Kava offers a lot more, options and toppings. They're a much newer type of business than a Chipotle. They are also profitable, and they have been rapidly increasing their profitability. Their net income in fiscal 2024 was $130 million compared to $13 million a year ago. So significant uptick there. Their revenue grew 33% in 2024 to just shy of $1 billion. So total revenue of about $954 million. I think both of these businesses are really interesting for anyone looking at the restaurant, coffee shop chain, quick service space. I absolutely think any of these businesses could suffer in the short term if there is a recession, because I think that is kind of an inevitable truth of the somewhat cyclical industries in which they operate. These are prone to shifts in consumer spending. And that's something that I think is probably important to understand when looking at these businesses. But for a long-term perspective, these are companies that are really intentionally but effectively growing their store footprint. They are both growing profitability at a really solid rate. I believe they are both cash flow positive. I know for sure Kava is, as I have those numbers in front of me. Revenue's growing steadily. I like these businesses.
Yeah, I agree. I like them too. Both brands are strong.
Yeah.
Right. Very strong brands. And I think there's a lot of growth ahead for both of them there. We have 3 minutes left here, Rachel. Besties asked about Toast. How would Toast fare in this environment if a recession is coming? They'll probably see a little bit of a hit, I would suspect, because part of their model is making money on each transaction.
Right? Yeah.
So if you think that and their core customer is restaurants right now, they are expanding beyond that, but that's the core that still is part of their business. So if you believe that restaurant trips will decline in a recession, and I think there is reason to believe that will be the case. That's what typically happens. People cut back instead of eating out 3 times a week, you eat out twice a week. Instead of eating out once a week, you eat out every 2, something like that, right? You tend to pull back a little bit. And if transaction goes down, they'll see a little bit of a decline in the core business. Now, they're also focused, though, on expanding beyond that, right? They're expanding into grocery stores, convenience stores, right? And those are places that you might expect to see a tick up in a recession, right? Less spending on restaurants, more spending, more trips to the grocery store to compensate, because you're still going to eat 3 meals a day. It's just an issue of where it's coming from, right? And maybe it gives them an opportunity to expand more quickly into those spaces. If they can present a compelling opportunity, a compelling business case to a customer, say, look, this makes it a little more efficient. We operate a little bit better. This will lower your costs a little bit overall. If they can make that case, you could see a rapid expansion during hard times. As businesses are looking for ways to, how do I make this more efficient? How do I shave a little bit off of these costs? So it could be a potential bright spot for them, but I think at least initially, just because of where their core business is right now and what tends to happen in a recession with restaurants, you will see a little bit of a pull off from them.
Yeah, I think that's right. And I think it's a good point you make as well. That's something that's been more recent. They're expanding into, just outside of food service, into convenience stores, grocery stores, bottle shops as well. And all of those essential features like, inventory management, online ordering, front of house, as well as back of house software, hardware, that is core, mission critical, if you will, infrastructure that a lot of these companies, restaurants, and then even smaller enterprises can't really afford to go without. So they might very well, as you mentioned, I think, see a little bit of a hit from changes in transaction volume, but also a huge part of their business is subscription fees for those products and services I mentioned. And that's not something that these businesses can really put on the back burner, even in a recessionary period, if that were to occur.
Nice. All right, that's it for us, Rachel. We're at the top of our hour here, 5 o'clock on the East Coast. Thank you guys for the good questions. Thanks for tuning in. Rachel and I are actually back at the same time tomorrow for more earnings. So bring us your earnings.
We'll be back
for this. But for now, we're going to turn you guys over to Tim and Jose for a look at AI and semiconductors here. And guys, I noticed you had 3 tickers that you thought you might talk about today. I took a look at them. 2 out of the 3 were up today.
So, all right.
There you go.
Which 2?
Tesla and Nvidia.
Interesting.
Doing their best. They could not do it on their own, but they were doing their best to pull the Nasdaq back into positive territory.
No, they couldn't get it over the line. I would say though, teaser heading into this hour, those are the 2 for which I have the most questions. So
Nice.
yeah. Toby, Rachel, thank you very much. We'll get us going here.
All right.
So, Fools, welcome to another hour. Fool24. I'm Tim Byers. With me, Jose Najarro. Jose, how you feeling, man? It's the afternoon. Is it 5 p.m. where you are, or earlier?
Yes, it is. It's 5 over here.
Okay, so little later, 3 p.m. in the Rockies. Nice outside. A few different tickers to talk about. Get your questions in. I was on the morning show, so I feel like you should have a chance to start us off here with what you want. I am prepared with more Oracle earnings. We've got Nvidia notes. I have a question for you that I will save for later, and then I've got Tesla thoughts.
I think maybe we can start in that order, Tim. Oracle earnings, I think, will probably.
Okay.
I think it's also probably like the least followed out of the others, so we can kind of like tease our way into the more popular ones. But I mean, there were a lot of interesting things that came out from Oracle's earnings. Tim, the first thing is they did talk about kind of the huge RPO growth that they saw over the quarter, which they are saying is driven mainly by AI demand. And unfortunately, right now, not having enough capacity to meet that demand. So they are kind of increasing their investments in AI data centers. And one of the things that kind of hurt them, what seems like this quarter or maybe the upcoming quarter as well, is going to be some of the delays we had in Blackwell. They talked about it, how they won't really see kind of that issue really be fixed until their Q1 fiscal year 2026, which is kind of Q2 calendar year. So they still expect at least one more quarter of maybe some hiccups with the Blackwell delays. But overall, strong RPO without any contracts from Stargate. And they believe Stargate is going to be massive in forms of training. I'm throwing a lot here, but let me just kind of
keep going. Keep going.
I think they did announce some pretty cool news for, obviously, NVIDIA. They mentioned a 64,000 GB200 cluster. But for AMD, they also announced about a 30,000 MI350 cluster. And the MI350, for those that follow their earnings, this was expected to come out in the late half of 2025. But during their earnings, they mentioned, because a lot of kind of the traction they were seeing from their current customers and net new customers, potentially, they were moving it up to more mid of 2025, opposed to that late 2025. So now we can see Oracle is one of those customers that was already using AMD's GPUs. They do have a very big cluster of the MI300, but then continuing to buy maybe the MI355X, which they called it, I think kind of showcases that AMD might be doing some great moves here with their AI chip space. What other thing really caught my attention? I think for right now, Tim, I think we can start with that. Those I think earnings were good in long term. We are continuing to see that AI demand from Oracle.
Okay, I want to focus on this. Thank you for pulling up Michael, for pulling up the data here. So I want to point out one thing here. So couple things. Total revenue, 0.1 billion, up 8% in constant currency. The cloud revenue, which is where all the stuff we were talking about, these cloud instances that require all of the AI infrastructure, up 25% in constant currency. So the cloud business, which is the future of Oracle, is 44% of revenue, roughly. And what we're talking about, this is what you were talking about, Jose. And I'm going to define a remaining performance obligation in a second here, but that is a very big number, $130 billion. We don't know how much of that is current, and I'm going to explain RPOs in a second here, but that's up 62% year over year. And a big portion of that is how Oracle is selling through cloud services. They have a product that they call Database at Cloud, and that is sold through the hyperscalers. And so the issue here is that there is contracted usage, presumably, probably not just Database at Cloud, but I would say fair amount of Database at Cloud. And what they said is that they have 18 instances currently. So what I mean by this is, so an instance is you have a bunch of, you have Oracle Exadata, and you've got databases, and you have all this infrastructure, and it exists inside, literally, I think in these cases, inside, let's say, an AWS data center. And so in order to access this, you have Oracle selling through the AWS marketplace, and you get access to the Oracle Database at Cloud through your AWS instance. So Oracle is taking its stuff and making it available inside of the big clouds. So that's a thing. It's not clear to me, Jose, exactly how much of this is driving the RPO, but I think it's driving some portion of this. There are 18 of these presently, and they said during the call that they are scaling up another 40. That's big. That's a two-thirds increase. That's pretty big. So this is a big part of the strategy. You have Oracle Cloud Infrastructure, OCI. So that is Oracle hosting its own data centers, doing its own thing, and then selling you like database at cloud, the autonomous database, all of the things that they provide through the Oracle cloud. Then you have the other side of it, which is the indirect channel and these additional hyperscaler instances. So what Oracle is telling us right now is, hey, we're expanding our footprint. We're going to Bigfoot this market, and we're going to put our stuff everywhere we can. And to your point, Jose, they are making some very big investments, which is why I was talking about this on the morning show. There was a huge increase in CapEx. It was like a 3x of CapEx. Well, now we know why. They're trying to Bigfoot the market and put their stuff everywhere. So that's a fairly big deal, and it's somewhat interesting to think about that. They are very much in a investment period. Harvest comes later. Right now, they are planting seeds, and they hope to reap the benefits later. They also said that Stargate is not yet a driver, but they sure think it will be. And for their forecast, so I told you in constant currency, total revenue growth is 8%. Safra Katz, the CEO, said 15% revenue growth is coming in the year ahead. In other words, we will accelerate revenue growth. So we'll start to see some amount of reaping. So this is interesting. The only other thing I'm going to add to what you said, Jose, is that Larry Ellison, so founder, chairman, I think he's still a chairman, but he's certainly the founder.
Yes, CTO, chairman, and founder.
He's the CTO still.
Yeah,
that's just funny to me. But whatever, it doesn't matter. Ellison has been connected with this business forever. He talked about how they scale up their infrastructure spend, which I think is interesting. It gives us something to watch as investors and analysts. Maybe improvement in margins, some kind of unit economic benefits. What he said was, and we're paraphrasing here, this is AlphaSense paraphrasing for me, Oracle starts with small data centers and grows those instances based on demand. And so they have higher utilization and lower labor costs. In other words, they have small footprint data centers. They have a smaller number of racks, but they pack those racks really tight with as much optimized compute that they can put there. And because they're smaller footprint and presumably in, places where they're getting benefits of the labor is handling more than one job, including the data center job. I don't know, but they are talking about utilizing lower overall labor costs on a unit basis. So that's something to watch for. If he's right about that, if he's not just making it up, we'll see that in the margins. That will be interesting. Also, he said Oracle has a high degree of standardization and automation in the cloud, which should further improve margins. So using a lot of open source technology, using a lot of off-the-shelf components, in addition to their own Exadata custom hardware, their database engines. So we'll see. They are signaling strongly here, Jose, that we should not only expect revenue acceleration, we should expect margin expansion. And if we don't get it, we should ask why. That's the thing I think I got from this Oracle report. You think that's fair?
Yeah, definitely, Tim. I mean, I think as we're going to see their OCI become a bigger portion of the business, that's where we're going to start to see more of the acceleration of total revenue. And the other thing, Tim, I want to say Oracle, I don't know if they got lucky or they were super smart, but one of the main things is I feel like this AI server and GPU capacity in the supply capacity has created sort of a equalizer for some of these cloud players. And let's say there was no supply constraint in GPUs, and there in theory there wouldn't be no supply constraint in AI servers. then if whoever had the most amount of money would just be able to buy infinite amount of AI servers, and they would probably lead the space.
Yeah.
But with this capacity, NVIDIA and all these other players, they obviously give a good bulk to whoever's paying the most, so the top 3 cloud service providers, but it has allowed them to not jump the boat dramatically and kind of create this massive AI server that is giving Oracle the ability to also build these AI servers. And even though they might not have the capex that Microsoft or all these players, they can still make a nice footprint in AI server growth. And I think right now the capacity has created at least some equalizer for Oracle to kind of become somewhat of a player here in the cloud infrastructure space. So I don't know if they got lucky, but when we started to see AI servers come out really about 2-3 years ago, Larry was everything that NVIDIA came out with about 2 years ago. I always saw Oracle being one of the first players to say, hey, look, I'll buy that. Hey, look, I'll buy that. Hey, look, I'll do this with NVIDIA. And I think they somehow either knew that at least AI was going to go somewhere.
Yeah. I mean, that's you make an interesting point there that there's not enough to go around. So everybody's getting a little and not everything that they want. And so nobody has built an insurmountable lead. I think that it's an interesting way of looking at it that I hadn't considered. So yeah, fair enough. Let's move on to NVIDIA for the next story here. I want to talk about CoreWeave, Jose. CoreWeave is one of the, it's been a frozen IPO market for a few years now. And now here we are with a bunch of market volatility right when CoreWeave, which is an NVIDIA-backed company, is wanting to go public. Now, I'm going to be perfectly transparent here, Jose. It is not clear to me exactly what the CoreWeave advantage is and what it is they do. So I may need you to help me understand why I should care about this business. Here's what I know about it. $1.92 billion in 2024 revenue. That's according to S&P Capital IQ. And they are reportedly wanting to raise $4 billion in the public market on a $35 billion valuation. So this is another one. This is another company that wants to Bigfoot the market. They want to raise a bunch of cash right on entry into the public markets. But that takes them public at 18.3 times revenue. So they're coming in at 18 plus times sales. Do you think that multiple is going to leave them begging for money that they're not going to get, or are there going to be enough people willing to take them up on the product, on the equity here, so they can raise the capital they want?
I think right now, Tim, we are seeing in the market where if you have kind of AI, especially in the private sector, you're getting billions and billions of dollars. I mean, right, we have OpenAI that I think is valued at over 125, and any of these new startups that are just starting with maybe some old ex-OpenAI executive are already in the multi-billions of dollars of valuation. So will they get money? I think so. I mean, with CoreWeave, I haven't read. I know they released their document, and from what I've read so far, Microsoft is a big customer of theirs. I think they mentioned about something over 64% of their revenue is coming from these Microsoft contracts that they have. There was some article that just came out about 24 hours ago that mentions that CoreWeave inks a $12 billion contract with OpenAI ahead of IPO. So I think the only real growth story here is pretty much what we talked about with Oracle, that there's just not enough capacity to go around. So if you're able to grow in that capacity, and I think Oracle, just to pull back on Oracle, they were able to grow their infrastructure as a service over 50% versus last year. Even though the whole cloud market grew about 20 something percent, infrastructure as a service grew over 50%. So
it was up 40. It was up. Well, it was 51% in constant currency. You're right.
Yeah. So I think with CoreWeave being more of just from what I understand, more of a pure infrastructure play, you would expect kind of those similar returns if they're able to kind of grow in the overall infrastructure market. The other thing with CoreWeave is they are mainly more US based and kind of I believe they might be expanding into UK. But one of the things that has really kind of hurt a lot of these neo cloud server providers, which I would kind of call CoreWeave one of, is a lot of them are in these tier 2 and tier 2 countries outside of the United States, which kind of might see some pressure with the AI diffusion law, which was a law that kind of took in effect before Biden administration left. And we haven't seen those laws or that law kind of be traced back. So I'm gonna guess we're gonna stay with that AI diffusion law, as it does kind of put a little bit more emphasis in US and tier 1 countries investing, more data centers investing in those places. So CoreWeave has, I guess, that growth opportunity of infrastructure as a service play. They have huge contract players already with Microsoft and that based report on OpenAI. And then they are also working in countries which are considered tier 1, obviously United States and allies around that area. So will they get money? Yes. Am I happy about the valuation? I still don't know, but I'm going to probably lean more to the no side right now.
All right. I asked Jester for an answer on tell me about CoreWeave's product. This is what it said here. So Jester is our internal AI tool. CoreWeave is a specialized cloud provider known for its high performance computing infrastructure, particularly in the realm of GPUs. Their offerings cater to various industries, blah, blah, blah. So, okay. So this is how I am understanding it, Jose. I'm going to simplify it. I think this is a specialist cloud. It's an AI cloud. I go here when I want to. So this is to your point. I can't get Blackwell yet. I can't get enough GPUs. Who's got GPUs? I need compute. Who's got them? And you got CoreWeave, the guy, over here saying, I got your GPUs right here. Come on, son. I'm open. I'm open for business. That is what CoreWeave is. It's a specialist cloud that has access to a bunch of GPUs, and they're NVIDIA backed. And so I think the argument here for CoreWeave is that, hey, we are very close to NVIDIA. They give us their GPUs. We're a core customer here. We get them, presumably, Jose, at some kind of wholesale price. We get them at a discount price. We also get early access to the newest GPUs. And so CoreWeave is how you get AI cloud and AI cloud compute access when you don't immediately have access to the latest AI engines. That's kind of, I think, the argument here, which is why it's trading for a ridiculous premium. That totally makes sense. The issue I have with that, and I'll have to read the S1 to see if I'm right about this, Jose, unless they have exclusivity and early access with NVIDIA, that sounds like one brutal commodity business.
Yeah, Tim, and it is. I think this is why kind of these are pretty much more like just pure compute rent out, right? Where if you kind of go to like Azure or Microsoft, or Amazon AWS or Google Cloud, you get a lot more other services that you can kind of rent out from here. So here you're kind of purely just getting compute, and I don't think they have any other solutions. But one of the things that we are seeing is some of these big tech players like Microsoft, they sometimes say, you know what, maybe I don't need to expand and buy my own infrastructure right now.
Right.
Let me keep up with demand and let me lease out this super cheap infrastructure from CoreWeave at the moment. And then I can put all my services on top of that, because I'm just renting out the compute. I can still put all my stuff on top of that. And then I can even sell it for kind of like a premium because I'm starting to add my things on top of it. So I think as big tech is still not wanting to overspend, but they do, I feel like we've heard from big tech players, at least a few of them, that there's still more supply constraint versus demand, so they have more demand than supply. I think we're going to see at least where these bare compute renting out systems are going to get a lot of investments, or at least multi-year contracts from these top hyperscalers, where for them, it's like, maybe I don't need to buy this many B200s. CoreWeave can do it. I'll just rent out that compute, put my things on top of it. And when they get the next solution, I can follow suit. So.
Yeah. I mean, this is something that Satya Nadella has been saying. He has said, like, over the next couple of years, there's an expectation that Microsoft will at some point will not just be a buyer of everything, they will become a renter, like a renter and a reseller. And that raised some questions like, well, wait a minute, is there a hardware cliff coming? And how does that work? And so in a way, you could read that. One way to read that is to say there is space for a third party to step in here, like a CoreWeave, to become like, hey, we are the warehouse operator that just provides this. We are like the another way to think about this would be like, I have the, if you need storage, you go rent a storage unit. Like, you don't buy or build another garage. You go get a storage unit. And that this is like the similar idea is what it sounds like.
I think that's a great way to kind of, at the moment, explain. Obviously, they can probably push other products at them later on and maybe expand more into the cloud space. But at the moment, I would say that's how you can see this in kind of the cloud space, being more of like that storage warehouse.
Yeah. Yeah. This is what it's looking like here. So that's an IPO. There's a few IPO. I mean, the market nuttiness may delay some of these IPOs. We don't know, but CoreWeave is one that has been kind of waiting in line, and it's been coming, and it is anticipated. So that's one to watch for. But it's a little bit on that. And Nvidia, to be fair, early investor here or early backer, they stand to make a lot of money depending upon how well and CoreWeave does in their IPO. All right, moving on. I'm going to move on to Tesla. I'm going to come back to my other big question here. So I have a question for you. I have a question for the chat, and we'll get to more questions here. I don't want to talk politics. I do want to talk about, do we care? Should we care that Elon Musk is signing up for another year to be operating with the government? I don't want to talk about whether, your view or my view or anyone's view of what he's doing there. What I want to talk about is he has admitted, Jose, that it is harder for him to focus on his businesses being in this role he's got with Doge. That's a fact. He said it. He said it in interviews. Should I care about that? I am the lead advisor for Rule Breakers, and Tesla is a super important stock in Motley Fool Rule Breakers. And so when he says that, it has me thinking. So here is a scenario I'm going to give you, and you tell me what you think of this, because I'm just only going to frame the question for you as I am thinking about it. So at an adjusted free cash flow yield, so once you take out all the stock-based compensation, when you adjust their free cash flow to what they actually generate on an organic basis, and then compare that to their enterprise value, Tesla trades for a free cash flow yield of 0.23%. That is an extraordinary premium. My view of what that valuation implies is that Tesla is already valued as if autonomous vehicles and robotaxis are very close to already here, which we know they're not. But this is how the company is valued. Autonomous and robotaxis, they must arrive and they must be successful. That's how the company is valued today. And my view of it is, well, the guy, historically, we know that Musk has been able to run multiple companies and make big visions happen. But the market is a little different now. And can Tesla, with a distracted Musk, achieve this big vision that he has laid out? That's the question that I'm asking myself. I'm not talking about operations. There's plenty of operators who are helping to run Tesla right now, and that's always been true. But this big vision that must occur, can it be done with a distracted Musk? What do you think?
So first, I would say this is probably maybe the wrong time, but it's kind of like a perfect test if he does kind of do stuff for another year of like, I know there's a lot of companies that are very dependent on their CEO. And it's like, hey, what happens if this CEO, unfortunately, something happens to the CEO? What happens if they leave, if they have to go? Will the company still survive? Well, this might be like that 1 year test or so where he's still going to be back in a year or so with full concentration. But can Tesla kind of pass that test in this 1 year? And if it does, then at least in the long term of things, it could be like, okay, even if Elon Musk decides to do something else in the future, we know that Tesla can still run as intended and create revolutionary products. In forms of the valuation, Tim, it definitely trades at a crazy premium. My question would be with this is this premium cheaper or more expensive than maybe the past 4 years? And the reason being is I feel AI has transformed so much in just 2 years that if you were kind of giving the same type of pricing on Tesla 4 years ago than it is now, I would actually think, even though it's same, it's actually cheaper because with the evolution of AI and all the data that Tesla has, their success rate, in my opinion, has increased dramatically. So if that valuation is similar to how it was 4 years ago, and I would say that Tesla technically, in my eyes, would be trading cheaper because the probability of success has increased. I think,
Okay.
so that would be my first thought. Can it succeed? I mean, I have a Tesla, Tim, and FSD, I probably use it 90% of the time. It's very rare for me not to be using FSD when I go out, and this is either with my wife or even my little one or by myself. So it's something that I feel safe using with my family. Obviously still completely supervised, but via every version that it goes, it just shocks me. And sometimes I'm in the car, Tim, and I'm like, I can't believe this is a car for itself. It still shocks me every time I drive it. So when seeing that, I do believe they have a high probability of succeeding with the AI technology. And with whatever, a robot is just a bigger robotics, in my opinion. I think Elon has mentioned it, that with a robot, you do a lot more tasks than you can in a robot. So it's a lot harder to train, but at least they already have kind of like this head start of some of the things that they've done with their car that they can kind of progress into the robotics that no other company has. So I think they have some form of lead there, and then just the manufacturing capabilities in both autonomy and just the robotics. Again, so with all that, I think AI has made the chance of success rate a lot higher. Tesla has the infrastructure, the training capacity. They have a lot of great engineers. They have products with via FSD that I can virtually see or physically see that has been doing really well. So as long as all that continues, I think they can succeed with this goal that they have.
That's okay. Interesting. I'd like the more positive view of it. The only thing where you haven't sold me is what the other thing that's changed in the last 4 years is this is a market where there is way less oxygen for Tesla. The competition, now, to be fair, you're talking about other things like the next stage they're getting to, but they also have a division that's the primary driver of their business, which is cars. And boy, oh boy, the amount of competition that they face in electric vehicles has gone up dramatically over those 4 years. So their core source of cash flows is under more threat than it was 4 years ago. So as with everything, this is a pretty complicated question. It is not easy. But this is like the way that I think of Tesla is they have got to realize this vision. And in order to stay with this business and stay confident in this business, I must believe. I must. This is how I see it. You don't have to see it this way. This is how I see it. I have to believe that they are well on their way to achieving this vision. And the question is, should I be more comfortable believing that if Elon Musk were fully focused on it? Because he ain't gonna be, at least over the next year. So that's a question for me that I have not answered. So I want to put that out there. And if we have thoughts on this, please go ahead and put them in the chat. All right. Let me pause and take some questions before I ask you the other question I've got, because we are now 35 after the hour and we took a lot of time here. So quickly, Cena asked me about the Asana CEO retirement. I haven't looked at it, Cena, but if I could give you an instant react, I'm like, nah, shrug emoji. And the reason why is because I think Asana has way bigger things to do than figure out, like get to see it. Now, if it's the founder, if it's Dustin Moskovitz, that to me would be more like a warning signal. But I don't think that's what you're asking me. I'm going to hold the one from 307 Fool because it fits with what I'm going to ask you a little bit later. But Besties is asking, Jose, with constraints in GPU supply that you're talking about, this would imply that Nvidia or competitors still have a ways for revenue growth for how long? So in other words, the supply demand curve is still out of whack. So what Besties is asking is does this imply years of pent-up demand that have yet to be satisfied? I don't know that we can make that argument, but what do you think?
Yeah, I don't think, I think one thing we can say is NVIDIA CEO has mentioned the following, that when first let me backtrack. One of the biggest scary thoughts for especially AI chips and data centers and any tech in general, when it gets very exciting, we tend to see heavy over inventory, everybody just buying as much as possible. And this creates kind of this over inventory cycle. Now, I do believe this cycle will continue here with AI chips, but I think the GPU supply constraint has allowed this cycle to last longer than normal. Because if it wasn't a GPU supply constraint, everybody and these big tech players would just have loaded like crazy with H100s and then be like, you know what? We have so much H100s. We're not going to buy the H200, the Blackwell platform, and so on and so forth. So first, I feel like it has protected the wallets of all these big tech players who might have had an open check before to make it seem like they were more conservative on spending. I don't think they were that conservative on spending. I think they just physically couldn't purchase as many chips as they wanted. The other thing is NVIDIA has, in my opinion, done really well with explaining their roadmap with all these other players. And Jensen, in various interviews, has said that he tells his customers, don't buy all at once. And the reason is like, you can buy H100s, we'll sell you the H100s, but we would recommend you don't buy this full capacity that you need because the H200 that we're going to release next year is going to be better. The Blackwell that we're going to release is better. And then so on and so forth. So we would recommend that you buy in forms of like a stack. You buy some here, you buy some there, you buy some there, and you buy some there. I also believe that kind of mentality has helped out with at least pushing out the inventory correction a little bit longer. And Microsoft CEO at a recent investment pretty much mentioned the same thing, that when they buy these GPUs, they don't buy in bulk anymore because they know this pipeline from NVIDIA that they buy a little bit here, a little bit there, and a little bit there. So as long as that stays in place, and I do believe the GPU constraint, while it is kind of ramping up in the progress, the great thing is as GPU supply increases, AI innovation is also increasing, and we're seeing kind of new applications being built on top of it. So it's kind of, I guess, following that curve at the moment. I think the real inventory correction, so yes, I believe there's still the opportunity for growth, but I'm going to say that the real time of testament is going to be when this GPU supply keeps on growing, but the innovation of AI stops flattening. And I think when that happens and GPU supply constraints still keeps going up, I think that's when we're going to really see kind of the pressure on companies like NVIDIA and whoever kind of provides other types of AI accelerators. But at the moment, from the current channels that I study, I think that there is ways for rapid, or the opportunity, not the absolute or not the guaranteed, but the opportunity for growth. And for how long? As long as that GPU supply constraint and that AI innovation and growth in AI products continue to grow, I think we will be fine. But that's my optimistic thoughts.
Well, you know, the way that you may not have intended to describe it this way, but the way that you describe that, Jose, that reminds me of, like, you are essentially arguing, whether you meant to or not, and maybe I misheard it, but you are essentially arguing that NVIDIA, by virtue of how they manage their roadmap, they are constraining their own supply. And in constraining their own supply, I mean, this sounds so cynical. I do not mean to sound cynical. This is just the best comparison I can think of. That sounds like OPEC. That sounds like the Middle Eastern countries that constrain supply when they want oil prices to be stable. Like that, I mean, they will at times, in order to manage that market, they will cut supply. And so it is fascinating that you described it that way. I don't think you meant to compare, Jensen Huang to the Saudi royal family, but I think in a way, you kind of, in a backwards way, you kind of did, which is
the
really
only
interesting.
thing I would say from there, Tim, is NVIDIA isn't itself doing it, right? Because TSMC is the one that really says, hey, I
Okay.
can't build it for you, right?
Sure.
So unless there's some evil, there's some back meetings that obviously there's a lot that we don't know about, but the supply constraint is not really kind of created by NVIDIA. It's more created by the constraints in the manufacturing capabilities.
Sure. Okay. So it's a multi-part constraint. Fair enough. Fair enough. Okay. Let me ask my question here. In a second, we'll blast through a couple of other questions quickly. Spiffy saying, buddy of mine says, I'm sorry. Buddy of mine's girlfriend has a Tesla, and his son set the car in FSD, and it drove to a restaurant without any interactions. He was amazed. Most have no idea. Nice. I mean, that's a good testimony. I'm sure there are more of those, Spiffy. Jose just gave one kind of just like that. LY winners win. Seems like Waymo has overtaken Tesla as first mover with Robotaxi. I think we are nowhere close to first prover here. Winners win. Robotaxis, I think this market is in the earliest of early markets here. So I'm not ready to start calling winners, but it is interesting. Spiffy also saying, I'm not crazy about Musk getting involved in politics, but Tesla's been a massive winner and keeps delivering, although not on Musk's time frames. No way am I selling. Yeah, I'm not selling either, but I wanted to express the question that I have because I think it's a legit question. And then this one on, let's see where. Oh, yes. Let it ride. Tesla Robotaxi is a 2-seater, not operational. Waymo's a 4-seater and operational. Zoox soon to be operational. Is Tesla the first mover leader on Robotaxi? Again, I think it's too early to say. Let it ride, like who it is and isn't. But I do think Tesla has so much riding on being dominant in robo-taxis, I think it's fair to keep really close tabs on how they execute this vision, especially in light of Musk deciding that he's not going to be focused on executing that vision in the short term. Long term, I'm sure he will be. All right. Let me pull up 307 Fool's question because it relates to my question, Jose. Do you see chips from Microsoft, Google, Meta, and Amazon as actual competitors to AMD and Nvidia in the next 5 years? My question is related to that in this way. And I have a prediction around this. All of those companies are making custom silicon. They're all doing it. And they all think they need it. They all think they need custom silicon. And in that way, they are potentially taking some business, potentially, not automatically, because NVIDIA and AMD also, build. They do have a custom build part of their business, but it's tiny. It's tiny. Most of this custom silicon is going to be based on ARM. And I think we know that. It's going to be based on ARM, might be based on RISC-V, might be based on something new entirely. So all of this is true. I'll make my reckless prediction in a second, but I want to kick it to you to answer this question about how much of the custom silicon movement takes away from NVIDIA and AMD, or does it take nothing away from them?
And I hate to be saying this, but I think it all depends in AI innovation. If AI innovates at rapid levels, I think it's going to take very little. If AI innovation starts to flatten out, I think it has the opportunity for ASICs to take a bigger market share. Jensen pretty much talked about this during their earnings call. Tim, and he mentioned a few things, but on a top level overview is very similar to like the GPU supply constraint. There is a constraint on data centers. There is a constraint on real estate. There is a constraint on the power grid system for these data centers, right? If we wanted to build unlimited data centers, I think ASIC solutions would definitely take market share, but we are limited to how much data solutions we can build just due to the various type of infrastructure hurdles that one has to go through. And Jensen mentioned that anybody can design a chip, but then when it comes to the final thing of, hey, look, we have to put chips into this data center, what is going to be the biggest growth opportunity for us with this data center and make the most money in revenue within the next 5 years? Because we only have a limited amount of space, the one that will be able to progress with the innovation of AI, if some new type of workload comes out that maybe the ASIC wouldn't be able to focus on, then the GPU would be the best choice, even though the upfront cost will be a lot heavier. If AI innovation doesn't really move as much and it stays still, it's going to be a winner where the ASICs player wins. And I think at the moment, it's still too early to tell. And most CFOs and CTOs are going to play it safe, where they might build some data centers with these ASIC solutions. We see Amazon pretty much doing it. They're building about a 400,000 Trainium 3 GPU cluster, which is huge. But I think they're only going to limit it to a bit where 3 to 4 years from now, they're going to say, was this 400,000 GPU cluster worth it? Or did all these workloads shift dramatically where our Trainium chip became almost obsolete, and now we have to replace it back with NVIDIA GPUs, so more of like a programmable GPU. So I think right now we're in this stage where we're going to see all these big tech players develop their own ASIC solutions. They're going to bring some data centers, but they're not going to do it so massively until they have more testing points to say, hey, look, we're actually innovating at a great pace, very similar to NVIDIA or these AMDs. Now we can increase the amount of data centers that we have with our ASIC solutions. So I think it's going to be a test approach, and we're going to see the progression over time.
I like that. I think what you're describing too, what rings true about that is just historically, for those who remember it, this is like 10 years ago when the industry went all big data. Everything is big data. We must have big data. Everything is data. Data is the new oil. Remember that one? Data is the new oil. And there was a lot of overspending on big data systems, and the payback was not what anybody wanted. And CFOs, I think, to your point, CFOs, not all of them, and some CEOs will override their CFOs, no question. But CFOs tend to have long memories, and so the idea of test and learn, that makes sense to me. That's probably right. But I will give you an alternative view. Not to say that you're wrong, but I'm going to give you an alternative, and this is my prediction. The reason that test and learn is so important is because the number one thing that gets in the way of AI-powered workflows and more AI-powered workflows is software. More, you must have the software infrastructure. Why does AMD and Nvidia not get disrupted? Because they have the software infrastructure. You can build software. There's known tools for building software on those platforms. That's just a fact. That creates safety, predictability. They've been around. Less risk. Very important. However, and this is where I think if you get unit economic cost benefits, particularly with things like RISC-V, open source tooling to create custom silicon with extremely low input costs, you know what AI is really good at? You could point an AI and say, like, here's my silicon, here's my custom silicon that I have built, to do X thing. Build me the software library for my custom silicon. And what an AI will do, it will build it. It will generate it. You'll still have to tune it. But that is probably the number one blocker for any kind of custom silicon. But if you have an AI that is building the software, building the software libraries for the custom silicon, the barrier to implementing that at scale and yielding unit economic costs has just gone down dramatically. So I think we're probably going to see more of these than we think. But that's a reckless prediction. That's not a regular prediction. That's a reckless one. So you can tell me whether or not you think that's bonkers in the chat, fools. But that's my prediction on this.
And Tim, I tend to have a lot of bearish thesis for NVIDIA, and I don't know why I never tried putting that one there. And I as a bearish thought, or not even a bearish thought, but as like kind of just a thought on competition with ASICs, I think it makes perfect sense. As right now, one of the big, especially for NVIDIA, one of their biggest moats is they just have this huge one software library, and then it creates kind of this ecosystem where it just feeds the flying wheel. But what if you kind of have that AI agents, or these AI agents, which we have kind of software engineers just creating that ecosystem within itself and make it ready, where eventually it's going to be very, like you mentioned, the friction of switching is going to be almost non-existent.
Right.
So that's definitely interesting. I like it. I have to think about that one.
Okay.
And it's definitely one I'm going to add to my bearish thoughts here for NVIDIA, and something we're going to have to see change over time.
Well, I mean, it doesn't even have to be bearish, Jose. It can just be that this is, like, if you have AIs creating new software libraries, that's great news for a company like, say, Cerebras, for example. The system on a chip, which is literally like the chip on a wafer, like a wafer-sized chip that is designed to just brute force AI at in just unbelievable throughput, because of the way that the system itself is designed as a very functional system on a chip, but really system on a wafer. And that needs, like, that you need software libraries for that. If you want to take advantage of that, you need software libraries. So if you have AIs that are like, yeah, here is your software library, you go customize this. That is interesting. That's a way to maybe make these more useful in the short term. All right, 8 minutes left. Let's get a bunch of questions out of the way. Let us know what you think about, both of our our thoughts there. Any other predictions you might have? Jalexand, is Tesla a damaged brand? It depends on who you ask. If you ask the person who sees it as a damaged brand, then you will get the answer. Yes, it is a damaged brand. Unfortunately, and because we do not talk politics here, I'm not going to talk to you about whether or not it is or isn't a damaged brand. We need sales data. When we get sales data, we're going to know more about how much the perception of Tesla has changed. But if you ask, certain segments of the population, they're going to say yes. If you ask other segments of the population, they're going to say no. So we need numbers. In order to really answer that question, we need numbers. This is an interesting one, Jose. Foolish investor from 15 minutes ago. Going forward, is a demand for inferencing, so in other words, generating an answer, going to outpace training, providing the data for getting an answer, GPUs by a lot, or are both going to grow a lot? It does feel as though we've shifted more into the inference side of the equation. Having said that, is data, are data sets going to stop growing? No, they will not. So there's probably a bit of growth on both sides of the equation here. Where are you at on this?
Yeah, I think both are going to be growing, but I think in forms of, if we have like a pie chart, while both are growing, inference is going to take most of the market share. I think the goal for the future is we have kind of AI factories, and it's just some form of AI agents running 24/7. So you need to have some form of these data centers where, how Jensen best explains it, AI factories where they're going to be generating tokens 24/7, because we're just going to be using these AI solutions, these AI agents, like nonstop. So I think inference is going to outpace in forms of market share, but both training and inference are going to be growing.
Yeah, I think that's right. Foolish answers asks a good question here. We'll take this one quickly. Does TSM have adequate facilities outside of Taiwan that can manufacture high-end chips like Blackwell to mitigate future geopolitical risks? So there's two things here. The U.S. wants them to have that. I don't know that they have it yet. They have said repeatedly, Jose, I think this is right, you tell me if I have it wrong, that the most advanced manufacturing capacity they've got, the most advanced tooling, that's there in Taiwan. That's in home base. That's where all the super advanced stuff is. But are they going to diversify and make Blackwell chips on US soil? I don't think we have any idea. And plus, it takes a while to stand up a fab. So it may be another generation before we get, like, it's the generation after Blackwell that we get those kind of chips built on US shores. So I don't know. I think it's too early to say that the US is going to get the most advanced chips or wherever else they are manufacturing. I think it's still largely centered in Taiwan, which, by the way, given the way the world is going with regional disputes, that's a little bit of a worry if you are a Taiwan semiconductor investor like me. I don't give a high rating towards China coming in and landing planes outside of a TSM factory, but I don't rate it as 0. I just rate it as low.
Yeah, same, Tim. And yeah, they don't have the capacity to build here in the United States just yet. I think the one in Arizona, which is producing, is running the 5 nanometer production node, but they just produce so many other types of chips. So if there was only a world where we only needed to produce NVIDIA's AI chips, they can do the wafer manufacturing, but they don't have the advanced packaging facilities just yet. With the recent new investments, they will. But again, these manufacturing lines that they have a fab for like 5 nanometers, then they're going to have a fab for 3 nanometers, and the list goes on and on and on and on. So they need to keep investing here as they get to better and better nodes over time. But like Tim mentioned, the most advanced stays in Taiwan.
Yeah. I have to mention something quickly because I see Max came on and I forgot to do something. I promised Max I would do something and I would correct myself on GitLab. And I had some other stuff. So I want to make this offer. I made it earlier on Mindset on Monday. When I get something wrong or if I need additional context, please email me. Max was so good. Sent me this. I mean, Jose, this was fantastic. Sent me this great, detailed breakdown of GitLab and how they're using it at their company. Really, really good. And there was something I had gotten wrong. This GitLab Duo is, if I'm understanding it correctly, I thought it was for the small teams product. What Max had told me is that it's like the Copilot. It's like the, you know, the GitHub Copilot companion. So I just completely got it wrong as the AI assistant. But in addition to that, there was so much really thoughtful, interesting stuff. So we really want to hear from you. Write to us, post on the boards, let us know, because there's so many people that tune into these shows that have real world experience with products that we're talking about. And that is super valuable data, incredibly valuable. So we want to hear from you. Correct us, give context, insight. We want all of it because it's just so useful. So a special shout out and thank you to Max for that super useful detail. And my apologies for just completely screwing it up, that I had completely messed up my explanation of GitLab Duo when I was doing the earnings last week, Jose. So it's just like, it's embarrassing, but I mean, look, I get things wrong all the time. The important thing is to invite, you know, the opportunity to get data and learn some more, which Max was super, super generous. So anyway, we can move on from that, but yeah, thank you, Max. Super appreciate it. We're almost out of time, so we're just a quick one. So Max saying, thanks, Jose and Tim. Missed the first half hour. I'm sure I'll love that too on replay. I hope you do, Max. Thank you. And then Tim Jungle saying, opinion of Tesla depends on what channel you watch. I think that is exactly right. And then Milner time. Fantastic. Love that. I just passed 7 Waymos in less than a quarter mile, and people love them out here in San Francisco. Curious to see how the other cities go. This is going to be super interesting. We're way early in the robo-taxi build out, and it's probably going to be long term. It'll be a bigger paradigm shift than we think right now, and it will probably in the short term take way longer to build it out than we hope it would. I mean, that just tends to be how tech cycles work. So let's leave it there because we've got healthcare coming up here. So we're going to, my apologies here. Bart, our producer, is saying we are going to stop the YouTube stream. So that gives us a chance to just wrap it up here. And then we'll let Danny and Brian come on for some healthcare discussion. Fools, thank you so much for tuning in to the AI plus Semiconductors Hour. Let us know what you think. You know, I mean, I want to say because it's not I guess we're on YouTube. Like and subscribe. Should we say like and subscribe?
You have to, Tim. You have to.
like and subscribe, share. But also we appreciate you being here, and we'll see you again soon. So Fool on, everyone. Thanks, Jose.